Stories.
We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Not so fast. Jay Powell signals smaller hikes ahead, but says he's prepared to drive rates as high as needed. Wall Street slides while China stocks drop on signs COVID-0 is here to stay. Up next, Bailey's turn. The Bank of England is set to deliver the biggest hike in 33 years to dampen double-digit inflation. The Twitter cull. Sources say new owner Elon Musk plans to eliminate half of all jobs at the social network to reduce costs. Well, just about a minute to go until cash equity trading starts. Taking a look at futures, it is negative. It is about catching up with the U.S. recession. Equities that saw their biggest tumble post-Fed since January 2021. U.S. equity markets fell 2.5%. Of course, they initially rallied after the release, so that fall towards the end of the day, it's something that European markets are going to have to grapple with. So what do we got? We got the FTSE 100, the first to open out of the gate, down 0.3%. It does appear to be faring better than some of the other indexes coming through. Spain is now open. That is down 1%. We've also had a lot of earnings. We've had Uniper, we've had ING, BNP, Stellantis, but how much can those individual company earnings shine through when, again, it is macro trading that is dominating this as well? You can see the dollar stronger against all of these foreign exchange, this foreign exchange column. The franc is down. We also saw the euro down. Here's what the dollar is doing in its own right, up 0.3% for the Bloomberg dollar spot. Again, it's a market that got maybe a Fed pivot, but if it was a Fed pivot, it was towards more hawkish, or at least towards concentration on the terminal rate, not each individual rate hike. So it's a market that needs to adjust. We also just saw S&P 500 futures just dip into the red. They did start out the morning positive, rebounding from that ugly session, but that's not holding on. U.S. two-year yields, they've been trading for less time this morning considering Japan was closed, so they've been trading for about an hour. Yields are perking up even higher on the front end of the curve, up 6 basis points. At 4.67%, they might need to go even higher. If we do get a terminal rate that is above 5%, Nomura says it should be 5 3/4. Finally, it's ugly in the European bond market as well. That sell-off really taking a global shape. German 10-year yields, those are up nearly 12 basis points. Well, let's continue with this story, continue with the two-year yield and the Fed decision. Let's head over to our Bloomberg MLive managing editor, Mark Cudmore, who, as I said, is taking a look at that. Mark, what do you got for us?
Yeah, Danny, good morning. You said the two-year yields might need to go higher than 4.68%. They need to go a lot higher, no might about it. They are definitely going much higher. They're probably going above 6% of the two-year yields. The history over the last 30 years shows that two-year yields normally top out above the terminal rate. It's now pretty much consensus terminal rates going above 5%. I don't know where that's going to stop, but it's easily going to break 5%. Let's say the terminal rate goes to 5.7%, 5% that you're saying Nomura is going to, then two-year yields probably go up to 6.5%. That's the kind of ballpark we should be targeting towards middle of next year. Remember, U.S. is probably not likely to head into recession until maybe the second quarter of next year. There's lots of time for those two-year yields to climb in the interim. Look over the past 30 years. Two-year yields back here went almost 2%, the peak above the terminal rate pricing back in the 94 move when terminal rate got up to 6%. Again, in the dot-com bubble, two-year yields went above the eventual terminal rate. Now remember, they get there first, so the two-year yield rose here quite a few months before the terminal rate got there. Again here, it was actually pretty coincident probably in the housing crisis. That's the one kind of exception, but it did not stop early because it got to where the terminal rate is. You can see in this brief cycle, so ultimately, terminal rate going above 5%, two-year yields going above 6% over the next 6 months or so.
As if the bond traders haven't had enough hard times this year. Mark, thank you so much. Bloomberg MLive managing editor there, Mark Cudmore. So we had another jumbo hike by the Fed. Chair Jerome Powell left little doubt he's prepared to push rates as high as needed to stamp out inflation, even as the central bank eyes a slower pace of increases.
It is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level.
Certainly a lot to discuss with that. And joining me to do just that is Callum Pickering, senior economist at Berenberg, and Gina Martin-Adams, making the rare trip from the U.S. over here, chief equity strategist for Bloomberg Intelligence. Thank you both so much for joining us. Callum, if I can start on that point that Mark was making, that I kind of made, but he did more dramatically, so it's much better. The fact that this market has more adjusting to do, that the terminal rate will be higher, yields need to catch up. Do you think that's right?
That's right. At least the short end of the curve needs to move higher. The question is, we might start seeing opposing forces at the long end of the curve. So you take the 5 or the 10-year yield. As the Fed surprises on the hawkish side, we price in more rate hikes. But then we also need to factor in that this is probably going to be more disinflationary. So we eventually get to a point probably where these hawkish Fed moves actually start to look dovish at the longer end, even if they push the short end up. That's that yield curve inversion that we often think about in markets. The question is then, how do other risk markets behave? My bet would be, at some point, actually, equities are going to start benefiting from a hawkish Fed because they're going to see discount rates get pushed down, analysts are going to see present values rise, and it's going to start to feel easier. At the moment, the bond market and the equity market are moving in the same direction, but I think that breaks down soon.
Yeah, Gina, what do you make of that?
Yeah, I would generally agree. I mean, I think the equity market largely prepared for a 2-year closer to 5% by the end of September. The sell-off was so significant that our fair value model would say, not only did we prepare for a 5% 2-year yield, but we prepared for a roughly 5% contraction in earnings growth over the course of the next 12 months. So 6% on the 2-year yield, as Mark was suggesting, is certainly above market expectations right now. But we've seen so much capitulation in analyst estimates and so much sort of downdraft in analyst earnings expectations just over the last 6 weeks that it would imply we're at that sort of moment where the equity market is pricing a tremendous amount of risk. It is a lot of volatility in the short run, and it's really difficult for stocks to get any kind of lift before the Fed clearly signals that they will indeed pause. This sort of move to short rates still going higher, but at a slower pace, is just not enough, considering the last couple of weeks of price action have really revolved around expecting something from the Fed. But longer term, it looks to us like we have priced a tremendous amount of risk.
See, I feel like this is, I kind of had this idea in my mind that we still had the Pavlovian urge to buy the dip, that markets were perhaps just really looking for any excuse to interpret this as dovish. But I'm almost hearing sort of the opposite from both of you, that perhaps it's too negative at this moment, that the equity market isn't looking ahead, it's capitulated, it's not ready for that disinflation moment yet.
My general view is that we're close to bottom in risk markets, because what we're doing is we're essentially factoring in mutually exclusive risks. So take the equity market at the moment. We hear from companies, we hear from analysts that earnings are likely to disappoint, that firms are losing pricing power. From an economics point of view, that gives me confidence actually that we're going to lose a lot of this inflation pressure next year. The bond market is reacting to a Fed that's turning more hawkish, essentially reacting to inflation risks. So you have disinflationary risks hitting the equity market, analysts factoring in higher discount rates because the bond market is worried about inflation and interest rate risk. So these are mutually exclusive risks that the equity market is having to eat up at the moment. Once those discount rates come down, as long as the recessions aren't much worse than expected, actually we should start to see some movement higher. This meeting, I think the market was hoping for that. Maybe it's going to take December or maybe next meeting.
I do wonder if we do get to that environment, or at least equity markets start to price in that environment where we move away from constant rate hikes. It looks something more like disinflation. Does the old leadership come back? Can we go back to the same playbook of the FANG stocks, the profitless tech? Do those become popular again?
Very doubtfully, mostly because those are the areas of the market that are still too expensive, especially the quality areas. So not profitless tech, but the areas of the market that are too expensive are the mega cap stocks in the S&P 500. They're the communications, consumer discretionary, and technology sector stocks that are trading at about a 50% premium to the broader index. The rest of the index on an equal weighted basis and excluding these stocks is actually trading at lower than 15 times earnings, which would imply that the rest of the S&P 500 is really close to pricing that terminal rate that we were talking about earlier. The problem that we have is these mega cap stocks are still, there's a tremendous amount of concentration risk. Everybody owns them. They own them against a deteriorating earnings trend. They own them on the premise that they've got sort of impenetrable earnings growth prospects into the longer term. And they're higher duration equities. So a lot of this comes down to a question of what does the cycle look like to you? Does the cycle look like the last cycle where interest rates were incredibly low for a long period of time? Inflation was a non-event. It was disinflationary flirtation with deflation for the vast majority of the last 10 years. They worked because of that macro condition as well as their perceived earnings moat. I think you have to ask yourself, do we want to pay a 50% premium for these stocks in an environment where their earnings outlook is very different than it was last cycle? And the broader macro spectrum may be very different as well. I would argue new leadership also always emerges out of recessions, with the one only exception of the pandemic recession, which is really just a perpetuation of former leadership. Otherwise, every recession in U.S. history has created a trigger, a shift change in sector leadership for the S&P.
Yeah, no, while you were saying, are we going to go back to that deflationary environment, Callum, I saw you vigorously shaking your head no. I mean, it seems like you agree with that idea.
I fully agree with that. You know, global forces shape inflation in an open world, and it's still an open world. Despite some deglobalization, we have aging populations, which are leading to labor shortages that will push up wage pressures. We have deglobalization, which weakens the efficiency of global supply, where greening economies faster actually than the technology would otherwise grant us the ability to. That's going to push up prices. Fiscal activism, banks are well capitalized, households have got some cash. This is an inflationary dynamic that we're in. I don't think it's got a 4 handle. It's probably got a 3 handle in the US. It's got a high 2 handle in Europe. But what that will mean is once central banks eventually think about pivoting, they probably won't be able to bring rates down fast. They'll take a little bit out to the extent that in the US and a bit in the UK, we're going to have to go above equilibrium interest rates in order to bring this inflation pressure down. We get back to equilibrium, but equilibrium in the US probably has a low 3 handle. In the UK, it's probably got a high 2 handle. So 0 is over, and that will actually make it harder for passive investment, probably a bit easier for active investment to the extent that there'll still be some capital around. Bad companies will get washed out. Good companies will have an ability to take on some risk.
Maybe stock picking will finally be back. Maybe that phrase will finally be true. Gina, Callum, thank you both so much. Gina Martin-Adams, our chief equity strategist for Bloomberg Intelligence, and Callum Pickering, senior economist at Berenberg, stays with us. Now, coming up, it could be the biggest rate hike since 1989. We're going to look ahead to the BOE's rate decision. That's next. And we'll also bring you more live coverage from Europe's largest technology conference in Lisbon. Don't miss that. This is Bloomberg.
Everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, you know, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
The difference between political gossip and policy intelligence. Bloomberg Government provides our clients with expert reporting, analysis, and public affairs tools that give you the edge in reaching policymakers on the Hill. When you're in the business of influence in Washington, information and connections are the currencies on which you rely. For knowledge you can act upon, the difference is Bloomberg Government.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in.
We may be seeing a Fed that doesn't have to do a whole lot more.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, tomorrow on Bloomberg Television and Radio.
Welcome back to The Open. About 15 minutes into your European trading day, it is an ugly day. The overall benchmark index down some 0.9%. Of course, it comes after the U.S. sold off about 2.5% during the cash equity trading. Europe didn't fare as badly since most of those losses came during the Powell press conference, came when European markets were closed. So there is a little bit of catch up, but of course, a lot of earnings to digest as well. Now, the other macro factor for this market to digest is decision day for the Bank of England. Currently, we're pricing in 75 basis points worth of hikes for UK rates. It is the central bank's largest in 33 years. The BOE's announcement comes at 12 p.m. UK time today. We'll also get economic forecasts from the bank. For more on this, we're joined by Bloomberg's Lizzie Burden. Lizzie, so much has changed since their last forecast, their last decision in September. Where does that leave the bank today?
Yeah, it's been a wild ride since the last decision. We've got a new Prime Minister, a new Chancellor. Trustonomics has been ripped up, but that means for the Bank of England there's less inflationary pressure to fight off. At one point between the meetings, markets were pricing 200 basis points of hikes by this meeting. In other words, there would have been an intra-meeting hike. What they did do, though, was, of course, emergency bond buying to save the pensioners from the market turmoil of Trustonomics. We're not expecting such a big hike today, 75 basis points. It'll still be big. It's taking rates to their highest level since in 14 years because we've got double-digit inflation, because you've got a tight labour market. But around the decision, what you're likely to see is dovish commentary, dovish minutes, a dovish presser, perhaps a dovish vote split, and a reduction in the inflation forecast. Why? Because of the impact of higher mortgage rates, the slump in consumer in sentiment generally, and because we've got this fiscal tightening expected on November the 17th. So really, it could be a historic rate decision, but the drama is going to come in the details around it.
Lizzie, it just proves what a weird year it has been when you can say 75 basis points is big, but not as big as we thought about before. Look, to some degree, the BOE is also flying blind here when it comes to the fiscal statement. Perhaps there's more clarity, but that now has been pushed back to November 17th. What does that mean for the BOE?
Well, it's not ideal sequencing. Andrew Bailey had said that he wanted it to be budget first, decision second. And as you say, the BOE is flying blind. Can you blame Rishi Sunak, though, for wanting to get under the bonnet of this budget? He was the Chancellor. He's a details man. This could be premiership defining. But really, the delay in itself perhaps doesn't make that much of a difference. Markets were seeing 75 basis points before. They're pretty much almost pricing that now.
Okay, Lizzie, thank you very much. Bloomberg's Lizzie Burden. Still with us here in the studio is Callum Pickering, senior economist at Berenberg. Callum, it does feel like that September decision was, I don't know, years ago. We're in such a different world. And Lizzie mentioned it, we're talking about this in the break, how much the bond market has changed, how much financial conditions have eased since then because of what's happened. What does that mean for the BOE today?
Well, the Bank of England at least can think squarely about economic issues. This is not a question of how much do we have to do in order to shore up credibility because of fiscal mismanagement. Basically, the UK's fiscal credibility is returning under the new Prime Minister. the Bank of England will just meet expectations today, 75 basis points, down from 150 actually just a few weeks ago. But even though that's a big hike in historical terms, in context of actually easing financial conditions because some of the fiscal risks have been taken out, actually the transmission of monetary policy here is actually a little bit obscured. So we raise rates at the short end, but it's happening in context of falling rates at the long end. And so net-net, actually, the tightening effect won't be anything like what a normal 75 basis points hike would deliver.
When it comes to the transmission mechanism, I think that's a really interesting point, the fact that it's not as clean as it once was. What does that mean when we get to a recession? Is there a chance that the market runs away from the BOE, that tightening goes too far again because they don't have as good of a grip on financial conditions as they did?
So the market, in my view, has gone too far in its rate expectations. So if you take a look at the OAS curve at the moment, peak rate is 4.8%, down from 6.2. So the market has shifted down. We're in a disinflationary recession in the UK. There's an enormous tightening through the mortgage market, which is going to squeeze household demand. The effect of this will be, in my view, by the time we get to February, the Bank of England won't be hiking interest rates, and the market will be okay with that. So I think we get 75 this month, 50 next month, and then they'll stop at 350. When it comes to the fiscal sequencing, which is important here, the best argument for delaying is that bond yields are coming down and gas spot prices are coming down. So the fiscal gap is shrinking over time. And to the extent that actually we see some more austerity, that also will take the pressure off the Bank of England at the front end of next year. Is it a case where austerity today is actually beneficial for the private sector because it brings down interest rates and it brings down inflationary pressure? So net-net, I'm not sure that this will be a big drag on a 12-month view.
That is interesting. Is there anything that you could see as a surprise that would change what the Bank of England needs to do in future meetings from the fiscal agenda, or are we pretty much smooth sailing, less volatility now?
I think if the economic data in Q4 is really, really bad and we see lots of disinflationary pressure in the underlying economy, let's say the labour market falls off a cliff, then that would change the dynamics significantly. I don't think it would change fiscal policy. The thing I think the market will and should focus on today is the Bank of England's forecast. Remember, uniquely, the Bank of England takes market expectations as its underlying assumption. So peak rate in the last forecast in August was 3%. Today, it's going to be 5%. And in August, the Bank of England was forecasting a big disinflation into 2024. So today, I think the forecasts are going to be nothing short of horrific. And that's probably going to bring down market pricing even more.
Okay, Callum, thank you very much. Callum Pickering there, senior economist at Berenberg. Such a fascinating conversation. Well, coming up, it's a two-day rally in China stocks. That's cut short. We'll get into that next. Why? Also getting some lines coming from Christine Lagarde. She is speaking at a Riga conference in Latvia, saying that she is single-mindedly focused on price stability and that a recession wouldn't be enough to tame inflation. We'll get more on that for you next. This is Bloomberg.
China's military power has been growing at an incredible speed over the last 20 years.
A strong country must have a strong military, as only then can it guarantee the security of the nation.
In terms of sphere of influence, we absolutely know that China wants to be dominant in Asia. So there is a target to get to that point, to be a military that is a peer to the greatest militaries in the world by 2035.
The competition for influence is a global one. And through a multi-decade trajectory fueled by planning, money, and pragmatism, China is building a military that allows it to shape the 21st century just as the U.S. shaped the 20th.
one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Welcome back to the Open. About 24 minutes into your European trading day, stocks selling off. We are on the lows of the morning, about 23 minutes into your trading day. We're also getting some hawkish language coming out of the ECB. ECB President Madame Lagarde is speaking in Riga in Latvia, saying that they are single-mindedly focused on price stability, also saying that recession wouldn't be enough to tame inflation. If that's not hawkish language, I don't know what is. Lagarde also saying that they have to be attentive to spillovers from Fed policy. There's a lot of pressure on central banks at the moment to continue to hike to keep up with the Fed in order to do things like defend their currency. So again, she's mentioning the Fed here. Christine Lagarde, again, saying she's single-mindedly focused on price stability. Nagel also speaking, saying that they mustn't refrain from hikes as political pressure mounts. So all the language coming out, it's hawkish, it's talking about hiking, even if there's a recession. Recession is not enough to tame inflation. One of the other big movers today are Chinese stocks. They snapped a two-day rally sparked by opening speculation as the nation's top health body reiterated its commitment to COVID zero. And of course, that Federal Reserve hawkish comments, that certainly not helping Chinese equities either. For more on this, we're joined by Bloomberg's Michelle Cortez. Michelle, can you take us back to the speculation over the past few days? Why did traders so forcefully buy this narrative that there would be easing in China?
People are really desperate to get any kind of insight on what's going to be happening in China. And I think in many parts of the world, there's just a disbelief that things are still so very locked down here and that COVID zero is still being taken seriously. They are trying to wipe out the virus entirely, something no one else in the world is trying to do. And investors really just don't think that's possible, and they're waiting for any signs of change coming out of China. Of course, at this point, we don't have any signs of that. So people are desperately latching on to this document that came out on Monday, started spreading through WeChat groups and other types of social media, that not only didn't say specifically that they were opening, just that they were starting to form a committee to look at what they would have to do in order to open. $450 billion later, we're getting some news that perhaps it's not going to happen as expected.
Okay, Michelle, thank you very much. That's Bloomberg's Michelle Cortez joining us again. We are looking at Asia equities. They did close lower today after two really strong days of rallying. Now, coming up, we're going to talk about what's been sending equities, among other things, on the risk-off path today. It's all about Powell saying that the path is going to lead to higher rates than previously expected. Sure, it's slower, but they did deliver just another jumbo rate hike. We're going to discuss the central bank's messaging and the market reaction next as two-year yields continue to push higher. We're at 4.68%. This is Bloomberg.
Apple has identified its next big business, bringing advertisements to more parts of your iPhone. Today, Apple pushes ads in 3 places: the App Store, Apple News, and the Stocks app. In the News and Stocks apps, Apple shows display advertisements. That means that third-party companies like car dealerships or mortgage lenders can showcase their advertisements just like they can on a website. On the App Store, the situation is different. There, Apple has search ads. This allows developers to buy their way into showing up higher on search results. For instance, an App Store developer can bid for the term car racing or basketball so their apps would surface above competing apps in the list of results. Apple's push into ads is a little ironic, given that its ATT, or App Tracking Transparency Privacy feature, limits the ability for Meta, Snap, and even smaller developers to generate as much revenue as possible from advertising. That's because the feature allows users to choose if they want their data collected and tracked across third-party apps and websites. Still, Apple's hoping to expand its own ads business and is planning to add search ads to its Maps app. Other areas where ads could eventually appear are on Apple Books and Apple Podcasts, along, maybe one day, with an ad-supported tier of Apple TV Plus to compete with new offerings from Netflix and other streaming video providers. I'm Mark Gurman. This is Power On.
Welcome back to the Open. 30 minutes into your European trading day. Here are your top stories. Not so fast. Jay Powell signals smaller hikes ahead, but says he's prepared to drive rates as high as needed. Wall Street slides while China stocks drop on signs COVID-0 is here to stay. Up next, it's Bailey's turn. The Bank of England is set to deliver the biggest hike in 33 years to dampen double-digit inflation. The Twitter cull, sources say new owner Elon Musk plans to eliminate half of all jobs at the social network to reduce costs. We are looking at equities up in trading for about 30 minutes. They are on the lows of the morning. On a benchmark level index, we're down about 1 1/3%. The DAX, that's down by 1%. FTSE 100 doing a little bit better, down 0.7%, but might be some of the weakness from the pound, giving us that currency effect, helping us out here. Of course, we saw the worst sell-off on Wall Street post-Fed since Jan 21. So it's a lot to grapple with, to digest. Maybe a different path, but the destination is much higher. It is now a focus on a terminal rate, and perhaps stocks have to catch up, although we're just talking to Callum Pickering over at Berenberg and Gina Martin-Adams from our own Bloomberg Intelligence, who say perhaps this will be beneficial for equities in the long run if higher rates means we eventually get to disinflation. Now, in terms of the sectors, again, all of them in the red. It is a painful day. It's unsurprising to see what's at the bottom of the ranks here. It is tech that is down 2.5%. It's those longer duration equities, the ones more sensitive to higher rates, because it should be said, it's not just rates in the U.S., interest rates. It's not just yields that are moving higher in the U.S. It is also European rates, with Christine Lagarde speaking in Riga at the moment, talking about the fact that recession wouldn't be enough to bring down inflation. What's doing the best? It's still down, but it's doing better. Banks down just 1/3%. Now, speaking of banks, I want to show you some movers. Well, I'll show you movers in just a moment, or now. ING is up 4 1/3%. We got earnings from ING and BNP. The story remains the same. Higher rates are helping the banking sector. ING announcing a €1.5 billion buyback. Stellantis, that is dropping despite earnings, which were a solid showing. That's down nearly 2%. They retained their guidance. They did beat. Sales are strong. Their pricing remains strong. But again, it's a market where the macro is taking over, and concerns on more cyclical sectors on what higher prices eventually will do to the consumer is taking over. So Stellantis down this morning, as is Uniper, which reported a very chunky loss. I believe it was about 40 billion. It was 40 billion euros. I do have it in my notes. Falling, that was the fall for the first 9 months of the year, really because Russia gas has been cut off, more or less hurting them. All right, let me show you what currencies are doing, because it still is a stronger dollar narrative. That is the story after the Fed talked about higher terminal rates, that the risk is under tightening, not over tightening. That's really putting some pressure on sterling, notable because, of course, we have a BOE decision today. What is a weaker currency? What does weaker sterling mean for Andrew Bailey and Co. and also the euro? That's falling too, despite, again, those lines coming from Christine Lagarde and Nagel talking about they need to keep hiking despite any political pressure. So all of this, of course, the backdrop is another jumbo hike by the Fed. And Chair Jerome Powell left little doubt he's prepared to push rates as high as needed to stamp out inflation. That's even as central banks eye a slower pace of increases.
We have to be open to the idea that the Fed may end up significantly higher than what I'll call an expectation of something in the 5 to 5.5% range in the first half of next year.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
The Fed does not want to see a replay of what we saw in July. It does not want to see premature financial condition easing on the signs of any Fed pivot.
It's not just up and then back down. The Fed's going to keep that peak in interest rates for quite some time till they actually see the improvement in the underlying inflation outlook.
Joining us now is Charlie White-Thompson, CEO of Saxo UK. Charlie, you joined us on probably one of the more weird days, so thank you very much for being here this morning. And I say that because it was just such a massive reaction in markets to this Fed, where it felt like it was relatively well broadcast that they would push for a higher terminal rate. Perhaps the path would be slower. Markets sell off, equity sell off 2.5%. Do we still have a ways to go to shifting to a new paradigm, to understanding this project of higher rates, of higher terminal rates?
Yeah, Dan, it's great to be here. I think we do. I mean, I think we've come from a Goldilocks period where basically we saw low interest rates, quantitative easing. Whenever there was a problem, someone would come in and bail out. And I think we are basically in a new paradigm. And the thing I found really interesting about the US action last night is the market was looking for some dovish, and it thought it saw it, and then it didn't get it. And Chairman Powell basically then just doubled down on it, and he said, no, we got some way to go, very premature, this is strong guidance. And I think, therefore, the market is really trying to decide on how it can deal with that. And the Bank of England, it's a huge day.
It is a massive day. What are you looking for from the Bank of England today?
Yeah, so I've been thinking about sort of 3 different scenarios. I mean, I think, so we have 50 hike, 75 hike, 100 hike. And I think that the strong money is on 75. And I think that, that's what I'm looking for. I mean, I think that, to use an analogy, the Bank of England should look to land that plane bang in the middle of the runway. I think if we came out with 50 basis point hike, I think the market would say that the Bank of England doesn't get the inflation worries. And then I think with 100 basis points, as I was thinking about this yesterday, I initially thought that the market would like that because it would show strength. The Bank of England understands what they need to do. But then when I saw the price action in the US, I think that 100 basis points would be viewed as negative as well. And therefore, land it in the middle of the runway, 75 basis points.
Is there not some degree which the BOE needs to grapple with a market that just saw financial conditions loosen pretty significantly? With Liz Truss out, with Rishi Sunak coming in, you see bond yields come back in. Do they have to account for that in sort of putting this more hawkish narrative, tightening conditions, yet again, in reaction to what we just saw in these markets?
Yeah, I mean, I think the Bank of England is in a really tough space. I mean, there's a lot of commentary about them flying blind because of, I think one of the main, I think the real deal's on the 17th of November when we see the budget. And if you step back and you look at what the Bank of England are dealing with, under the Truss government, you had, I view it as 8, 9, 10. So you had a current account budget deficit of 8%. So you had a current account deficit 8%. Budget deficit 9%, inflation 10. If you look at Sunak, you got 6, 7, 10. So it's in a better position, but it's still very challenging. But I think the rhetoric has to be inflation is #1 enemy. We need to deal with that now, and we need to be firm and fair.
What have your conversations with clients looked like around this? I mean, how concerned are they? How have their strategies and the way they view this market changed?
Yeah, I think it's been very interesting. I mean, basically, a central premise for me is this is about risk management. I think we spoke about the Goldilocks period where effectively risk management was by the dip. I think those days have gone. And what I'm talking about and what we're talking about strongly is that if you're going to have sustained returns in these markets, you need to be able to understand risk. And what that means, in my opinion, is multi-asset portfolios, not just equities. So it's FX, it's commodities, it's bonds. And I think it's really important that you understand how to manage the downside. You need to be able to make money when markets go down. And I also think what we're encouraging is we are encouraging a shift away from just tracker funds. I think this really is a time for actively managed mutual funds, hedge funds, macro funds. And what I'm personally looking for is hedge fund managers or managers who've been around for more than one cycle, more than just the Goldilocks cycle, because I think that they have got the experience to deal with what are very volatile markets.
Yeah, I have a great story for you about a millennial peer of mine not realizing that base rates were a thing because they've been zero for so long, so didn't realize they need to be included. So I understand the looking for experience. Look, if I want to get bullish about this UK market, if I want to get bullish about flows coming in, be it investments, be it deals, be it just a stronger pound, is there a panacea? And if so, what is the one thing that needs to be done in this country to boost growth? What are you looking for to really add fuel to a bullish fire here?
Yeah, I think the first thing, I think bullish sterling's tough. I mean, when you talk about 6, 7, 10%, those scenarios I just spoke about, I think it's for tough. And as a house, we think sterling's pretty challenged. But I think what we need to do, I think we need confidence. I think we need a firm playing field. I think we need to deal with this inflation. I mean, when I look at house price movements, when I look at consumer confidence, when I look at statistics like this coming out, it's very challenging. So I think we need something to build on. And when I look at our clients now, the number one question I'm getting is bonds. They keep asking bonds because yields for a generation of investors just hasn't been there. So we're seeing a lot of interest in that. And the second biggest interest we're seeing is options. So the ability to make money on the way up and the ability to make money on the way down.
Yeah, as you say, all about that downside protection. Charlie, thank you so much for joining us this morning. Charlie White-Thompson there, CEO of Saxo UK. Now, coming up, we're going to be speaking exclusively to S4 Capital's chairman, Martin Sorrell, as we bring you the latest from Europe's largest technology conference. Tom McKenzie is there live. Don't miss that. This is Bloomberg.
of a push have you seen from the Kishida government in terms of green funding?
The Kishida administration has committed to doubling the amount of investments in so-called green technologies. I think we need more than just pronouncements. We need real money backing very innovative startups and innovative companies in this space.
What do you make of Kishida's new capitalism?
Well, I think his framework is reflective of the challenges that Japan society is facing, namely that growth has been present, but growth has not been, of course, evenly distributed. But frankly speaking, it's hard to redistribute income if you don't have much income to begin with. If the government and private sector can work together and collaborate to drive more innovative growth startups, that can really drive the income growth that the Kishida government needs to redistribute.
The difference between missed opportunity and actionable intelligence. For in-house attorneys who strive to provide superior counsel and strategic advice, Bloomberg Law offers an unmatched platform of analytics tools and business intelligence. All to help improve productivity, mitigate risk, and inform decision-making. For the comprehensive platform that helps you work smarter and faster, the difference is Bloomberg Law.
The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This subscription advertising model is a very smart move if he goes in that direction. The verification, that little check, is very important to people and could help clean up the platform considerably.
ArcInvest CEO and CIO Cathie Wood speaking exclusively to Bloomberg at the Web Summit in Lisbon. Now, at a time of much uncertainty for this tech sector after this year's brutal sell-off, we are live at that summit. Of course, it is Europe's largest technology conference, and it's happening today. On the ground there is Bloomberg's Tom McKenzie, who's there with a guest. Tom.
Danny Berger, thank you very much indeed. Yes, very pleased to say I'm joined by Martin Sorrell, of course, the founder of WPP, built that into the world's largest advertising company, now the founder and executive chairman of S4 Capital. And Sir Martin, thank you for joining us on set here in Lisbon. We just heard from Cathie Wood saying she thinks the advertising subscription model that may be being pursued by Elon Musk is a good one. She also told me in the interview that the route that you've seen in terms of advertising sales falling, particularly for the likes of Meta and Alphabet and Amazon. Where are we in the downturn on ad spend?
I know you like to sensationalize everything, Tom, but it's not a rout, right? Okay, if we looked at Google, Q3, actually, constant currency up 11%. There'd be a lot of people that would die for that. Amazon actually up a third from about 31 billion last year, projecting about 40 billion in ad revenues this year. Meta is the issue. I mean, the big factors in the digital marketplace, about 450 billion last year, probably 500 billion this year. Google, 205 last year, 225 this year. Meta, stable at 115. That's where the issues are. Amazon going from 30 to 40. And of course, TikTok is the big grower, along with, people forget, Apple is growing its ad platform to probably about 7 billion this year, and Microsoft around 10. And if Microsoft takes out Activision, which looks as though it probably will happen, that will make it an even bigger force in advertising. So you have to be a little bit more nuanced, I think. If one looks at sort of things like Snap and Twitter, they're not exactly rounding errors, but each of those two platforms, about 1% of global digital media. If you assume that all their revenues were US, it would be 2%. So these are not really guidelines to what's happening in the marketplace. The key platforms, the key ones, are Alphabet, Meta, and Amazon, and TikTok. Those are the four key ones.
I know you were watching the Fed and Jay Powell very closely yesterday.
I was watching in New York, yes.
Of course, we're going another 75 basis points. The market ended up selling off on the back of the commentary from Jay Powell. Of course, the view is that you get into a recessionary environment in the US from a number of economists as a result of this hiking. We've got the BOE later today. Get into that recessionary environment. What does that mean for the ad spend going forward as we look at the quarters ahead?
It's very difficult to forecast this thing, and you shouldn't really forecast, but I'll go ahead and forecast. I think that the rates of inflation are going to end up higher than we think, so higher than 2%. I don't think we'll be able to pull it back to that. And interest rates will be lower than we think. The terminal rates will end up being lower, because I think that people will start to get worried about the impact. The Fed has a dual mandate. It's not only about controlling inflation, it's about unemployment, same for the Bank of England. So I think there'll be more balance. It'll be a bit more nuanced in time. But look, the honest answer is that the rates of growth of digital advertising have slowed, but they are still strong. When I look at 2023, and we're starting our planning and budgeting process for next year, one thing is for sure, digital this year is about probably 60-65% of client budgets. Next year, it's going to be 65 to 70, and by 2025, it's going to be 75%. Linear TV and linear and analog media are going to be under pressure. That's where the pressure is going to be in network TV, in traditional outdoor, in traditional radio, in traditional newspapers and magazines. Digital is going to continue to prosper. And the reason is clients are going to be looking for a performance next year. The pressure from a CEO or a CFO on the CMO is going to be, let's look for volume and look for growth. And that means performance, activation, measurement, media mix modeling are all, we're down the funnel at S4, and Media Monk's our operating brand. That plays to our strengths because we're more about results, and that's going to be really important next year.
You touched on Twitter. What are your clients saying about concerns around wait and see? And it's about content, it's about reactivating some of those accounts, it's about controversy, moderation.
And it's not clear yet from Elon Musk where he is on that. And he's announced the Moderation Council. not dissimilar to what we saw with Meta or Facebook. The question is, how is that going to operate? I mean, there's an inconsistency already, even in the first week. He has to be really clear on what he's going to do on moderating content. You know, will President Trump be allowed back? When President Trump was taken off the Twitter platform, actually users went up by about 21%. So we have to see, clients don't want conflict, they don't want controversy, they want a sort of stable environment. And what we've seen in the last week or so is too much inconsistency. He has to lay out the point. Twitter has not been historically very flexible in dealing with advertisers. They redline when we come down to contractual provisions, they're very, very inflexible. They have to be much more flexible in how they negotiate with advertisers. They've got to listen more, and they've got to lay out a discrete policy around moderation. That's the key issue. Both Facebook, Meta, and Alphabet and Google have been investing very heavily in moderating content, and that's a big issue that has to be settled.
Okay, I want to bring you back to S4 Capital.
Right.
GLG Group coming out publicly with a short position on S4 Capital. But presumably you disagree with it. What would your message be to GLG?
0.5%. I don't think it was. We talk to GLG all the time. They know what our messages are. They know what our top line growth is. They know what our objectives are for this year and indeed for next year. So first half of the year, top line was up by 28%. We'll be announcing our third quarter results on November the 14th, and we've indicated July and August continued. The interesting thing about our business is, it is governed to some extent by the growth of the platforms, but it continues to be very strong. So wait for November the 14th,
very briefly,
and GLG and others will see.
Very briefly on UK politics. Are you reassured now under the leadership of Rishi Sunak?
We have an adult in the room, thank goodness, at last. And I think Rishi Sunak has the capabilities and qualities that are needed at this particular point in time for the UK economy. But we face huge challenges, as does the whole of Europe. We face three big issues globally: US and China, divergence; Russia, what happens as a result of the war and after, if there is an after; and lastly, Iran. Those are the three big challenges, and the world is a very fragmented place. The last 50 years, didn't matter where you were, as long as the demographics suited, wherever you planted your flag, you succeeded. It's going to be a much more fractured and fragmented world, both geographically and functionally. So North and South America, to me, big opportunities, despite the leftward shift in South America. Middle East, energy prices are going to continue to be strong, so the Middle East offers lots of opportunities. Africa is very volatile. Europe, very difficult. UK, France, Germany, Italy, Spain all face big challenges, both in the short, medium, and long term. And then Asia, with the caveat around China. Most of our clients who have big positions in China are worried about what the implications of Taiwanese policy will be for security and growth. So countries such as India, Vietnam, which grew last year, I think, by 13.5% GDP, Indonesia, Malaysia, the Philippines, these are all areas of the world that will become increasingly important. So lots of opportunity, but in a very fragmented way. And then functionally, we talked about digital. We're a purely digital business. Our growth rates continue to be extremely strong. That will continue to be the case.
So Martin Sorrell, traveling the world, always fascinating, always entertaining. Thank you very much indeed. Founder and Executive Chairman of S4 Capital. Danny.
Tom, thank you so much. Fantastic conversation. Tom McKenzie there at the Web Summit in Lisbon. I want to give you a quick look at where we are in this market, specifically looking at FX here. The dollar's strength taking off, continuing yet another day after Fed Chair Jerome Powell shifting the focus to that higher terminal rate. It is sterling that's getting hit very hard from this narrative, down more than 1%. Euro is also down 0.5%. But the fall in sterling right now at 112 comes just before a BOE rate decision that's set to hit at noon. Of course, a weaker currency absolutely complicates the issue for the BOE. The Fed continues to hike. Do other central banks need to match that pace? Coming up on the program, Elon Musk is said to be planning to eliminate half of the jobs at Twitter. More on the social network next. This is Bloomberg.
Airport, and behind me you can see SpiceJet 737 MAX aircraft. Earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. There's a big celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Everything you need to get set for the start of U.S. trading. Bloomberg The Open with Jonathan Farrow. Drilling down on the numbers and preparing you as only Bloomberg can. Weekdays on Bloomberg.
A report from Reuters this morning says that Morgan Stanley is planning to begin global job cuts in the next few weeks. Sorry, I keep trying to say it the British way. Anyway, Elon Musk is also said to be planning to eliminate about 3,700 jobs at Twitter. That's about half of the social media company's workforce. So we are currently dealing with this world where we are looking at more job cuts. It was just confined to tech. We'd heard the Metas of the world looking at pulling back, freezing hiring, and now it's clear that it's happening at banks as well. If Morgan Stanley, again, according to this latest report, is also looking at pulling back support too. Now, all of this comes amid some concerns about jobs. We have had a very strong jobs market, and perhaps that accounts for some of the hawkishness coming from Powell yesterday. What that hawkishness has met is continued strength in the dollar. It's something that is just really hitting sterling extremely hard this morning, down 1 1/10%. We're also getting some lines from the ECB. Nagel talking at an event saying that QT should be done smoothly, and talking about not replacing maturing assets is one way for them to do it. So that would be a passive QT, if you will, not active, such as the BOE is doing at this moment. Also saying they're very happy with the 2% inflation target. But of course, it's a world that now needs to cope with a higher terminal rate for the Fed. That's it for European Market Open. Surveillance is up next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
I think to be successful in a role like this, it is not only technical knowledge. It is about passion.
They have to love Oreos, right?
They do.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
We have to be open to the idea that the Fed may end up significantly higher.
I think we are likely to see rates somewhere between 5 and 6% before this is over, and maybe even higher.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
The Fed does not want to see a replay of what we saw in July. It does not want to see premature financial condition easing on the signs of any Fed pivot.
It's not just up and then back down. The Fed's going to keep that peak in interest rates for quite some time until they actually see improvement in the underlying inflation outlook.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 9 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. A warning from Fed Chair Jerome Powell. Interest rates will go higher than originally expected, but the central bank may start slowing the rate of increase next month. Now it's the Bank of England's turn. In just a couple of hours, it's likely to deliver its biggest rate hike in more than 3 decades. And big job cuts on the way at Twitter. New owner Elon Musk plans to eliminate half of the social media company's workforce. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Chrissy Gupta and Kaylee Lines in New York. Matt Miller is off today. And Kaylee, well, risk assets, they went up, but it was brief, and then they really came down. And we're still dealing with the aftermath of that here in Europe.
Yeah, it wasn't necessarily a hawkish decision, but it was definitely a hawkish press conference, Anna. Jerome Powell making it clear that it's not about the journey, it's about the destination, and the end destination may be a higher terminal rate than we all previously thought. So that definitely weighed on sentiment in the U.S. yesterday. It continued to weigh on sentiment in Asia overnight. The MSCI Asia Pacific Index as a whole down more than 1.5%. In addition to just the Fed overhang, there was also a bit of cold water thrown on the rally and the idea that COVID zero policy may be on its way out in China. China's top health body reiterating its commitment to COVID zero policy. So that whole reopening thing may not be happening anytime soon. As a result, a basket of Chinese reopening stocks was underperforming, down about 3% in the overnight session. Then in the bond market, no surprise given the hawkish commentary out of the Federal Reserve. We saw Treasury yields moving higher yesterday, and we've really seen global yields follow suit. We saw a follow-on move in Australia and New Zealand. The 3-year Australian yield and 10-year New Zealand yield each up more than 11 basis points in the overnight session, Creedy.
Yeah, Kaylee, stateside, we are seeing, well, futures, they're slightly in the red. You do have that negative bias, a little bit of pressure on risk sentiment, but take a look at this. They're actually flat at the moment. What's interesting to me, though, is after you have the sell-off of almost 2% on the major benchmarks, well, it's kind of natural. There are some technicals that help you kind of bounce back when you have that much of a sell-off. I wonder if that's what we're going to see today. For now, at least, futures, like I said, about flat, not really taking its cue. It looks like they're still kind of maybe pulling back and forth a little bit. The bond market, a completely different story, because that's really where you're seeing money come out very quickly across the curve. By the way, the maturities don't matter here. Take a look at the 10-year yield. We are at not just above 4%, we are at 4.14, 414 basis points on the 10-year yield, up about 4 basis points just in today's session. But look, take a look across the curve. You look into the front end of the curve, the 2-year yield, for example, that move gets more fast and more furious. And as you see that move, especially in the front end, the dollar follows. The dollar is stronger by about 0.5% when you look at the Bloomberg Dollar Index. And traditionally, that would mean that you perhaps see a little bit more pressure on equities. You're not necessarily seeing that, but you are seeing some pressure in the crude space. Remember, NYMEX crude trading at an 88 handle, down about 1.5%, Anna.
Okay, so those are the moves stateside. Let's have a look at where we are in Europe then, Chrissy, and we have the European equity markets still feeling the after effects, the downdraft of what we saw on Wall Street yesterday. So stocks were severely weaker on Wall Street at the close, and so we factor some of that into our European session today. And it is tech stocks, just as we saw weakness in tech stocks on the NASDAQ yesterday on Wall Street, tech stocks to the fore, and tech stocks are weaker today. Some areas of the banking sector, though, doing a little better as we continue to talk about higher rates for longer. We've got some news here in Europe when it comes to the interest rate hiking cycle. The Norges Bank over in Norway raising benchmark interest rates to 2.5%. The estimate was for 2.75%, though, so that's actually not a hike as big as had been anticipated. And the Norges Bank also saying that they will most likely have to raise again in the month of December. The market taking then a fairly dovish interpretation here. Certainly we saw in the immediate aftermath of this decision some weakness in the Norwegian kroner, and that's what we continue to see there on that chart against the euro, also true against the US dollar. So that's the Norwegian story, not then hiking as much as had been anticipated. Will we get something similar from the Bank of England? We'll have to see. The pound certainly on the move ahead of that meeting. Here's the weakness in tech stocks I was talking about, down by 1.8% here in Europe. Here's the weakness in the pound, 112.60, dropping by over 1%. A lot of dollar strength to deal with, and so this is really a dollar strength post-Fed story, but it is having an impact here on the pound. And what will be the impact if we see 75 basis points from the Bank of England later, as expected? What if they only do 50? How weak would the pound get then? Sainsbury's, the grocery store here in the UK, up by 3.4%. And this is an interesting theme developing from those businesses that you might have expected to be really affected by the cost of living here in the UK. We are seeing if they manage to stick to guidance, that is actually at the margin being taken as a positive. We saw it yesterday with Next. We see it today in the case of Sainsbury's. And Rolls-Royce down by 3.5%. Some concern around inventory levels, even as we all go back to flying. This is the engine maker, of course. Some concern around inventory levels and some other issues plaguing this particular business right now. Kaylee.
All right, Anna, well, let's get back to the Federal Reserve because, as we all expected, they hiked 75 basis points yesterday. But the message from Chairman Powell was, buckle up, we aren't done yet.
We still have some ways to go. And incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected.
Bloomberg Markets editor Valerie Teitel is joining us now for more. So, Valerie, no doubt about it, Powell had his hawk out yesterday. So why did the stock market initially rally higher after the statement and then he slapped that down?
Yeah, we spent a gut-wrenching 30 minutes thinking that Brainerd might have made some friends. There was an addition to the FOMC statement, and this one line really jumped out at us. The cumulative tightening of monetary policy will be taken into account when they analyze their hiking pace. Now, we spent 30 minutes thinking that this Brainerd pause, maybe she's made some friends on the council, maybe this is the new norm for the Fed, talking about the risks of hiking too rapidly and a need for pause due to the lags at which monetary policy affects the economic activity of the U.S. But look, make no doubt, Powell came out swinging in his press conference, and he made 4 clear hawkish signals. We have some way to go before we're getting sufficiently restricted. The terminal rate higher than previously expected. This one really hit the equity market and made it turn an about face. And then again, he's reiterating it's premature to talk about the pause. So thinking that this Brainerd pause might have gotten some friends on the council, well, that was a bit dismissed then. And then again, he reiterated over and over again that their preference is to over-tighten. They see the risks of under-tightening higher than over-tightening, and that sure shook the market. The one thing that we're now seeing is that the terminal rate is ratcheting higher. We hit a benchmark of 5% 2 weeks ago, but now you can see that it's not just 5% peak, but we're pricing in now a 5% yield out entire across the 2023 euro-dollar curve. Now, this ratcheting higher of the terminal rate, that is going to keep the dollar strong. And we know that this is only going to ratchet higher than 5. Maybe we'll get to 5.25, maybe 5.5 after the NFP print on Friday. If that comes in strong, the expectations of Fed hiking and especially the terminal rate next year is going to ratchet higher, keeping pressure on the dollar.
Okay, yeah, absolutely. That upward pressure clear to see this morning. Valerie, thank you very much. Valerie Teitel with the latest on the market's response to the Fed. Up next is the Bank of England, of course, which is expected to deliver its biggest increase in interest rates in 33 years today. A 75 basis point hike is almost fully priced in by money markets. Bloomberg's Lizzie Burden joins us now with a preview of what we can expect. Lizzie, good morning to you. So a lot has changed, of course, since the last time we heard from the Bank of England. What do we expect?
A lot's changed. What an understatement. We've got a new Prime Minister, a new Chancellor. Trustonomics has been ripped up. It means the Bank of England's got less to do in the inflation-fighting mission. There was a point when markets were pricing 200 basis points of hikes between meetings, an intra-meeting move, and today. Not so anymore. Now markets see almost 75 basis points. That's what economists expect. We did see the Bank of England riding to the rescue of the pension funds with the emergency intervention. The drama's over, it seems. 75, though, still quite big. That's because we've got double-digit inflation, labour market tightness, but it's likely to be surrounded by hawkish hints in the presser, in the minutes. In the forecast, we're likely to see inflation coming down. Why? Because of the impact of higher mortgages, the impact to sentiment of all this turmoil, and also, of course, because we've got that fiscal statement coming up on November the 17th. The more tightening the Treasury will do, the less the Bank of England needs to do.
Lizzie, the BOE started active gilt sales this week. Could we hear more about quantitative tightening at the long end of the curve?
I mean, active gilt sales have started this week and it's gone pretty well for the Bank of England. I can't see them wanting to rock the boat at this stage. Economists I speak to say that they're not expecting more details about how they're going to deal with the long end today. But that's also partly because the governor's going to want to make interest rates the active tool. That was part of the mission. So perhaps we will, but I'd be surprised.
All right, Bloomberg's Lizzie Burden, looking forward to your coverage throughout the day on the BOE. Thank you so much. Now let's turn to corporate news. Bloomberg has learned that Elon Musk plans to eliminate about 3,700 jobs at Twitter, or about half of the current workforce. This coming as Kathy Wood of ARK Invest says she's turning bullish on the company, speaking exclusively with Bloomberg's Tom McKenzie at the Web Summit in Lisbon.
This subscription advertising model is a very smart move if he goes in that direction. The verification, that little check, is very important to people and could help clean up the platform considerably.
So let's get to who she was speaking with, Tom McKenzie at the Web Summit. So Tom, obviously a lot of Twitter employees may not be feeling so good today as they await job cuts, but Kathy Wood seems to be feeling good about this. What does she see for Twitter under this new leadership?
Yeah, this is one fan of Twitter, and of course she's divisive in her views. She's though treated like something of a celebrity superstar here at Web Summit, but her views on Twitter arguably have changed because at the beginning of this year her funds were actually selling off Twitter. Now she revealed to us in this exclusive interview that in fact via a public-private fund she has a small position in Twitter under Elon Musk, about $1 million. So she said she wants to expand that. To your question about what she sees in this company under Musk, she said, look, you could get to a point, and she drew on his experience at PayPal, where this becomes a super app with banking services, with finance services built into it. And that is where she sees the optimism. She talked about the fact that she supports him in terms of that subscription model, $8. Again, that's proven controversial. Interestingly, we're also talking to Sir Martin Sorrell, previously, of course, the founder of WPP, the world's biggest advertising agency. He said content and standards is still key for advertisers on Twitter. They want more certainty on that front. But for now, what we're hearing from Kathy Wood is she's supportive of Musk's plans.
Well, Kathy wasn't the only high-profile guest you spoke to yesterday. The First Lady of Ukraine was there as well. Tom, what was she doing headlining a tech summit?
Yeah, interesting. Surrounded by armed security, very tight security for very obvious reasons. What she was trying to get across to the Web Summit here was her message that she wants the tech community, investors, innovators, entrepreneurs to be involved in Ukraine in a positive way. She said, it's time now for you to take sides. We have some sound from her. Take a listen to our interview then with the First Lady of Ukraine.
Technology is a powerful force. You just have to decide whose side you're on, because the technology can destroy and murder, but also technology can be a saving grace for the children who need new limbs, for example, and also for the medical supplies, for energy, for the communities. So that's the key message I've got. It's time for it's a very powerful force. You just have to decide which side you're on.
I also asked the First Lady of Ukraine about the infrastructure attacks that we've been seeing by Russia in cities like Kiev on things like energy, electricity, water. She said this is not impacting the morale. The morale of the Ukrainian people remains strong. She did, though, say that she is concerned about signs of Ukraine fatigue setting in amongst that country's allies, and said that if that becomes entrenched, Ukraine risks perishing, and that, of course, would have significant implications for the world as well. So she's concerned about what she's seeing here in the West in terms of that support and whether that's going to continue for her country.
All right, really important conversation. Bloomberg's Tom McKenzie at the Web Summit in Lisbon. Thank you so much. And don't miss Tom's interview later this hour with Mick Mulvaney, former acting chief of staff for President Donald Trump, who also will be at the summit. All right, well, let's get back to the equity markets and take a look at some stocks moving in pre-market trading here in the U.S. We mentioned earlier the cold water thrown on the whole China reopening speculation after the top health body said they are still committed to COVID zero policy. So as a result, the U.S. listings of big Chinese companies are under pressure in early hours. Alibaba, JD.com, Baidu, each down in the ballpark of 1.5% to 2.7% in the case of JD. Another big mover to the downside is Qualcomm, the biggest maker of smartphone processors. It gave a much weaker than expected revenue forecast. It's getting the hit from COVID zero policy in China, but also just the broader economic slowdown that is weighing on the smartphone market. So as a result, it is down nearly 7%, and it is an even bigger move for another company. Roku, the streaming company, also gave a weak forecast. It is feeling the hit as well from a slowdown in advertising spending. We have heard this from so many companies in recent weeks, but it is taking a big hit as a result, down about 19% before the bell, Anna.
Advertising under pressure, tech under pressure, some of those themes we revisit as we see more hawkishness from the Fed. Coming up on the programme, we'll get a preview of the Bank of England and what to expect. Liz Martins joins us, senior UK economist at HSBC. Will we get 75 basis points? What kind of dovish language will be accompanied with that? We'll also speak to Danielle DiMartino-Booth, a former advisor at the Dallas Fed, who's now CEO and chief strategist at Quill Intelligence. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. And the place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
We think that's the next secular shift.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off today. Of course, we're on the heels of the Federal Reserve. We, of course, have the Bank of England decision in just a couple of hours. For our radio audience, stick with me, but for our TV audience, I want to show a chart of what the markets are actually pricing. This is going to be potentially the largest hike for the Bank of England, I believe 33 years. What's important to know, though, is that this might not be the end-all, be-all. There might still be a long way to go. This is a chart here that shows the Bank of England's benchmark rate about 2.25%. 2.25%. The UK CPI, which has really skyrocketed. We know the cost of living crisis has really accelerated and I want to say been magnified in the UK to some extent. The most recent fiscal policy is not really helping that case either. What's being priced into the markets, though, is still 250 basis points of tightening still left for the Bank of England. And that is going to be a crucial question of whether or not they can deliver that in a way that perhaps kind of harms as little as possible to the economy and to, of course, the working people. Let's get a little bit more perspective here. Joining us now is Elizabeth Martins, HSBC senior UK economist. Thank you, as always, for joining us. I want to start with the question of credibility here. The Bank of England has been whipsawed quite a bit. It's been pulled in a bunch of directions. How credible right now is the Bank of England's thinking?
Well, I think the Bank of England's been criticised because it's moved in smaller magnitudes than other central banks. So around the world, we've seen central banks raising by 50, 75, 100 basis points, and the BOE has been much more steady as you go. So it has been slower, even though it started first. There's some credibility issues around the fact that it continued doing QE all through 2021, although, again, so did other central banks. So I think, you know, there is that criticism of it. But as to whether that was right or wrong, I mean, time will tell on that. The Bank of England's been very concerned about the impact of tightening on the economy. And I think, you know, the slowing growth numbers, the surveys, you know, suggest that it was right to have those concerns. So I think that's kind of the jury is still out, really.
Okay, so the path has been different, but as you say, they did start earlier. There does seem to be some thinking from various places, and I think you share this view, Liz, that perhaps the Bank of England thinks the market is pricing in too much hiking at the moment. And I think we've actually heard that from one or two bank officials already.
We have, yeah, from two bank officials. One was Ben Broadbent, who's usually very tight-lipped about what he thinks about where rates are going. And one was Catherine Mann, who usually is on the hawkish side, usually encouraging people to expect more rate rises. So both of them have attempted to bring the market down. But of course, we've been on a complete roller coaster in the UK, haven't we? We had the so-called mini budget on the 23rd of September, sent rates soaring up to the sky, and they've come right back down as all that fiscal tightening has come out of the price. So, I mean, it's no wonder everyone's a bit confused about this.
Yeah, absolutely. So there were expectations, as you say, for sort of 2% hikes at one point. That's, of course, unwound. Now we expect 75 basis points today. In terms of the path forward from here, are you going to be watching the split of the votes on the MPC for clues as to whether there is going to be a move towards a more dovish consensus?
Absolutely. The split on the vote is always very interesting. Who's pushing for more? Who's pushing for less? And last time we had a three-way split. We had people who wanted more than the 50 basis points we got, and we had one member who wanted less. So the more people that want more, you know, that tells us something about what's going to happen. Actually, I think the risks in this meeting are that the bank will want to, similar to those comments, bring down expectations a little bit, point towards a slower pace of tightening. We've seen that everywhere, actually. We've seen the Fed pointing to a slowdown in the pace of tightening, the ECB perhaps moderating expectations as well. And I think the Bank of England will be in the same boat. So perhaps more votes for smaller hikes than 75.
So there's the pace, then there's the ultimate destination, which is the message that Chairman Powell was trying to give yesterday, that ultimately the terminal rate could be higher. And when he was asked why the thinking changed, she basically said, because inflation isn't going down in the way we thought it would. It is proving very difficult to rein in. What degree of success do you think the Bank of England is going to have in reining in demand and by extension cooling prices?
Well, I mean, I think it's a combination of Bank of England tightening and also the cost of living squeeze, which is reining in demand already. We can start to see that in the surveys. I think we probably are already in the start of a recession. The problem is, does that bring up unemployment and bring down wage pressures, which is the piece of the puzzle that's really concerning the BOE? Other parts of inflation actually look a lot better in terms of goods price inflation, commodity prices, shipping costs, that kind of stuff. That's all moving in the right direction. But what the bank's worried about is that core side, wage pressures, and that's much harder. And I think the worry is, in terms of, you know, those imbalances in the labour market, it will take some time for those to play out. So companies have had such a hard time in the UK getting the staff that they need in the last kind of couple of years, and they'll be reluctant to let people go. So I think, you know, wage pressures, and particularly in this inflation climate where people can say, you know, my food bill's up 14.5%, you know, people will be demanding higher pay, and that's the bit where I think it will be tough.
Well, I'm glad you outlined some of those struggles, because this is coming as well as the currency continues to weaken and weaken and weaken. Quickly, as a final question, let's talk about purchasing power here. How much is that going to eat into consumer sentiment in the UK?
Well, consumer sentiment, I mean, is already rock bottom. If you look at the GfK Consumer Confidence Index, it's telling us that we've never been so depressed here in the UK, not in the pandemic, not in the global financial crisis, not even in the winter of discontent. So people know that things are quite bad. I don't think that's matched in the spending numbers yet. If you look at the restaurant data, you know, those still show that people are still out and about, going out and enjoying themselves. I think as we move into next year, unfortunately, you know, inflation will still be with us, higher mortgage costs will be with us, higher rental costs, and now higher interest rates as well. And I think that probably does, you know, continue to weigh on sentiment, and perhaps more than the sentiment in the surveys start to be matched in the actual spending data.
All right, Liz Martins, HSBC Senior UK Economist, thank you so much for joining us. And don't miss our interview with Andrew Bailey himself, the Governor of the Bank of England. That's at 12 p.m. Eastern, 4 p.m. in London. Now, keeping you up to date with other news from around the world, here's the first word. In China, the National Health Commission says the zero-tolerance approach remains the strategy to fighting COVID. That comes after unverified social media posts boosted hopes that the policy would be eased. On Wednesday, China reported the most new COVID cases in more than 2 months. The U.S. has condemned what it said was the test launch of an intercontinental ballistic missile by North Korea. The launch came a day after Kim Jong-un's regime fired off at least 23 missiles. The State Department urged North Korea to stop the launches and return to talks over its nuclear weapons program. In Brazil, President Jair Bolsonaro called on his protesting supporters to dismantle hundreds of roadblocks. He said they harm the economy and aren't a legitimate form of demonstrating. Supporters of Bolsonaro also refused to accept his defeat in Sunday's election and have taken to the streets across Brazil. And President Biden asked voters to consider the future of democracy when they vote in next week's midterm elections. In a speech not far from the Capitol, the president urged Americans to reject what he called Donald Trump's big lie, denying his election defeat in 2020. Democrats are trying to stave off the potential loss of their majorities in Congress. So it's just a reminder, Anna, that as we contend with all of these different monetary policy decisions and economic data points, there's political risk to consider as well, with the midterms coming up quickly here in the U.S. next Tuesday.
Yeah, absolutely. We've started those conversations with some of our guests, haven't we, about what the midterms might mean for investors. We'll continue to do so as we move towards next week. Danielle DiMartino Booth joins us next, a former advisor at the Dallas Fed, who now is the CEO and chief strategist at Quill Intelligence. Lots to talk about in the aftermath of that press conference by the Federal Reserve yesterday. What did she make of the move away from focusing on immediate rates to the terminal rate? We'll get into that conversation shortly. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund just typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck. dress the right part, don't wear a tie? What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Digital Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. A warning from Fed Chair Jerome Powell. Interest rates will go higher than it originally expected, but the central bank may start slowing the rate of increase next month. Now it's the Bank of England's turn. In just a couple of hours, it's likely to deliver its biggest rate hike in more than 3 decades. And big job cuts on the way at Twitter. New owner Elon Musk plans to eliminate half of the social media company's workforce. I'm Anna Edwards in London with Kaylee Lyons and Chrissy Gupta in New York. Matt Miller is off today. And Chrissy, one of the big focus, of course, coming out of the Fed press conference yesterday is a renewed focus on the terminal rate. And we've seen analysts slowly revisiting where they think interest rates are going to get to. And there's been a suggestion from, I know, a number of our colleagues on the Markets Live blog that reassessment is something that could drive markets for a few days.
Well, it could, and it likely will. Remember, one of the bull cases that was forming for the equity market was this idea that the terminal rate, or at least the expectations of it, kind of hovering around 5%, was stalling out. In the absence of that, you're going to see a little bit of pressure on the stock market. The stock market sell-off that a lot of people said is probably overdue to kind of turn around. Nevertheless, today you have the S&P futures down about 0.1%. What's interesting, though, is this follows, of course, an almost 2% sell-off in the S&P 500. This is important because now you start to see futures kind of fighting against these technical factors. That what it wants to do is bounce. When you have that big of a sell-off, you bounce the next day. Today, not so much. You can really see that sentiment is still weighing as the market kind of reprices what the future is going to look like if the terminal rate isn't actually at 5% the way the market was expecting. But it's not just the stock market, it's the bond market as well, and that's where you're seeing the bigger moves. Take a look at this, 417 on the 10-year yield, a move of almost 7 basis points that are already higher. And as you see those yields rise across the curve, by the way, a bond sell-off really underway here, the dollar follows. And you have that Bloomberg Dollar Index strengthening by about 0.6%. And we can't, of course, leave the commodity complex behind because a lot of those fiscal policies that we're worried about directly affect the likes of NYMEX crude, trading around with an 88 handle, down about 1.6%, Kaylee.
All right, Creedy, well, there's also a lot of micro stories to pay attention to, and I'll start with one of the more positive ones, and that is Etsy reporting after the bell yesterday. Revenue that topped expectations for the period just reported. The forecast also came in line, and analysts say that's really positive against a pretty weak macro backdrop. As a result, it is up about 10% before the bell, but it is not a positive story for Roku, the streaming company, delivering a weak forecast, suffering from the slowdown in ad spending, so it's down about 19%. Qualcomm, the biggest maker of smartphone processors, is down about 7% as well on a weak forecast. It is getting hit by not just weaker macro backdrop, but also the COVID-0 policy in China. And on that note, we have COVID-0 policy persisting in China. China's top health authority doubling down on that, despite the rumors over the last several days that it may be eased. And of course, that had led to a market rally. Now that is reversing some today for some of those big Chinese stocks, including those here listed here in the U.S., including JD.com, down about 3% before the bell, Anna.
Yeah, we seem to have moved on, haven't we, from that Chinese excitement that lasted a couple of days, Kaylee. This is what we see in Europe right now. The Stocks Europe 600 really responding to yesterday's trade on Wall Street, down by 0.8%. Technology stocks certainly to the fore. They're feeling a lot of the pressure, down by 1.7%, as, of course, higher interest rates becomes a slightly more global expectation on the back of what the Fed had to say, and that takes the edge out of some of those tech stocks. This is the euro gaining against the Norwegian kroner. The Norwegian kroner then losing ground as we saw the central bank there, the Norges Bank, actually continue hiking, but hiking by less than had been anticipated. And what is interesting about that is if this were yesterday, if this were ahead of the Fed, we'd be asking questions about whether this was going to tell us something about what was to come from the Fed. It wouldn't have been the right question to ask, but I'm sure we would have asked it anyway. This is the pound, then 1.1% lower, 1.2% lower this morning. The pound in retreat, but really this is part of a strong dollar story, again in the aftermath of the Fed. We had some data out on the UK this morning. UK October Services PMI coming in at 48.8. The prelim number there was 47.7, so it's better than the prelim, but it's still well below 50 in terms of the performance of the services sector in the UK. That suggests, Kaylee, it is in contraction.
All right, Anna, well, let's get back to the conversation around the Federal Reserve. Joining us now is Danielle DiMartino-Booth, a former advisor at the Dallas Fed, who is now the CEO and chief strategist at Quill Intelligence. So, Danielle, we all know it was not actually about the decision or the statement yesterday. It was about Chairman Powell and what he said at that podium over the course of the press conference. How would you rate his performance?
I think it was actually the best of his entire career. And his first press conference in 2018 was like 37 minutes. And I'm like, wow, this guy's not messing around. This blew that out of the water. He really was resolute. He was showing that he had full veto power. He basically dismissed the academics. He actually said the economists with reference to lag. And it felt like a me against them thing. It was for somebody who spent 9 years inside the Fed, I've never seen anything that extraordinary for him to literally abandon an entire Federal Open Market Committee.
Well, and essentially, if you distill his message, it was that, okay, we may dial back the size of hikes, but ultimately we're going a lot higher than you thought. What do you think that height is? How have you reassessed the terminal rate?
So I think something in the 5% range is going to be reasonable and realistic. What was bizarre was there was no summary of economic projections at this meeting, and yet he said that the terminal rate is higher than what it was in September. It was as if he was a one-man dot plot at the podium. So, and he brushed off the idea of the risk of over-tightening. Don't worry about that. I think one thing people have not picked up on, though, is Senator Sherrod Brown had been very critical. Right before the meeting, Powell has to pay attention to the employment mandate as well as the inflation. But during his comments, he said that fighting inflation was key to being able to maintain both of its mandates. Brushed off that criticism, which I don't think that many people picked up on.
Well, you mentioned the part that he kind of also brushed off the risk of over-tightening, and that's going to be a crucial part. What really stuck out to me was the fact that he said, it doesn't matter if we over-tighten because we can always cut after.
We've got those tools.
Right, and that's something that is kind of priced into the market, but I'm wondering, in the face of all this criticism that the Fed has cut too far or cut too long or waited too long and created this kind of a bubble in asset prices, it kind of feels like he was endorsing a technique that has come under such scrutiny. How is he going to follow through on that if they do indeed over-tighten?
He is trying to lay to rest lower for longer by being higher for longer than what anybody expects. And again, mistakenly, one of the reporters at the press conference asked him about the stock market being up, not knowing that the stock market had already turned tail. The minute he said premature, everything just went down. And he was just as resolute in answering.
He smacked that down.
He really, really did. I mean, I've never seen such a great performance out of a Fed chair. And if he was trying to channel his inner Volcker, I mean, he literally said, the body of knowledge and study on lags is, it's 40 years old or so, but it post-dates any era of inflation, so we don't necessarily have to incorporate it into our construct as we might have in a low inflation environment. I'm like, wow, you just dismissed Esther George, who might have dissented had the word lag not been added to the statement.
I'm old enough to remember when transitory was still in the vocabulary, as we all are. Chairman Powell was very confident about a year ago that this inflation would actually pass, of course, rescinding that in hindsight, excuse me. But I think what's important to note here is that I believe as recently as this week, you've started to see cargo rates make a complete U-turn. You've seen wheat and rice prices now back to where they were pre-boost. Is any of this factoring into the Federal Reserve's kind of plan as perhaps a win?
Oh, I certainly think that, I mean, and he mentioned, you know, extensive slowing here and there in the economy. He's recognizing that interest rate sensitive sectors are reacting to Fed policy. I don't think he thinks that they have reacted enough. And in addition to that, some part of me thinks that Powell is actually trying to break the mindset of the Fed put. If you're going to do that, you're going to hide behind the most lagging of all economic indicators. You're going to hide behind the very low unemployment rate, knowing full well that it's lagged, knowing inflation is also lagged. He's a lawyer. He's not a PhD in economics. He can follow real-time data just as well as anybody, and you saw that yesterday. But for now, I think he hides behind the shield of a still too tight labor market and still too high inflation, despite what we've never seen anything this biblical in used car prices or this quick in housing prices. Housing's supposed to filter through to the consumer price index, Fannie Mae says, with a 5-quarter lag. It's barreled through in 2 to 3 quarters, which means at this time next year, we're going to be talking about, oh my gosh, prices are falling.
Okay. Danielle, can I ask you, good morning, by the way, can I ask you about the rest of the world? Because just as he dismissed perhaps the rest of the FOMC, he also dismissed concerns about the pressure that the rest of the world might be feeling from the strength of the dollar. And we see that once again today with a really strong dollar. He basically said that nobody is going to be better off if the US fails to tackle inflation. And that's it. What, end of conversation then about the strength of the dollar and what that does elsewhere?
Yeah, you know, it's kind of fascinating because we have 35 years or so of very cordial coordination between the world's central banks, especially in the post-quantitative easing, post-Bernanke era. And he really has been dismissive of the wrecking ball that the U.S. dollar has been in the rest of the world. You know, I slept with one eye open last night, you know, trying to keep an eye on the yen. And that's where we're back to because of this attitude. It'll be fascinating to see what other people have to say here in the coming days, Fed officials.
Okay, yeah, keeping our eyes on the FX markets then. Danielle, thank you so much. Danielle DiMartino-Booth, CEO and Chief Strategist at Quill Intelligence, joining us there bright and early in New York. Don't miss our interview, thinking of central bank policymakers, don't miss our interview with Andrew Bailey, Governor of the Bank of England. Of course, the BOE's rate decision just a few hours away. And that conversation will be at 12 p.m. Eastern Time, 4 p.m. in London. Coming up next, Mick Mulvaney, former acting Chief of Staff for President Donald Trump. He's on tour. He'll be talking to our colleague Tom McKenzie and to Kaylee shortly. This is Bloomberg.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Ну, вже ж нас це турбує. Нас це просто не турбує, а лякає?
Well, of course we are concerned, but also when we talk about the concern, we can also talk about the fear, and the fear is not just not the fear of the country, it's the fear of what price could somebody pay for your life. That is scary when people choose whether it's worth to, do it or not, and are bargaining for that, for the life as a price.
That was Ukraine's First Lady speaking with Bloomberg's Tom McKenzie yesterday at the Web Summit in Lisbon. She says her nation could perish if the world gives into fatigue with the war sparked by Russia's invasion. Tom McKenzie is back with us now, and he is joined by Mick Mulvaney, the former acting chief of staff for President Donald Trump. Tom, over to you.
Yeah, Kayleigh, thank you very much indeed. Yes, very pleased to say, joined by Mick Mulvaney here on the ground in Lisbon. As you say, Kayleigh, former White House chief of staff, someone who was in the room, of course, with Trump during that administration when that debate was going on about the handover of around $400 million in terms of aid. You gave testimony on this in Congress. We heard there from the First Lady of Ukraine speaking to me saying she is concerned that Ukraine fatigue is now setting in. Is that a legitimate concern, and how is it playing out in the U.S.?
Yeah, I think, morning, Tom, thanks for having me. I think it's a concern. I think the Americans, though, are looking more to Europe than people realize. Our resolve is pretty good. Yes, there's discussions now about whether or not we're giving too much money, whether or not the money is getting where it needs to go. Those are the right conversations to have when you're giving away your own taxpayer money. But one I don't think gets enough attention is the Europeans, not the British. The British have done a pretty good job in terms of ponying up to help the Ukrainians. But the Germans, the French, the Italians, the Spanish have done practically nothing. In fact, you could take almost all of continental Europe together, take out Poland, and Europe has given more than the rest of continental Europe put together. So I think if European resolve starts to waver, then American resolve might follow the same route.
We are starting to see divisions within the Republican Party. They can take the House, of course, and we'll get your views on this. But Kevin McCarthy, if he becomes head of the House, and then Senator Mitch McConnell, they have very different views on how much support to give Ukraine.
They do, but it's a healthy debate. It's should we give American taxpayer money to this country overseas? And there's times that the answer is yes, and times the answer is no. But keep in mind, if you make it us by ourselves, or us with the British alone, and the Europeans who live there, who are next door, who are right under Russia's doorstep, if they aren't stepping up, then the American taxpayer is going to stand back and say, no, why are we doing this? And the people that it impacts every single day don't seem to care. That is something that could change American opinion on public opinion very quickly.
And what is your view? What is your forecast for the midterms?
For the midterms.
For the midterms.
For the midterms. Oh, I think it's a foregone conclusion at this point that the Republicans take the House. The lowest number I've seen would be Kevin McCarthy picks up 15 seats and becomes the Speaker of the House. I've seen projections as high as 32 or 34 seats going to the Republicans. Don't know if it'll be that good. If you want to watch an interesting race, watch the race for governor in New York. I've talked to Lee Zeldin a couple times. He really does have a chance. He's within the margin of error on a couple of polls, and the momentum seems to be going his way. If Lee Zeldin wins in New York, you're talking about a landslide, the likes of which we've not seen since 2010 for the Republicans. So I'd watch that race early on Election Day.
Mr. Mulvaney, it's Kayleigh in New York. On the subject of the midterm elections, we heard from President Biden yesterday talking about election deniers and a democracy that is under assault. How much damage has been done to American democracy, to the American voting system since the 2020 election? And how could the midterms potentially exacerbate that if we do have candidates refusing to accept the results of their races?
Yeah, look, listen, January 6th was a dark time. There's no question about it. I've been a critic of January 6th for the last year at least. But for Biden to come out and use that as his closing argument, I think might give you some insight as to why a lot of folks are now saying it's going to be a red wave. The Democrats continue to avoid the conversations that swing voters, people who don't make up their mind until the last 30 days, which are the folks right now who are going to sort of determine the outcome of this election, want to talk about inflation and crime. The Democrats open to talking about abortion, and they're closing talking about election integrity. Abortion and election integrity are critical. There's no question they're important topics, but it's not what voters want to talk about right now. So here again, I think Democrats have opened to talking about the wrong thing. They're closing talking about the wrong thing, and they may pay a serious price for it next Tuesday night.
Okay, so let's talk about policy then, because obviously it is the economy and inflation that is front and center in voters' mind. We have on the monetary policy side a Federal Reserve that got even more restrictive yesterday. They are tightening policy. What role should fiscal policy and Congress be playing in the face of what ultimately is going to be an economic slowdown?
Yeah, if you're talking about inflation being too much supply and too much money chasing too few goods, the Federal Reserve is really good at destroying demand. It's what they're going to do by raising interest rates. They're already in the process of doing it. The Federal Reserve is not very good at increasing the supply of goods and services. That would be fiscal policy. That would be trade policy. That would be regulatory policy. I don't think you've seen this administration admit that yet. You're seeing re-regulating what Trump had deregulated, and it's making it harder to get goods and services to market. I also think you're going to see a situation where both parties will be willing to spend more money helping people during a recession, which is actually pro-inflationary. You just give them money, people money for not creating anything. For example, if you increase unemployment benefits. So yeah, you're in a circumstance right now where fiscal policy is going to be fighting against monetary policy. Washington, D.C., the elected officials will continue to do things that create pro-inflationary pressures, which could limit the effectiveness the Fed has on controlling inflation.
If the Republicans get the House, as you predict, as the polls suggest, what does that mean for the domestic policy of the Biden administration?
Yeah, I think if historically, look, when we do mixed government, one party holds the White House and the houses of Congress are split, we actually are a little bit more fiscally responsible. There's that balance. When one party's in charge of all, we spend a lot of money. Republicans spend a lot of money on defense, and when Democrats are in charge of everything, they spend a lot of money on welfare transfer payments. So when we get to split government, which is where we're going to be effective January of next year, I think you'll see a little bit more rational approach to the spending. It'll still be a tremendous amount of money. I don't think you could foresee a circumstance where the federal deficit is less than $1 trillion next year. I'd like to think that I'm wrong, but I just don't see it regardless of the outcome of the election. So you continue to have fiscal inflationary pressures despite what the Federal Reserve is doing on the monetary policy side.
Okay, we're here at the Web Summit, biggest tech event in Europe, so let's swing back to what's happening on the ground. I know you're involved in crypto, in the crypto space. I don't know if this is a dirty term, but you've been labeled by some as a lobbyist for crypto. When it comes to the regulatory environment in DC, a number of proposals going through on stable coins, on digital assets. How do you see that unfolding? Is it going to be positive for the industry?
It will be. What's happening in the legislature now is really good. There's very few things in Washington, D.C. that are bipartisan. Antipathy towards China is one of them. Antipathy towards big tech is another. But sort of support for DeFi, the decentralized finance, support for blockchain, these emerging technologies that are often driven by small businesses, as much of what this conference is all about, where we're here today in Lisbon. There's an interest in that. Cynthia Lummis has led in the Senate, but she's got Democrat support, at least to examine the topic. So I'm cautiously optimistic that Washington, D.C. is headed in the right direction. Problem is, right now, they're too slow. They're too slow in reacting to the world. I was just talking to the Lithuanian minister. They are ages ahead of us in terms of applying blockchain to government services. So a lot of the smaller countries around the world are doing better than we are. We've not been nearly nimble enough. I also think that regardless of what happens in Washington, the Biden administration is still going to be anti-crypto and anti-blockchain, and that doesn't change for the midterm election.
Okay, so your view that there needs to be some catch-up from the US and regulators there. Mick Mulvaney, thank you very much indeed. Of course, former White House Chief of Staff to former President Donald Trump. Katie, back to you.
All right, and thank you to you, Tom, for joining us with Mr. Mulvaney at that summit in Lisbon. Appreciate your time for both of you. And coming up later today, don't miss Tom's interview with the co-founder of Airbnb. That's coming up in the European Close later on today. This is Bloomberg.
the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window, they have thorns on them.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance Early Edition. I'm Kriti Gupta with Kaylee Lyons in New York and Anna Edwards in London. Matt Miller is off. Let's take a look at what's going on ahead today. G7 foreign ministers meeting in Germany with Russia's invasion of Ukraine sure to be among the biggest topics. Peloton's earnings results are released before the market opens. Of course, all eyes on those shares. And it's the Bank of England's rate decision at 8 a.m. New York time, where it's expected to deliver its biggest interest rate increase in 33 years. Anna, it's going to be fascinating to see if, even with this historic rate decision, you do actually see some movement in the currency space, if pound actually weakens or rises.
Yeah, absolutely. I mean, it's weak already. It's funny, we were having a conversation earlier about whether this is historic. It is the biggest in, 33 years? I don't know. How do you define history these days? But since 1989, we haven't seen a hike of this size, Kriti. But we are seeing the pound much weaker, down by 1.3% right now. And that's before, Kriti, we might potentially get some disappointment from the Bank of England. You don't know. If they didn't hike by 75 basis points, you'd expect the pound would weaken quite substantially.
Yeah, and it's fascinating to see what that does in reverse then to the dollar, Kaylee, and really you start to see the ripple effects once again from the dollar read-through.
Well, the dollar, at least right now, pre-BOE, is strengthening substantially, higher by about 0.6% on the Bloomberg Dollar Index, and you're continuing to see the big moves in the bond market, Anna. The 10-year yield up another almost 9 basis points today after rising yesterday. We're back up at the 4.19 level because the message from the Fed was, even if we get a step down and the hikes are smaller, we're going farther. It is a repricing of the terminal rate that this market has to contend with.
Absolutely, all about the terminal rate. And how long do we remain in that post-Fed trading environment? Is this something that lasts hours? Does it last days? We've got the jobs report tomorrow, of course. Will that tell a similar tightening story, perhaps, if the jobs market remains strong? That is it for Early Edition. Surveillance is up next. This is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and
and you're not a good company. You're just a less toxic company than some of the other oil majors.
Well, the first thing to say is that, you know, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And so I understand that point of view. And I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
It is very premature to be thinking about pausing.
Until we see progress on inflation, the Fed is really focused on getting inflation down.
I think the Fed is just saying, hey, let's be careful and understand we have to get to the destination.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
It does not want to see premature financial condition easing on the signs of any Fed pivot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Equity futures the day after the Fed, lower by 0.2%, and this bond market on the move. Your 2-year TK, 470 this morning.
It's really good to look at that rounded up, John, 4.71%. This is one of the most interesting days in 20 years. This is completely different than the zeitgeist I'm seeing this morning across media, across a lot of Wall Street. This is fascinating, and if Dominic Constant with us here in moments is great. He calls this a super restrictive Fed.
Looking forward to it. What's your number one takeaway from Chairman Powell yesterday?
Number one takeaway was late in the interview, Kyle over at CNBC quietly asked him a question about international ramifications of what he and the Fed is doing, and you see it this morning. The Fed is central banker to the world, including central banker to the United Kingdom.
A number one takeaway from me and many others too, that moment right at the end of the news conference, I think it was the second to last question, Bramo, where that journalist wrongly misled this chairman to believe the market was still rallying, and he just went through the list one by one, as to why maybe this market shouldn't be rallying.
And another way of saying this is perhaps he said the quiet bits out loud, just like Neil Kashkari said it, which is that they do not want to see the market rallying. They do not want to see any kind of loosening in financial conditions. What you're seeing is a higher terminal rate being priced into the market, 5.2% nearly being priced in as soon as April, May of next year, which really highlights the shift in markets.
How difficult is it to be bullish in this market right now, based on what we heard from this Fed chair just yesterday?
Unless you believe that the data is going to really cooperate, that you're going to see some sort of material downshift in inflation that's going to come before early next year, it is hard to be overly bullish, which is the reason why the bears have taken control, and people can blame some of the bearish tilt of this program. But honestly, that is really what basically the Federal Reserve is saying.
I think you can blame everything on Chairman Powell right now.
I think I will.
Some people were happy with Chairman Powell just yesterday. In fact, many people were, Tom, and I imagine that's because they were on the other side of the trade.
Yeah, that may be on the other side of the trade. I can't find words for how sensitive the markets are now. It can be something esoteric like Indonesian rupiah going out to new weakness. Forget about that. It's about the real yield ready to go through a 168 to maybe get out over a 170. You mentioned, John, the elephant in the room, the 2-year yield, 4.71%. But I look at the currency screen, and if I'm Rishi Sunak, the Prime Minister of the United Kingdom, looking at his Bloomberg this morning, I'm saying, what do I do on fiscal?
They want a weaker dollar. They're not getting one just yet.
They're not getting it at all.
They're not getting that at all. For the chairman to turn around and say he still believes the risks of doing too little outweigh the risks of doing too much, that was a rebuttal yesterday in many ways to all that political criticism he's taken over the last couple of weeks.
I agree with that. And I think there's an ex post ex ante thing here going on. And the fact is, as Dom Constant will tell us, is they're going blind to a neutral rate. I really got that from Powell yesterday. Chris Lowe, I think, and others said this was the most interesting press conference in ages.
Equity futures down 0.2% on the S&P. Let's whip through the price action for you. In the equity market, a little softer after a dreadful day of losses yesterday off the back of that news conference. Yields a whole lot higher on a 10-year this morning, up by 8 or 9 basis points, just south of 420. At the front end of the curve, though, to see the 2-year up and away, taking out the highs of the year, up 9 basis points on a 2-year, Tom, 471 this morning.
Again, it's the bond market, and John, it's two things going on here. It's yields moving higher, but also a shift in the curve, negative 52 basis points on the vanilla 2s10 spread. And to see that, John, break down back towards pre-Mizra's negative 60 level would be critical. We're not there yet.
You mentioned that dollar strength, euro dollar this morning, Lisa, 97.55.
And it'll be interesting to see whether the pound actually also loses value on the heels of what may be the biggest rate hike by the Bank of England going back to 1989. At 8 a.m. in about 2 hours' time, we do get that Bank of England rate decision. That 75 basis point rate hike is coming in the face of weakness. And this is really the dilemma so many people are facing. And perhaps the biggest rebuttal that we heard from Fed Chair Jay Powell yesterday was it is essential to kill off inflation for a stable labor market. Our dual mandate is not in conflict. In fact, it is working together over the longer term. How does Governor Andrew Bailey message that same thing at 8:30 a.m. when they are pressured by a weaker pound, when they are pressured by a fiscal policy that is yet to fully be released? Today, we also get U.S. data, including initial jobless claims at 8:30 a.m., U.S. September factory and durable goods orders, and October ISM services data at 10 a.m. Eastern. I am curious about services. I am curious how much they are starting to lose some of the momentum because everyone keeps talking about how inflation is rolling away from the goods into services. How far can that go? And today we do get a slew of earnings. I am curious about the consumer. Hyatt, Peloton, of course, is its own story. Restaurant brands, Under Armour, Carvana, Starbucks, Kellogg's, many, many others. How much do consumers continue to go out and buy? Peloton shares lower ahead of what people expect to be disappointing because people are no longer buying bikes, sticking them in their homes and not going out because that was a pandemic era kind of development. That's what people are basically saying. Carvana has been all over the place, really beaten up. I'm curious about used cars and car valuations in the face of some of the highest rates that we've seen going back to 2009. And Starbucks, how much, John, are people still going out and buying frappes and lattes and everything else, especially as they head back to work? It might be a good kind of reopening trade.
Bramo, thank you. Lisa, thank you very much. Joining us right now is Dominic Constant, the head of macro strategy at Mizuho Americas. Dom, fantastic to catch up with you, sir. What a morning for it. Let's just start with yesterday and that news conference. Number one takeaway for you, Dom, what was it?
Well, the main thing I thought was actually at least they started to introduce the idea that the cumulative effects of monetary tightening to date are going to have to be considered. So there's some sense of neutral and a measure of restrictiveness that's in place and is going to be in place as the forwards are realised. So, I mean, that was the main thing. There's a shift in narrative. I absolutely agree. It's important that they raise the the peak funds rate versus their September dots. But that's been going on for a while anyway. So the main thing for me is a new narrative, if you like.
Dominic, your note yesterday, and folks, you can get it from Mizuho. There's a single classic constant paragraph in there where you say this is faith-based central banking, and they risk a textbook type 2 error, something the laureate Michael Spence talks a lot about. Tell us about the certitude of Fed policy buttressed up against a potential for error.
Well, I mean, the problem is we don't really know where neutral rates are in the sense of producing or being consistent with price stability. You only sort of observe that after the event. So we can look back at historical data, and because we don't even have that much data only going back maybe 20 years, the neutral rate, right now, based on that backward-looking thing, would be around 1%. But we could be in a new regime, in which case neutral rates are higher. So by those old metrics, the Fed is definitely super restrictive, but they may not be restrictive enough if the neutral rate is in fact higher. And understanding why neutral shifts is very important. And there are lots of behavioral things that could be going on there. There are structural things that are going on in demographics and globalization that could be shifting the neutral. So in some sense, the question is, what does a central bank do in this environment? I would just suggest they have to be a bit cautious at some point when they know that on old metrics they're super restrictive. Perhaps they need to sort of just take a pause, recalibrate, wait out a couple of meetings in the course of 2024 before they decide if they need to carry on raising rates. So it would be a kind of a pause that refreshes a tightening cycle, or maybe everything will fall into place and they'll say, phew, we thank goodness we've done enough. And then maybe they've done too much and they have to scurry back the other direction. So that's the issue.
Dominic, we were talking earlier at the beginning of the show. John asked, is there any reason to be bullish right now in equities? Because you've got the Fed chair basically coming out and, in so many words, not being particularly happy at seeing any kind of rally in the face of this inflation and the need for tighter financial conditions. What's your view on that? I mean, where could there be room for bullishness amid an absolute rebuttal of any type of dovish pivot?
Well, it's hard to be bullish on anything, to be honest, either bonds or equities. The issue for equities, I think, really is down to a hard landing or soft landing. If there's a hard landing, you definitely cannot be bullish on equities. They have a good downside in earnings, and we would suggest at least another sort of 10, maybe even 20% downside in price on a sort of hard landing. The other problem you've got is even with a sort of softish landing, the route to a softish landing, as we've always argued, is anyway through margin compression. So it's earnings coming down. It's just that you don't have to have a massive cost reduction on top of it, which would involve really sort of shutting down sort of businesses. So it's very difficult to be bullish. I would just say that you could do a weighted average of soft versus hard landing outcomes. Right now, by the way, we're not really getting any sense of any landing. But you could do a weighted average, and you could say that the fair value perhaps is around 3,600. That's kind of where we've been working to. And if the clouds clear and the soft landing looks like it's sort of taking hold, then you've got upside, up to around 4,000 or so on the S&P. So that's the way I approach it. So yes, difficult to be bullish. But maybe if you're in the soft landing camp, you can sort of use some of this weakness to accumulate, cover some shorts perhaps, and maybe sort of look for some kind of upside down the road.
Certainly difficult to be in that camp right now. Dominic Kostom, thank you, sir, of Mizuho. What a tough moment for those in that camp. Easier to repair the damage of doing too much than doing too little.
Yeah,
was the
this is the asymmetry that we heard twice yesterday.
Do you think it's that asymmetric, though?
Yes, wildly. Justin Wolfers at Michigan was brilliant on this on Twitter, and the Kostom note yesterday was one of the best from Dominic in 20 years. It was brilliant.
How much comfort do you think Democratic senators who are worried about the damage that's going to be done to the labor market?
Zero.
How much comfort can they take?
Zero did they get out of that? Zero. But I tell you, this is an overcome by events screen I'm looking at this morning here. And what Kostom said, that this is so important, John. We go from Stanley Fischer and ultra accommodative to the phrase Kostom coins of super restrictive. Mohamed El-Erian and Bill Dudley, they do not believe this Fed is super restrictive, and Kostom says, be cautious.
Look where the emphasis is, Bramo. The emphasis right now is on the destination. It is no longer on the journey.
Except that right now, as Dominic Kostom just said, we're not seeing any type of landing. So trying to envision the contours of a landing when we're still at 30,000 feet is very difficult.
That news conference was just absolutely amazing.
Oh, it's historic. It was historic.
Of all the press conferences we've covered together, just absolutely incredible.
It was just, and we're talking snoozes. I got this totally wrong. It was not a snooze fest.
Futures down 0.25% this morning. Good morning to you. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Federal Reserve Chair Jerome Powell is making it clear he is prepared to raise interest rates as high as needed to get rid of inflation. At the same time, he says the Fed could go to a slower rate of increase as soon as December. Powell spoke after Fed policymakers raised rates by 75 basis points for the fourth time in a row. Meanwhile, in just under 2 hours from now, the Bank of England is expected to deliver its biggest interest rate increase in 33 years. Economists predict the UK central bank will raise interest rates by 75 basis points in order to cool double-digit inflation. That would bring the base rate to 3%, the highest since 2008 and the biggest single increase since 1989. In China, the National Health Commission says the nation's zero-tolerance approach remains a strategy to fighting COVID. And that comes after unverified social media posts boosted hopes the policy would be erased. On Wednesday, China reported the most new COVID cases in more than 2 months. And big job cuts are on the way at Twitter. Bloomberg's learned that new owner Elon Musk plans to eliminate about half the social media company's workforce. That's about 3,700 jobs. Musk intends to inform the affected staffers on Friday. Meanwhile, remaining Twitter employees will be asked to return to the office. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. A lot's happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
All eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in. We may be seeing a Fed that doesn't have to do a whole lot more.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, tomorrow on Bloomberg Television and Radio.
We still have some ways to go, and incoming data since our last meeting suggests that the ultimate level of interest rates will be higher than previously expected. We have some ground left to cover here, and cover it we will.
Chairman Powell, straight out of the gate in the news conference, doubled down on that statement a couple of times, and this market got really shaken up. Futures this morning, negative on the S&P 500, down 0.5%. A move lower again in the bond market. Yields higher, much, much higher. On a 10-year, up 10 basis points, 420. Similar move at the front end, looking at 470 on a 2-year. And off the back of that, what do you get? You get some dollar strength. You get some euro weakness, 97.44, negative 0.75%. Heard from some ECB speakers this morning, guys, and it's fascinating to listen to what they've got to say. President Lagarde says that we don't believe that recession will be able to tame inflation. I think that's basically the president talking about stagflation risk. And we had another ECB official this morning say this, Tom. It's clear that rates need to go higher, but take a listen to this. In my view, recession in the euro area is a baseline scenario. It's not in the ECB's baseline just yet. This is one official, but so far it's likely to be relatively shallow and brief. Here's an individual, Tom, that wants to hike interest rates and do it even if we get a recession.
I agree. I totally take that point in the punditry. What I'm going to say, John and folks, this is so important. I think this is underreported in the financial media right now. On the commercial break, John, I didn't look at my Bloomberg for 30 seconds, and the market's moved. I mean, you have sterling going down to new weakness now. It's incredible markets. Today, I'm following the 2-10 spread as carefully as I can. Right now in Washington, and this is an important conversation, I've waited over 8 weeks to try to figure out what the suburbs of America are doing in the midterm. We'll be in Washington for you for Tuesday, for Wednesday as well next week. Anne-Marie Horton will greet us, our Bloomberg Washington correspondent. There it is, Anne-Marie. Greg Giroux has been on this at Bloomberg, and Catherine Lucy nails it in the Wall Street Journal. The suburban poll, the Democrats have lost the suburbs. Are you surprised?
I'm not exactly surprised that we're seeing this shift, because the polls prior to this, really going into the fall after the summer, was that the concern for the economy over the things like like abortion were really starting to pick up. But this poll specifically is incredibly important because it's not just the suburbs, Tom, it's suburban white women. And the striking down of Roe v. Wade is something that resonated with them over the summer, but that really started to lose steam. And if you look at this poll, these are the numbers. The top issue, 34%, and this is what is going to get them out to vote. And this is a robust voting group, according to this poll, in terms of how many of these women want to get out and vote. They say rising cost is their #1 issue, and they say it's just costing too much to live, and that is now overtaking any other concerns like abortion.
Well, take it to Philadelphia, the land of a no-hitter, and Anne-Marie, let's be direct here. Oz Fetterman, is that decided in the Philadelphia suburbs as maybe Trump-Biden was?
Potentially. And if you look at this poll as well, Tom, what you can see is that when asked for these suburban women how they feel about how President Donald Trump did as president, it's 50-50 in terms of approve and disapprove, while actually Biden's numbers are trailing in this latest poll. This poll is much worse for the administration and the Democratic Party than the same Wall Street Journal poll they had in August.
What do you make, Anne Marie, of the counter-programming yesterday from President Biden amid the press conference from Fed Chair Jay Powell?
Well, there was a few counter-programmings, right? So the president had an event I was at yesterday, actually, with a number of labor leaders, and it was talking about a talent pipeline. I'm not sure that the Fed's calendar is on the agenda for the White House the same way, say, it's on our agenda when we do our programming. I think the White House also wants to make sure that they say they're independent of the Fed, so why would it matter if the president was speaking at the same time? And yesterday was 6 days. Today it's 5 days to the midterm elections. The president is going to do anything he can every single day to have some event to make sure he's hitting the base.
But to be fair, Anne Marie, the big issue right now is inflation, right? This is one of the top issues, if not the top issue, for so many voters out there who are looking at the economy and looking how much they pay for groceries and for gas and for everything else. So who is President Biden speaking with? Who is he trying to message to at a time when he's definitely creating animosity with the energy companies? He's pointing a finger at the Fed, and some of his own party members are saying that the Fed is acting overly aggressive.
Well, it's a good question because this is something the White House has struggled with. They struggled to nail a message on the economy. And sometimes you just don't know who the messaging is for. Our colleague Nancy has a great report out this morning that really tries to show the circle the president has relied upon and widening that circle when he wants economic advice. Everyone from the CEOs of Apple and Walmart and Target and Brian Moynihan of Bank of America to also his grandchildren's field hockey parents when he spends a lot of his time on the weekends in Delaware. Interesting, one group that he's really not engaging with is the oil industry. And that's difficult to understand when it's gas prices that have really infuriated Americans. And this poll in the Wall Street Journal shows that's one reason why they're going out to vote, suburban women, but also the fact that your chief of staff is waking up every single day at 3:30 in the morning and the first thing he's looking at allegedly is the price of a gallon of gasoline in America. If you're so concerned, why are you not engaging with the industry?
AMH, thank you. Down in DC, Anne-Marie with the latest. And Tom, this is something Will Kennedy and I talked about just yesterday. You've got the war of words between the oil patch and the president right now, but getting lost is effective policy on energy. And I haven't heard enough about that over the last few months.
No, there's a history in America of a lack of effective policy on hydrocarbons. There's no question about that. But I would suggest the gallon of gas is, I mean, I grew up as a gallon of gas is a third rail for America. No question about that. I don't think you get that in the 3 zip codes of Manhattan. But with that said, there's so much more going on here. And the magnitude of the shift of the Wall Street Journal poll, 27%, I've never imagined that. I've never framed it. John, it's unimaginable, that shift. That's got to be topic one for the Democrats on this Thursday morning.
Well, the party in power playing the blame game, Tom. You've got Democratic senators blaming the Fed. You've got the White House blaming the oil patch. And I'm not sure if that's sticking with the electorate right now going into the midterms.
No, I don't think it is. And again, the poll is game-changing. What Anne-Marie says, what Greg Giroux says, our poll expert, what a guy like Vallier says, or Terry Haynes and all, this is a shift poll less than a week before the election. John, I got to go back to the international markets here. It's a Damien Sassower Thursday, our EMAs.
Is that what you're calling it?
You know, is the United Kingdom an emerging market? Are we having an EM central bank?
How much trouble do you want to cause today?
I don't know. How many degrees of freedom has Governor Bailey lost because of Jerome Powell in the last 24 hours?
I think they've got a problem through the FX channel, and we've been talking about that all year. Futures right now, down 0.4% on the S&P. We'll continue the coverage. Big moves in this bond market on a 10-year, up around 10 basis points. On a 2-year this morning to 472 from New York City. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
No one covers the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
Big moves in this market over the last 24 hours or so. We've got futures down by about 5 or 0.6% on the S&P. On the Nasdaq 100, we're down 0.7% on the Russell, down 0.5%. In the bond market, yields are higher by 10 or 11 basis points at the front end, 472. Get used to that. 472, the previous high was 10 basis points lower than that, and it was a few Fridays ago. In the bond market on 10s, yields higher by 9 or 10 basis points, just south of 420. We've got a problem in the FX market. If you're President Lagarde, if you're Governor Bailey, you've got a weaker currency to deal with this morning. Euro dollar 97.41. Euro dollar negative 0.8%. That right there, a stronger dollar ripping right the way through G10. That's a weaker euro.
John, it's the way it's weaker. It is suddenly and abruptly within the later British morning, and the euro just giving out the new weakness. These are, I can't say enough about the nuances of the market right now in the Bloomberg terminal.
It's a major move.
Amazing.
Listen to what the chairman had to say
please.
yesterday, and I think we're all whipsawed after the statement to the news conference. In the news conference, you've got a Fed chair basically saying, we still believe the risk of doing too little outweighs the risk of doing too much. We also believe the path to a soft landing has got narrower over the last couple of months. And don't pay attention to the pace of hikes. This is about the destination, and that terminal rate needs to go higher. What's interesting about that last line on the terminal rate is the shift in the September dot plot was already quite large, and now we're set to do that again at the December meeting.
Well, let's take 1 minute here, because we got Jennifer McCune here on the Bank of England. We had cumulative tightening, which is associated with the vice chairman, and Neil Dutta, among others, picked that up. And that vapored in the press conference. We were up 200, 300 Dow points, and then boom, we were down 500.
It was straight out the gate. It was straight
It was
out
like
of the gate.
cumulative tightening didn't exist.
It was the first line almost in the news conference, and he doubled down on it, and he repeated it. And I keep going back to that moment in the news conference because I think it's so revealing. When he was led to believe this equity market was up, he just delivered what someone told me, when I think this is a great phrase. He delivered a hawkish greatest hits in about 2 minutes in response to that question.
We're not day trading here, but I'm looking at sterling right now, 112.38, and the chart is weaker. Let's get a brief on that. Jennifer McCann joins us, head of global economics at Capital Economics, with her work at the Bank of England. As noted, I really can't say enough about the quality of Capital Economics. Jennifer, let me cut to the chase. Late in the press conference, the chairman was asked about the international ramifications. What are the new constraints that Governor Bailey faces this morning after what Chairman Powell said yesterday?
Yeah, I think maybe it does constrain other central banks a bit, this suddenly more hawkish tone. It's pretty confusing. It's confusing not only for markets, but just generally, globally, for other central banks.
Right.
It certainly muddies the waters.
How is he constrained by domestic economics? I saw one report in the British press this morning of housing prices could decline 15%, dare I say 30%. How constrained is Governor Bailey by the domestic realities of the people of the United Kingdom?
Yeah, well, there are real conflicts in terms of the domestic position for the Bank of England as well. You're right that the economy is clearly weakening. That's having an impact on the housing market, which is a real worry here in the UK. The housing market's really important to the rest of the economy. But on the other hand, price pressure is still really strong in the UK. It's kind of got the worst of both worlds, really, where it's hit by this terms of trade shock that the Eurozone has seen in terms of gas prices, but it's also got the domestic inflationary pressures that are more like the US, with wage growth far higher than the Bank of England will be comfortable with. So we think it's going to go for a pretty big hike today. But the big question is about what the messaging is beyond that, whether it indicates that there may be a slight softening in its hawkishness to come.
The baseline assumption right now in markets is that the Bank of England's going to raise rates by 75 basis points, the biggest hike going back to 1989 for the Bank of England, and then raised to about a 4.25% level where they'll stay for a while. If that base case gets realized, what does that do to the pound? If we get that signal today, does it basically leave things where they are, or does it give some support, especially after the disappointments, the sort of disappointingly small hikes that we've seen from the Bank of England recently?
Yeah, I mean, it might give some support. Our base case is that rates actually go further than that. We're expecting a peak of 5% in the UK, and we even think there might be a 100 basis point hike today, just given the strength of price pressures. But going forwards, going into next year, we think that it's the weakness of the UK economy that's going to be really important, and an increase in risk aversion as the global economy goes into recession. And I think that's likely to weigh on sterling.
We heard, and John was just mentioning this, Christine Lagarde of the ECB is warning that recession alone won't tame inflation. She was talking about the Euro region. If this applies more broadly to the UK as well, what is the point ultimately of outsized rate hikes? What is the point of this entire hiking cycle if the sole purpose is to reduce activity that may not lead to reduction in inflation, as Christine Lagarde is saying?
Yeah, well, I think it may not immediately turn the inflation picture around, but clearly if you can pull demand down enough, then that does reduce the risk that wage growth will continue to spiral, continue to rise. That demand will keep pushing up and pushing inflation up further. So I think it's largely a matter of timing, and we've got to remember that it really makes sense for the central banks to sound relatively hawkish now. If they started indicating to us now during a tightening cycle that cuts are to come, then they're just undoing all the work that they're doing with the hikes, because financial conditions start to loosen, because markets start to price in those cuts in future. So it's a really confusing position to be in. But I think I wouldn't read too much into what the central banks are saying right now. What's going to matter is what happens to their economies and to domestic inflation next year.
Jennifer, there's a cohort of American economists, market economists, who are suggesting inflation can be stochastic, go up, turn right around, and come back down. Is that a possible belief at Capital Economics on double-digit European and double-digit UK inflation, that we can go up and structural economics will bring it right back down to a legitimate disinflation?
Well, I think there is going to be a disinflation next year. There are some really large statistical base effects in the global inflation profiles. Those apply to the UK, the Eurozone, to the US. And it is going to be the case that headline inflation comes down. The real question, of course, is what happens to core inflation, whether we see underlying domestic price pressures starting to come down. There's much more evidence of that coming in the US than there is in the Eurozone.
Why is that? I don't mean to interrupt, but I think this is critical. Why is the US different in believing core disinflation can occur, and you don't believe that in the city?
Yeah, well, I think it's partly about gas prices. So obviously in Europe, we've been hit much harder by the rise in gas prices. That's affecting headline inflation, and it has a knock-on impact on inflation expectations. We've got a lot of strikes going on, a lot of discontent about just how intense the pressure is at the moment. We're at the peak of pressure on the cost of living, on people's incomes. That's pushing up wages. And it feels like things are building at the moment in the European economies, and that there's a real risk of wage growth going up very sharply.
Jennifer, thanks for being with us this morning. Jennifer Mickey on there of Capital Economics, the Bank of England decision about an hour and 23 minutes away. These are single mandate central banks, Tom. The European Central Bank, the Bank of England, they've got a hidden inflation target. And whether they believe they can do anything about it or not, they've at least got to retain a commitment to getting it down. And that's a difference between what they want to signal and what they'll actually do. I just wonder, Lisa, if there's a difference between what they signal and what they'll ultimately do, is that a tradable story in the face of what we're experiencing right now? If you don't believe, let's say, Chairman Powell's going to do what he tells you he's going to do you still want to be long here? Because this feels pretty uncomfortable.
I don't know the answer to that, right? Do you want to play game theory? Do you want to play this game with the Federal Reserve? Because that's ultimately what you're asking. Are you going to call their bluff and say, ultimately, you can't do this? Well, the more people do that, the further the Fed has to go, right? So it kind of has a self-fulfilling prophecy against you. There is a larger question, right, which I think is actually expressed in the bond market. If you believe that the Fed will lack the political will to ultimately do what needs to be done to bring inflation back down to 2%, then you do not want to get long treasuries, because right now you cannot be certain that those yields are going to come down materially in the way that so many people had thought. And that might be one of the distinguishing features that people are kind of trying to grapple with right now.
Sometimes we make it, I think, a little bit more complicated than it is. I remember in the last 10 years, you just had some very simple statements from some hyper-bullish people who just basically said, the Federal Reserve is telling you what they want. Listen to them and don't fight them. And hasn't the Federal Reserve just told us yesterday in that news conference, ultimately, what they want?
The Fed is not in control. Right now, Mr. CPI is in control. Right now, inflation is in control in a way that we have not seen before, and nobody really understands it. You know, Jennifer McEwen was just saying that she thinks that there's going to be a more rapid disinflationary force in the U.S. A lot of people would agree with her, Tom Porcelli among them, which is one reason why they think the Fed will have to back off, and it's not even in the Fed's eyesight. So if the Fed isn't really in control and the Fed's saying, we don't really know, but we want to kill inflation, then, you know, basically you're trading off of economic data more than you are the prognostications of a split Fed that's going to be facing a lot of political
without
pressure.
a doubt, we're at the mercy of the next two prints from the Federal Reserve. I don't think anyone's denying that. But in the meantime, they're in control of something, financial conditions. And they've proven that just yesterday by smacking the equity market back down again.
I agree with that. And if they're saying that they want to bring financial conditions down, so they will. And that's the issue. And the dance, of course, is how do you do that without creating some sort of financial stability problem that causes them to stop before they've really achieved their goal?
David Blanchflower had a blistering short tweet today on the disinflation that we're beginning to see in some of the data. It was blistering.
He doesn't think the risks are that asymmetric, by the way.
Yeah.
He thinks the damage you do to the labor market is real and difficult to unwind.
That's his claim. Yeah, that's what he's known for with his classic book, The Wage Curve. John, I thought Jennifer said something absolutely profound there about labor. Here's a headline from The Independent in the last 2 hours. When are the next train strikes in November 2022 in England? We're not seeing those headlines in America.
No, but we are still having conversations and negotiations with unions in America, Tom, with inflation
But like in the United
multi-decade
Kingdom?
highs. No, the difference is they're actually going on strike.
In the United Kingdom.
But we're having conversations with unions that might go on strike.
Yeah,
in
like
the
at
United
Twitter,
States.
they're having conversations.
I think they're having much harder conversations.
Much harder
over there.
conversations at Twitter. We'll get
Futures right now on the S&P are down 0.5%. We're down 0.6%. In the bond market, yields up and away by 11 basis points at the front end. Let's call it 473 on a 2-year. Wow. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks in focus again today. At 8 a.m. New York time, the Bank of England is set to deliver its biggest interest rate hike in 33 years. The BOE is trying to rein in double-digit inflation. Meanwhile, Fed Chair Jerome Powell is prepared to raise interest rates as high as needed to get rid of inflation. At the same time, he says the Fed could go on to a slower rate, increases as soon as December. President Biden asked voters to consider the future of democracy when they vote in next week's midterm election. In a speech not far from the Capitol, the president urged Americans to reject what he called Donald Trump's big lie, denying his election defeat in 2020. Democrats are trying to stave off the potential loss of their majorities in Congress. In Brazil, President Jair Bolsonaro called on his protesting supporters to dismantle hundreds of roadblocks. He said they harm the economy and aren't a legitimate form of demonstrating. Supporters of Bolsonaro, who refused to accept his defeat in Sunday's election, have taken to the streets across Brazil. And in sports, for only the second time, there's been a no-hitter in the World Series. Christian Javier and the Houston Astros bullpen, they combined to no-hit Philadelphia in a 5-0 win. Now that ties the series at 2 games each. The only other World Series no-hitter was pitched by Don Larson of the New York Yankees in 1956. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
November 8th, as Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
China demand coming back will, of course, have an impact on the market, but we're in a world where demand is sloshing downward around the world. I think there's ample supply in the market for us to not have a big impact from China coming back.
That's the constructive view from Ed Moss, the Global Head of Commodity Research over at Citigroup, live from New York City. It's a continuation of what we experienced yesterday afternoon, post-Fed. In that news conference, equities down, futures lower, negative 0.7%. In the bond market, yields higher by 9 basis points, just south of 420. On a 10-year, on a 2-year, up 10 basis points to just in and around 472. Yields up, dollar stronger, euro weaker, euro dollar holding on to 97, 97.34. Tom, we're down by 0.9% on that currency pair.
Critical markets, and John, I'm going to suggest equities give way here with a VIX out to 26.39. John, I'm just focused on sterling. You've got to be as we drive towards the Bank of England meeting. What hasn't moved is yen. If you get yen to move out 148 out to 149, that sort of confirms everything we're seeing.
How does the BOJ respond to that?
How do they respond to Powell? I think they're like everybody else. They have less degrees of freedom than they had 24 hours ago.
Operation Ostrich. Yeah, I was about to say, just
head in the
stick my head
sand.
Right now, what we're going to do is address food. If you have your wheat in your Wheaties, and you know in America it comes from Kansas, in the United Kingdom, it doesn't come from the United Kingdom. There's huge food imports into the United Kingdom. This is something Kona Hake looks at, head of commodities research at ED&F Man. Kona, we were talking before this chat about the idea that the microeconomics of wheat, whether it's the United Kingdom or Egypt, Tunisia, whatever, when all the hardship of the Ukraine buttresses up against the macroeconomics of a combined food economics. Discuss the micro of wheat buttressed up against a difficult macro scene.
Yeah, Tom, it's the situation is literally two stories where you have the wheat supply-demand fundamentals, and this is not just for wheat, by the way, it's for a lot of the soft commodities, where supply has been really tight. Reserves, global reserves, are actually historically quite low. And you have this situation where you're trying to marry tight supply-demand fundamentals against a macroeconomic backdrop that is really quite bearish, where you have recessionary fears, you've got rising interest rates, you've got rising energy costs and lower consumption trends. And when you have that, I think the futures price tends to follow that outlook more than the immediate supply-demand tightness. And that's the trade-off we're beginning to see. And as a result, you know, these wheat commodities that ultimately are priced in US dollars, what you see is a gentle decline.
What do you see for higher single-digit food inflation? How do you break that? Is it about breaking oil prices? How do you, I get housing, how that dynamic works, but how do we move away from high single-digit food inflation?
The food inflation story was a while in the coming, right? So we knew from a year ago that this was happening, even before, actually. In the middle of COVID, they were going up. This is it's sticky. It's not going to disappear overnight because you still have freight and supply chain issues and the energy costs and fertilizer costs, all of this, which is pushing up food costs. On top of that, and this is particularly for food importing countries who price their food in US dollars, on top of that, they have a massively rising food import bill in their local currency terms. So this is really adding to the cost. So for this inflation to now start coming off, it's not going to be overnight, that's for sure. What's helping is that Yep.
Well, no, but this is the issue, right? So there's this delay kind of feeling, and it eventually will take time to come over. And food is something essential, unlike gasoline or oil, in the same kind of way in terms of people being able to reduce their consumption of oil more easily than perhaps reducing their consumption of food. How do you buy into or not some of the declines that we've seen in crude valuations, Kona, given the expectations for a slowdown or even recession?
Well, it's an interesting comparison because if you look at energy prices, so crude, for example, they're stable at $90 per barrel. Yes, OPEC held the cutback in OPEC, but it hasn't fallen to the lows of 50 that we saw at the beginning of the pandemic. And I think you're going to see the same thing with food. They're coming off. They're definitely not as high as they were just before the Ukraine invasion, but they're also not coming back to the lows that we saw 2 years ago. So I think that's the situation. The fundamentals have shifted to a slightly higher structural phase where the sticky food inflation means that your baseline is moved up a little bit higher.
When it comes to crude, Amrita Sen came on our show and said she does not expect crude valuations to go back down to that $72 level that the U.S. administration has pinpointed as a potential time to start refilling the Strategic Petroleum Reserve. Ed Morris came on yesterday and said he does think we could get there over the next 12 months. Where do you sit on this?
So OPEC has shown that they're targeting a $90 per barrel level. I think if they hadn't intervened, or they will be in November, I think prices would have gone to the 70 level. Now, how quickly and how effectively they can get the discipline together and enact that cut might be effective. If they are not able to do that, then I think the recessionary implications are so severe. Yes, it would get to 70. But my base view is that OPEC will do what they can to try and really keep it at above 85.
Kona, thank you. Kona Hack there of ED and F-Man. The takeaway there, the same takeaway that we've had in every conversation so far this morning, it's high for longer. It's high rates for longer. It's high food prices for longer. Yeah. That seems to be the takeaway across the board here.
That's the x-axis treatment, and that's where you get back to this phrase yesterday, a bombshell phrase codified by the Vice Chairman Brainerd of cumulative tightening. The cumulative effect of this sustained inflation is tangible.
It's the reaction function here for me, Tom, that stands out across the board.
And changed.
Echoed by the ECB as well. This has been a story for the last number of months, but I think everyone finally capitulating around this story, that if we get a real weakening in the economy, weakness in the labour market, a rollover in the broader economy, they are telling you that they aren't going to cut, Tom, anytime soon. They're trying to push out that story way out through next year and into 24.
That's their script, but as Dominic Kostum said, and I'm going to go to Stan Fisher as vice chairman years ago, he coined the phrase ultra-accommodative. And now you've got Dominic Kostum super restrictive. A lot of people disagree with that, but we're there. I mean, what we saw yesterday is the here and now of neutrality.
There are a lot of people this morning that just don't believe him. They don't believe it, Lisa. They still think you might get cuts next year. When this economy rolls over and this guy's truly tested, he'll capitulate. But I've asked this already this morning. Is that a tradable story? If you disagree with them right now, if you think ultimately they can't go forward with this is just about signaling and no follow-through, is that something you can actually trade on?
A lot of people are trying. I'm just looking right now at Fed funds futures, and the expectation is for a peak in June of next year of about 5.2%, a little less than that, and then they go down, right? By the end of the year, it's 4.9%. Not a massive decline or a massive cut. But the question is, how much is Christine Lagarde avant-garde in her comment this morning, right? That basically even a recession won't necessarily kill off inflation, especially because of what Kona Hack is talking about, that there are these sort of sustained higher prices in the real world economy that rates are just not going to fix. How does the Fed, how does the ECB respond to that? Do they push fiscal policymakers to borrow more money and spend at a time when rates are really high? What's the solution?
The takeaway in the last 10 years was don't fight the Fed. And fighting the Fed was being short the market. Now it's flipped. Fighting the Fed right now, in the near term at least, is being long the market.
Which raises a question of whether it's just an opposite retracement of what we saw over the past decade, or whether this is a unique period.
Across the board, it's the last decade in reverse. Futures right now, down 0.6% on the S&P. From New York, this is Bloomberg.
What are the biggest challenges for General Dynamics, and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
It is very premature to be thinking about pausing.
Until we see progress on inflation, the Fed is really focused on getting inflation down.
I think the Fed is just saying, hey, let's be careful and understand we have to get to the destination.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
It does not want to see premature financial condition easing on the signs of any Fed pivot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
It feels like that news conference ended about 5 minutes ago.
Yes,
We've
well
just
said.
picked up
Well
where we
said.
left off.
Well said.
Thank you, Tom.
Well said.
We thank you from New York City this morning. Good morning, good morning. For our audience worldwide, equity futures down 0.6%. The pain TK continues.
It continues, and it continues with a different flavor. And John, I thought our last hour was just brilliant. Thank you to our team for a great set of bookings. We continue with Binky Chada here in a moment. John, what I notice here is the markets are speaking, and this is where the Bloomberg terminal really comes in. It isn't just about the stock market or even FX. It's the sum total two-year yield, 4.72%.
The message simple, slower but higher, up 10 basis points at the front end. Tom mentioned the 2-year, 472 right now, at a 10-year, Lisa, up 10 basis points, 420.
I'm just watching the front end and watching the repricing up higher of a higher terminal rate. When does this create some real pressure that we haven't seen yet? Have we seen the bulk of it? Do people start to understand, as we heard from Dominique Constam, that it has to come from margin compression in order for the Fed to be happy? That's the soft landing is margin compressions. That's not exactly great for the equity bulls.
Cue the White House, some earnings from the oil patch. ConocoPhillips boosting the share buyback by $20 billion, Tom. This morning.
It's
just
a windfall.
Just a cool $20
Are we going to get a windfall
billion
tax? I mean, where is this before the election? We're not going to.
That was not a concrete proposal earlier this week. It was a threat.
Okay.
And I think the market saw it as just that, a threat,
not
without
even
any realistic proposal on deck that we can actually follow through with.
Yeah, I mean, Afterthought was going to Sephora, and she said, we need to windfall profits here. She wants, the flow.
You're going to tax the children.
I'm taxing the children. We're thinking of doing it. With the way they're going through it,
just to recuperate some of the money you give to them.
But that talks about the stresses that are out there. We mentioned the Washington Post poll. In America, there's some serious stresses right now. You're seeing it in the poll data.
Without a doubt, the economy front and center.
These are two combined stories.
Elisa, you've mentioned this a few times. We all have. Whatever we discuss today, about what happened yesterday in the news conference. It is all at the mercy of the economic data that is still to come. We have CPI on November 10th next week. We have CPI December 13th. And then shortly after that, I think a day later, the Federal Reserve gets set to go again. And at that meeting, we'll have the projections for next year and the year after.
That's why it's hard to really say, let's just go with the Fed, don't fight the Fed. What is the Fed wanting to do? They don't know where inflation is going to go. And I think they're pretty clear about that. The balance of risks is definitely weighted more heavily to not going far enough. And that is bearish in and of itself. But it is very unclear if we start to get some sort of disinflationary kind of force that we heard from Danny Blanchflower, what that does.
OECD Paris out moments ago, 10.5%.
Sure.
I believe that is double digit.
Germany's a piece of that. The Eurozone is a piece of that.
Yeah.
Double digit
10.5.
CPI, Tom, across the board.
UK 8.8%.
And could get worse.
Yeah.
This is something we've talked about. You can make the argument maybe that we've seen peak year-over-year inflation in America. We can debate about how long that will persist. In Europe, I think you can make the argument it's still in our future, not in our past, and that's problematic for these policymakers facing down higher inflation and also their economy rolling over.
I think you got to do a data check. I mean, what's going on here? There's just, I'm sorry, but it's an exceptionally interesting screen today.
Binky Chatter of Deutsche Bank dropped by, so we're going to catch up with Binky in just a moment. I'll whip through the price action just for you, Binky. Futures down 0.6% on the S&P 500. In the bond market, yields higher by 10 basis points. 420 on a 10-year, 470-ish on a 2-year. Euro dollar negative 0.7%. Stronger dollar, weaker euro, 97.47. Tom Keane on euro dollar. What a move!
Yeah, and you see the Dow move 800 points yesterday. You see the Dow outperform through all of October. I would suggest that
Why do you smile when you say the Dow?
Mr. Chadha is focused on the Dow Jones Industrial Average and that quality big cap move that we saw.
I don't think Binky's got a Dow forecast.
You don't think so?
I don't think he has. I think we'll avoid that, and Ramo can tell us what's coming up through this morning.
Just whipping you through it, we've got the Bank of England rate decision in about an hour time. I wonder how much that's going to change the conversation at all. 75 basis point hike is what's expected, the biggest going back to 1989. Governor Bailey does speak about a half an hour after that. Today we get a number of U.S. data points, including initial jobless claims. How much do we actually get some sort of shift upward in that? U.S. September factory and durable goods orders and ISM services data for last month. How much do we start to see a little bit of a softening in services? And earnings do continue. A lot of focus on the consumer today, Tom. And I'm wondering, John, if we see all of these companies reporting how much we see the bifurcation come up with some sort of story other than just the haves and the have-nots with strategy and with consumers that they're trying to attract.
Well, we've seen that with tech versus oil, energy, and we see that again this morning in energy. Pleased to say, here's the proper introduction, Binky, just for you. Binky Chatter, Chief Global Strategist and Head of Asset Allocation at Deutsche Bank, joins us right now here in New York. Morning, Binky.
Good morning.
What did you make of yesterday? That felt brutal for the bulls.
So actually, I wanted to start with respectfully disagreeing with you very modestly about...
You can disagree with me as much as you like, and you can be rude about it if you want, Binky.
You started by asking whether whether the meeting from yesterday is over, and what that struck me as, I think the meeting that began in March is not over yet. If you look at the S&P 500, it is absolutely glued to every measure of the Fed and Fed speak. And I think, more importantly, looking forward, you got to keep in mind that this window that we've seen of the S&P 500 being so closely tied to rates is not the normal pattern, even in past rate hiking cycles. So you have to ask yourself, what is different? Why is the S&P 500 married to the U.S. 10-year yield or the 2-year yield? Depends on your taste. What I would argue is that basically perhaps, and we all tend to look basically at risk assets or equities and the 10-year yield, but I would argue it's an open question as to whether it is actually really a concern about the level of yields, which is the numbers we were just talking about, the 2-year at a new high for the cycle this morning, or is it really, the speed which has given rise to basically all of the volatility that we've seen? If you take a look at the MOVE index, it's, almost 100% correlated with the U.S. 10-year yield.
Sure.
So and so you can't really tell rates from volatility apart. I would argue it's been much more really about the volatility. If you look at the MOVE, we are back at basically the peak in March of 2020. We are, outside of the financial crisis, the global financial crisis, we were here in Russia, LTCM. So, this meeting has been going on since March, and it's been running like an emergency meeting now for quite some time.
It's an interesting
and the
way of
pattern is
framing
an
it.
aberration.
So let's talk about the volatility. If you believe it's the vol, and you're bullish, then you've got to make an argument as to why volatility is going to come back down anytime soon. Can you make that argument now?
You can make several arguments. Number one, of course, is, if you look at a chart of volatility, it looks like a spike. If you look a little closer, it's been rising for quite some time. And with this kind of volatility, either something breaks, and that's a separate discussion, or it comes back down. From a fundamental point of view, I would argue, clearly in terms of from where we started in March and where, we need to go, we are probably a lot closer to the end than the beginning.
Okay,
and so it's really about predictability and getting that vol down.
You're one of the great bulls in the street. Just because of time, Bick, I want to cut. Everybody wants to know, you reaffirm a bullish call, you maybe take it into 2023. I'll cut you some slack on that. In your experience, how do corporations adjust to what I see on the Bloomberg screen? How do corporations adapt to get into a constructive Chata 2023?
So, there's really 2 points to make here. Number one is basically how they reacted historically, basically to recession or concerns about recession, which is, cutting and basically preserving and protecting your cash flow and parking it on your balance sheet. And I would say right now, the signs of that are, a scale of 1 to 100, around 8 or 10, so it's very, very low, and you're just not seeing that. So yes, Fed hiking cycles, lead to recessions, but the sort of, this playing out is happening very, very slowly, I think last summer we were pretty close. I would say since then, corporates have, basically said, I just cut preemptively in the pandemic, and that really didn't work out very well for us. So,
market's been hammered.
Not in a hurry to do that.
Let's finish here. Do you believe the Fed does have control over financial conditions?
I think that, if you look at a chart, so let me draw you a simple chart. It's a butterfly chart of the Fed hiking and what rates are doing and what equity markets have typically done. You can go check out even, Mr. Volcker's hikes of 1980. This cycle is unique in the sense of
But I understand
how much
the world
equities
you
have
want.
sold.
I want to talk about the world we've got.
Yeah,
This is the world we've got right now. And your call's not working. And I'm trying to work out why it will. Because this Fed chairman made it pretty clear that he doesn't want financial conditions to ease anytime soon.
Yeah, I think it's really, I would characterize it as basically Fed overreach. Historically, the Fed hasn't really talked about talking down equity markets and talking up credit spreads. It will work. That fever of the March meeting continuing until now is going to break, or it's going to break something else, and there's just sort of no two ways around that. So in terms of, talking down or tightening financial conditions, it's a strategy till it works, and it is going to stop working at some point.
Binky, it's working right now. Futures down
Yes.
0.6%. This is tough for the Bulls. Binky Chatter at Deutsche Bank. Thank you. With Tom Keene, Lisa Ravitz, and Jonathan Ferro. Jeff Yu coming up in the next hour from BNY Mellon. Your equity market down 0.6% on the S&P. From New York, your bond market yields higher, much, much higher on 2s and 10s. Your 2-year through 470 this morning. Your 10-year having a little look at 420. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. At 8 a.m. New York time, the Bank of England is expected to deliver its biggest interest rate increase in 33 years. Economists predict the UK central bank will raise interest rates by 75 basis points in order to cool double-digit inflation. Now, that would bring the base rate to 3%, the highest since 2008 and the biggest single increase since 1989. Federal Reserve Chair Jerome Powell is making it clear he is prepared to raise interest rates as high as needed to get rid of inflation. At the same time, he says the Fed could go to a slower rate of increase as soon as December. Powell spoke after Fed policymakers raised rates by 75 basis points for a fourth time in a row. The U.S. has condemned what it said was the test launch of an intercontinental ballistic missile by North Korea. The launch came a day after Kim Jong-un regime fired off at least 23 missiles. The State Department urged North Korea to stop the launches and return to talks over its nuclear weapons program. And big job cuts on the way at Twitter. Bloomberg's learned that new owner Elon Musk plans to eliminate about half the social media company's workforce. That's about 3,700 jobs. Musk intends to inform the affected staffers on Friday. Meanwhile, remaining Twitter employees will be asked to return to the office. And shares of Qualcomm are falling. The biggest maker of smartphone processors gave a far weaker forecast than expected. That showed that the market for consumer devices is eroding faster than feared. Both the economic slowdown and COVID lockdowns in China are hurting sales. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
The standard way venture firms work is you commit capital, let's say over a 5-year investment period, something like that.
Yeah, exactly. Right.
And then the fund is typically lasts maybe 10 years or so.
15. Well, these days longer. So often 15. Often the tail extends out to 20 years because these companies take a long time to develop.
And somebody that invests in a venture fund today should be trying to get rates of return of 20%, would you say, or more?
You know, top-end venture is sort of 3x net of fees. You know, ideally you're hoping for more than that. You're hoping for 5x or more. You know, you're illiquid the entire time, right? So you'd hope to get paid for the liquidity.
And today,
so yeah, maybe 20 to 40% if things go well is sort of baseline.
Let's take another subject. Let's suppose somebody says, I don't want to invest in Andreessen Horowitz. I want to be Mark Andreessen. How does somebody become a venture capitalist? What are the skill sets for good venture capitalists? There's a high degree of intelligence, hard work, a lot of luck, dress the right part, don't wear a tie. What are the things that make one a good venture capitalist?
So the highly successful VCs historically are very idiosyncratic. You have people from very different backgrounds. Mike Morris is a former newspaper reporter. John Doerr is a former chip salesman. You've got people with very different. Jim Breyer has more of this kind of blue chip investment background. You have people with very different backgrounds and experiences. And so I think it's some set of skills and some set of knowledge, and then there seems to be a taste component to it that's really hard to measure and really hard to predict.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment isn't a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
Access the financial world on demand. Hear from leading economists, policymakers, and industry industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. All eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in. We may be seeing a Fed that doesn't have to do a whole lot more.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, tomorrow on Bloomberg Television and Radio.
We know democracy is at risk. We also know this. It's within our power, each and every one of us, to preserve our democracy. And I believe we will.
The President of the United States on the campaign trail going into the midterms next week. From New York, the price action. Equities continue moving lower on the S&P 500 near session lows, down by 0.7%. Yields up by 9 basis points on a 10-year, just short of 420. On a 2-year, in and around 470. In the FX market, dollar stronger, euro weaker, euro dollar 97.42. And in commodities, crude holding on to $88 and about 50 cents. We're down by 1.7%. Talked a lot about that Federal Reserve meeting, a 75 basis point hike, a hawkish news conference. Then it's on to payrolls tomorrow. The estimates so far in our survey, Tom, 200K. Yeah. The previous number, 263.
30 seconds here, John. We fractionally moved away from the tension of an hour ago. I get that. But nevertheless, we go into Governor Bailey. What does he say today? Does he have a press conference like Chairman Powell?
Lisa informs me there is a news conference 30 minutes after the decision.
Where he
We're looking for something like 75 basis points. It's the forecast of the Bank of England I'm interested in, because I think it's tremendously difficult to put them together before we get a deeper understanding of what this government is going to do with the budget.
So we see a forecast today without a fiscal budget.
We should get forecasts, and they should have some idea. Of course, there's going to be a range of outcomes in those forecasts, a wide band, Tom, to accommodate the idea that maybe you get a shift in fiscal policy, but it's going to be interesting nevertheless.
Francine Lacroix with the governor of the Bank of England here later this morning.
What
I'm not sure what
time's
time. I don't know what time. I don't know if it's English time, New York time. I can't.
4-hour time difference now, TK.
Is it 4 hours? It's because of daylight savings. It's summertime.
Back to 5. It goes back to summertime this weekend. We go from BST to GMT, I believe.
Someone expert on BST to GMT, Amory Horton, joins us now for years in London with Bloomberg, now our Bloomberg Washington correspondent. Amory, as we come to Washington next week for Tuesday, Wednesday, and I hope to darken the door of Martin's Tavern out in Georgetown. It'll be fun. Forget about the fun, Amory. Brief us on what's the difference for Republicans between 51 senators and 54 senators. How big a difference is that?
Well, they would maintain this control, right? And there's a number of issues that the Democrats were able to get ahead of and vote on because they had the majority in the Senate. If the Senate is really what it's going to come down to, Tom. I mean, the House, the projections really show that the Republicans are going to win there. But whether or not they can gain control of the Senate, that is going to be key. And depending on how we wake up that next morning on Wednesday, we may not actually even know. But it is a big deal. If the Democrats are able to maintain control of the Senate, then it's a complete gridlock. This is something Wall Street does like. If you do see Republicans gaining that control, there's going to be a lot more issues that they're going to take up with the administration, things like impeachments, et cetera, and bills that they may be able to send to the president, but that he can veto.
Which Senate race are you focused on?
I think for me, I'm going to be focused on Pennsylvania because the margin just completely keeps narrowing, and it was very sad to watch on a human level. But I think that debate and individuals going out after that debate really questioned if Mr. Fetterman was able to do this job. It is the highest office you can run for, obviously, besides president. So that's one of the debates I'm going to watch because the Democrats had real hope and momentum to flip that from Mem and Oz, and this is really a purple state.
Anne-Marie, how far have we moved away from elections at this point just being a referendum on Trump?
Oh, that's a great question because the president is not Trump, right? It should be a referendum on President Biden. But I think Biden said it himself yesterday, outlining in this speech about democracy, that it is still about the former president and what the current President Biden would call, quote, MAGA Republicans. He really took to the fact that, in his words, democracy is on the ballot. He's talking about the fact that political violence, and the Capitol Police statistics show this, has been up since 2016, since the former President Trump took office. And obviously, he talked about the fact that what just happened recently in California with the Speaker's husband, Paul Pelosi, and the fact that this attacker came in repeating words that we heard at the insurrection on January 6th. Where's Nancy? Where's Nancy? This clearly is something that the president has felt deeply about, and he wanted to take this moment 6 days before the midterm elections to remind voters that it's not just about the economy, it's not just about abortion, it's not just about prescription drugs. Democracy is on the ballot. The big question is whether or not this is really going to move individuals in how they vote.
AMH, thank you. Anne-Marie Jordan over in Washington, D.C. Thank you very much. This coming from the Wall Street Journal. AMH sent this to me a couple of minutes ago. The majority of Americans support continuing aid to Ukraine in what there will likely be a prolonged war with Russia, but support is becoming a partisan issue as Republican opposition grows to helping the country, according to a new Wall Street Journal poll. Tom, it's becoming problematic.
If the president was a Republican, would we be having this discussion? I don't think so.
Perhaps not.
I think it's just a minority, go after the majority thing.
You don't think it gets worse as the
economy
economy gets worse as well at the same time?
No, I just think it's a theme. It's a partisan theme of a minority saying, let's push against the majority president.
Futures right now down 0.7% going into those midterms. Next week, this equity market's lower, bond yields are higher off the back of a very hawkish Chairman Powell in that news conference. I think many people are absolutely whipsawed by the dovish interpretation of the statement yesterday, Tom. And
I think
hawkish news conference. Now, the Fed speak now is going to be fascinating in the coming weeks.
Well, brief us. You follow it more than I do. I think it's a bunch of malarkey.
One official leaning into the statement and another official leaning into the news conference.
Is that going to be the new joke, like transitory?
I've heard a lot of people say that the statement was about the Vice Chair, Brainerd, and that the news conference was about appeasing the hawks. The chairman's job in the news conference is to reflect a consensus on the committee. That's his job. He can't just be speaking about what he thinks, in my opinion, this, that, and the other. He's got to be reflecting the consensus.
So how
of the
alone
committee.
is the vice chairman?
I don't think she's alone. I think they all realise we've got work to do. It was the emphasis of the news conference that mattered most. And I think he managed to do what we all said would be the major challenge. We went into this and we said the challenge for this Fed chair is to indicate that they're open to smaller rate hikes without triggering a premature easing of financial conditions that would undo the work they've already done. And Lisa, based on that very narrow question, most people assume this chairman did a fantastic job in that news conference yesterday.
A lot of people do, and people subtly point to the point that he made, which is their dual mandate is not in conflict. That, in fact, in longer term, in order to get the labor market where we want it to be, you got to bring inflation under control. Period, full stop. And that is the main risk.
Willie Caesar's coming up, the global head of credit strategy at Credit Size. Looking forward to that. Equities down by 0.7% on the S&P. The Federal Reserve behind us, the Bank of England in front of us. That decision coming up in about 35 minutes. We'll catch up with Lizzie Burden over in London to break that one down for you. What a crazy month it's been in the United Kingdom. This is Bloomberg.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now, the US and Europe are answering back with their own infrastructure initiatives to counter China. But African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
Rita Nazareth at Bloomberg with the data point of the morning, I think, the stat of the morning, if you will. The worst Fed day price action on the S&P going back to early 2021. Brutal. Equity futures right now down 0.7% on the S&P. On the Nasdaq 100 down by 0.9%. The pain continues. It's all about the news conference with Chairman Powell. It's no longer about the journey. It's about the destination. We'll go slower, but we'll go higher.
So sensitive.
Therapy, Tom. It's all about therapy. It keeps me very zen.
You're showing how vulnerable
Keeps me very zen. I'm vulnerable too. I'm all about feelings and emotions, Tom. In the bond markets, 2s, 10s and 30s look like this. Emotional move in a 2-year up 9 basis points through 470 on 2s. Pain. In the 10-year, up 6 basis points, 7, 8 basis points higher, close to 420. Pain. Pain for who? Let's talk about that in the FX market. Painful for any central bank trying to engineer some currency strength against the US dollar right now. Euro dollar, Tom, with a 97 handle. That currency pair negative this morning. Down and down hard.
It's the way it's down, and we saw that 90 minutes ago, John, and we need to watch it. There's been a pause here, but I'll tell you, coming off the theatrics we're going to see at 8:00 from Governor Bailey, you really got to wonder how these currencies react.
Yields up, dollar stronger. Next move is from Governor Bailey in the Bank of England in around about 29 minutes. That's the price action. Let's get you some movers. We can do some single names now with Bramo. Hey, Lisa.
Hey, John. We're really looking at a bunch of different earnings that were particularly some of the losers this morning. Peloton, you can't really blame Sex in the City and the potential for some sort of heart attack. Those shares lower, plunging by 17% pre-market trading after lowering their year-ahead forecast. It's really tricky when people are actually still going to the gym now and going back to living their lives the way they used to. Under Armour shares are rising 6.4%, even though there was a bit of a disappointment in some of the forecasts. And Marriott, interestingly, again, trying to make sense of some of these share moves, down 1.6%, even though they actually increased some of their forecasts. This really goes down to the year-to-date price action, considering that Under Armour is lower by 66% year-to-date. How much more pain can we bake in? On the flip side, the real just clear winners, full stop, have been the energy companies, and just some of the earnings that we have been getting confirms that. ConocoPhillips coming out, $20 billion of share buybacks. It sort of feeds into this question of how much political pressure will there be, and not just in the U.S. Jeremy Hunt over in the U.K. also proposing windfall taxes on some of the oil majors. Cheniere Energy is set to report earnings, and Transocean up more than 6% after also delivering some better than expected results. Tom, again, how do you deal with this as a politician at a time when you kind of need them to be investing, and you need them heading into the winter?
There it is, the windfall debate, and it will continue. We know that for certain into the end of the year. Yesterday, somewhere in the vicinity of 2/3 of the way through the Fed discussion, there was a modest note from Citigroup, and they framed out a 5% 2-year yield. To discuss that, Winnie Caesar joins us now, Global Head of Credit Strategy at Credit Sites. Winnie, how does your world change if the 2-year yield moves from 4.70% to 5.00%, what actually are we going to live with a 5% 2-year yield?
Well, good morning, Tom. Thanks for having me. I think that the conversation around a 5% yield, both in the front end in the 2-year, is important, as well as in the long end of the curve with the 10-year, where we've had a lot of clients asking whether we're going to, I know. You know,
is it about Halloween? Is it like a Halloween after effect? There we go.
He's really disappointed that we could only buy $10,000 worth of those I-bonds for his future savings. He's really set on buying a monster truck for himself when he's older. So hopefully we get there.
I like that.
But clients have been really focused on what happens if we hit these 5% levels, both in the front end and in the long end. And I think that the 2% 10-year yield, or the 5% 2-year yield discussion is really important from kind of a credit risk perspective, whereas the 5% 10-year yield is really important from a duration risk perspective. And the performance in credit portfolios this year has been equally negatively impacted by both credit and duration risk. So clients are trying to figure out, okay, which bet do I take now? Do I say a recession is coming, extend duration, and things are going to be okay? Or alternatively, am I going to just get whipsawed again with the 10-year going to 5%?
In your world, Winnie, and this is not the world of our listeners and viewers, how do you link the 2-year yield move up with what we see in the new LIBOR OIS, the FRA OIS through 50 beeps this morning? This is all esoteric, folks, but all you need to know is in Winnie Caesar's world, yields up. What does that mean to you? How do you link them?
So yields up has a lot to just do with market liquidity functions and really what has been happening with depository institutions and less smooth functioning in the Treasury market more broadly. We have seen over the course of this year, as the Fed really started to do QT and then kind of amped up its bond roll-off, the Treasury market liquidity has eroded pretty considerably. And this has been particularly true in the front end of the curve, which is why we're seeing a lot of just really challenging movements on the LIBOR side of things and in just the front end of the Treasury market.
Given the volatility that we've seen in benchmark rates, how much can you get behind this assertion by JP Morgan's Bob Michael yesterday on Bloomberg TV with John, when he was saying that investment grade debt really is the ballast, the sort of calm in the storm to hang on to, despite some of this underlying volatility?
Yeah, so I really respect that view. We've been very constructive on U.S. investment grade debt. With all-in yields at 6% in U.S. IG, historically, that's actually a level where you can buy high yield and perform pretty well in portfolios. So to have a cohort of companies that are much stronger fundamentally at a 6% yield feels really good. I think that what's really tripping investors up is the percentage of spread that contributes to that all-in yield is much lower than it has been for the past 10 years, just because government treasury yields are so much higher. So investors are really trying to wrap their head around how much credit risk can I take and feel comfortable with. I love this 6% all-in yield. And what we're telling investors is the IG universe has a lot of flex in their liquidity, in their balance sheets, in order to weather a continued economic deceleration.
Winnie, given all of this, though, how much do you have to look at some of the technicals, right? This question of the LDI concerns over in the United Kingdom, perhaps not in the same form, but forced selling from some big institutions that have been hit with massive losses, some of which, and I'm talking about the private debt and the private equity world, might not have been realized yet.
Yeah, so the liquidity side of the conversation is really interesting, especially because one of the top things we heard from investors coming into this year was, we're reducing our allocations to U.S. IG. We're reducing our allocations to U.S. high yield. We realize that yields are going higher. We realize that policy tightening is upon us. And where people were going, floating rate asset classes, CLOs, leveraged loans, private credit, private equity. So there is the potential that we continue to see kind of this re-rack in terms of asset allocation. But the benefit to USIG and high yield is a lot of investors started their years underweight those asset classes. And so there's a pretty good case to be made that they should be rotating into something else. The question is, how much liquidity did they kind of preserve or put on hand at the beginning of the year instead of putting all their eggs in the EON basket or in the private credit basket?
When we look at short-term paper, and I guess we've got to look to December as well, does the Fed parlor game and the Fed speeches that we're going to get, I can't imagine what they're going to be like here in the coming days. When we look at the speeches, does that actually affect short-term yields? Or are they now just a beast out into 2023 to stay elevated?
I do think that what the Fed governors end up saying over the next few weeks is going to be important. We've seen a lot of volatility.
In what way?
We've seen a lot of volatility in the terminal rate that's priced into the Fed funds futures market just in the past 12 hours or so. Now with a terminal rate well above 5%, about 5.18%, we're going to be very focused on the conversation around lag effects and kind of the appropriate pace of tightening from here on out. Who knows?
I don't mean to interrupt, Winnie, but this is just absolutely critical. Do you think various and sundry Fed speakers will talk back what we heard from Chairman Powell yesterday?
I think that there is the potential that there will be more of a focus on the lag effects and a slower pace of rate hikes from here on out. Whereas Fed Chair Powell was very much focused on kind of that overall higher destination in terms of Fed funds. I think that the pace and kind of the path to get to that destination is still highly uncertain. There's still a lot of economic data to come from now through the end of the year and, let alone into next year. So I do think that the Fed speakers are going to be focused on that lag effect between policy tightening and actual economic impact. Because when we talk to our analysts at credit sites who cover all of these companies, they're definitely seeing some signs of kind of transition in terms of inflationary pressure and also transition in terms of expectations for next year, which indicates to me that there is some deceleration in inflation. There is a deceleration in growth, and the Fed kind of needs to acknowledge that and that the pace of tightening needs to be much more reconciled with kind of the lagged impact of policy tightening on actual economic conditions.
Winnie Caesar, thank you. Winnie Caesar of Credit Sites. Did we clarify whether Mini Caesar was long this equity market, Tom, buying into this weakness?
We didn't go.
Did we get any clarity on that?
We didn't go equities with it. We went mostly like a 2-year yield in it coming in as well. And I thought it was really nuanced between the duration game of fixed income.
Just to be clear, I said Mini Caesar, not Winnie Caesar. The smaller version.
The Mini Caesar actually had been long going in yesterday's meeting and was very upset and was expressing incredible displeasure.
That's understandable.
It's understandable. We all feel it.
The bulls have been shedding a lot of tears through this year, Tom. Futures are down 0.8%. Darren Mayer's going to join us. Mini Caesar, not Winnie Caesar. Anyway, coming up, the head of research over at FX Strategy and at HSBC. Looking forward to that. Yields are higher, stocks are lower. We're down 0.8% on the S&P. What a moment. What a moment in this market off the back of that news conference from New York.
It's amazing.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Central banks in focus again today. At 8 a.m. New York time, the Bank of England is set to deliver its biggest interest rate hike in 33 years. The BOE is trying to rein in double-digit inflation. Meanwhile, Fed Chair Jerome Powell is prepared to raise interest rates as high as needed to get rid of inflation. Now, at the same time, he says the Fed could go to a slower rate of increases as soon as December. President Biden asked voters to consider the future of democracy when they vote in next week's midterm elections. In a speech not far from the Capitol, the president urged Americans to reject what he called Donald Trump's big lie, denying his election defeat in 2020. Democrats are trying to stave off the potential loss of their majorities in Congress. Nature has given the British government a break. Unusually warm weather in the UK last month brought down the cost of the government's energy subsidies by almost $296 million. The unseasonably high temperatures meant households haven't switched on their heating as early as they would in a normal year. Peloton has delivered a weaker outlook for the current quarter than Wall Street was predicting. The fitness company revenue was 37% below what it was a year ago. Still, CEO Barry McCarthy said Peloton is beating its own timeline for a turnaround. Shares are down about 90% over the last 12 months. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
No one covers the world like Bloomberg.
The writings on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders.
Watch Wednesdays on Bloomberg Television.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He taught himself, self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
As
long as inflation remains elevated and way above the Fed's target, it's really going to be focused on getting inflation down. I think for the foreseeable future, till we see progress on inflation, the Fed is really focused on getting inflation down.
The former Fed Vice Chair Richard Clarida joining us on our special edition of Bloomberg Surveillance covering the Fed decision. Fantastic to catch up with him. This market is down, and not just inflation. That's the effort here for the Federal Reserve to get inflation down and to get the market down and keep it there, apparently. Equities are down by 0.9% on the S&P. Yields are up by 8 basis points to 418, and this dollar stronger, euro weaker, euro dollar 97.40. TK, we're down by 0.8%, and this Fed chairman couldn't be clearer, could he, in that news call for
Yeah, we went from
cumulative
tightening, what, John? Up 300 Dow points, bam, down 500. Liz Ann Saunders just had a great chart out of the S&P and separately the Dow as well, and it was like two events. It was a statement, and then boom.
Hammered.
Just completely different.
And then kept doubling down on the statement, too.
And you see it in the deepest market, which is foreign exchange. You had a 113 DXY. Yen hasn't moved, not part of the story today. John, what do we do with euro? What does Lagarde do with the euro? Like a 0.97,
well, I think the question for people in FX right now, we trade in rates or we trade in growth prospects? Because rates are going up in Europe and growth prospects are rolling over.
Yeah, well, there we are. Let's do it now with Dara Meyer joining us, Head of Research Americas, Head of FX Strategy at HSBC. What are the ramifications of DXY breaking through 1 to 13? What are the ramifications of resilient and then stronger dollar as HSBC is nailed for 3, 4, 5 years?
Well, it's been going well. Thank you. Can I just say, and it pains me to say this, good call John yesterday on the coverage around the Fed, because you got the statement. He said, well, hold on, we haven't had the press conference yet. And that absolutely turned things on your head, as you all said. So sorry.
John did well, but I didn't do well.
I'll take that.
Yeah, well, he shone yesterday.
Dara just knows that it's my turn to buy the round when we go for drinks next. And
that's
okay, very good.
No, but
let's continue. Strong dollar. What's it mean, oh wise one?
I think what's curious is the way you framed that question earlier is like, are we talking rates or are we talking relative? Why can't we talk both? It's both about rates and global growth, not U.S. growth. And I think that's the mistake the currency consensus has made. They've looked at the U.S. economy and said, hey, our interest rate sector is slowing. That will temper the Fed. That will temper the dollar. But the reality is the dollar is trading off deceleration in global growth because everyone's having to hike rates. On the U.S. side of the equation, as has become abundantly clear, amazing work by the Fed yesterday to be able to get us on a slower trajectory for rates without fostering a massive risk-on move, without fostering kind of, oh, this is the end of the tightening cycle. I mean, that they must have spent long and hard thinking about how they're going to do that. And so I thought cleverly done.
The hawkish step down, right? I mean, this is sort of what people were expecting and what they delivered on. So I don't understand, though, what could change the story that you just said. Because you have a Fed that's hiking rates potentially to a higher level than previously expected. And you also have a U.S. economy that's better than so many of the others and more resilient. So what's going to change the dollar story throughout next year?
Well, I think the data. I mean, honestly, that's what we'll end up coming back to. If you get 2 or 3 months of core CPI printing 0.2, or non-farms coming in 100,000 or less, then that allows the Fed to say, kind of, our work is done here. That's the key. But the market's just so impatient for that. They want to say, well, let's anticipate that and expect that to come in 2023. But the Fed's saying, we've been getting this so wrong for so long on inflation. We got to see the numbers. We can't anticipate the numbers.
So right now you're projecting a terminal rate of 4 3/4 to 5%. The market's actually ahead of you.
Yeah.
The market's above that. Where do you think you're right, and where could you potentially upgrade how high you see rates going?
Well, look, on one day of the week, the market looks more dovish than us, and the next day of the week, they look more hawkish than us. That's just the reality of the market. So I don't draw too much from that, and nor do I spend a lot of my energy fretting about where the consensus is at. It's clear the momentum, and this has been true of this dollar bull run. I compare it to the road trip with your kids. You set off, and the kids immediately start saying, are we there yet? Are we there yet? Are we there yet? This has been the dollar bull run. Every moment in this dollar bull run, the market has said, is that dollar peak? Even yesterday. Do you think that's the dollar peak? Why? I mean, the Fed's still telling us we'll keep raising rates. Global growth is slowing. Risk aversion is pervasive. You're going to buy the dollar, at least for the next couple of months, I would have said.
Let's take a random tea leaf. I did Thai baht back to 1999 after the big blow up, after the crisis, and we're out 3 standard deviations, which is 0.8 standard deviations more than we've ever seen. How does the world adapt to Jerome Powell when they're looking at that depreciation or devaluation?
Well, look, we're in that environment again, aren't we, of our dollar, your problem. And for economies that are fighting inflation, a weak currency is a problem. But frankly, what can they do? I mean, look at the Japanese. They've tried, they stemmed the flow, but the reality is it's not a great deal to be done.
Can listen to Bangkok and the 47 other Bangkoks that are out there?
I don't think we're at the point, and I think the Fed will take this view, that we're not at the point where the destructive element of a strong dollar is such a problem for the global financial system that we kind of have to navigate towards some kind of exit. We're just not there yet. And if you've still got core inflation at 6%, you've still got, an unemployment rate that's historically low, the Fed will say, we've got work to do, and that's what they're telling us.
Right now, I'm just focused on the euro when that reaches a breaking point. I mean, we've seen it sort of hovering underneath the parity level. At what point does it become a problem that either triggers the Fed or triggers the ECB in some capacity, even if it's not their gig to play?
Yeah, I think it's already a problem. It's already a problem for the ECB. But the problem is, what do you do about it? There's not a great deal to be done. The ECB has belatedly matched the Fed for pace, but there's no way they're going to match them for level. So let's pretend we get to a point where both central banks have stopped. You're going to be sat on a dollar that's yielding considerably more than a euro. You're getting paid, literally paid for doing nothing, which is just fantastic. Who's not going to do that? And if you've got the bigger issue for the euro, I think, is let's think about what you do with the dollar, to your point about rates and growth. When the Fed raises rates, you buy the dollar because rates are going up and because growth is going down, risk aversion. When the ECB raises rates, okay, you might buy the euro because rates are going up, but then you're selling the euro because European growth is going down. You got that ambiguity around the euro that the dollar doesn't struggle with. And that's why the dollar throughout this year has been buy the dips, grind higher, despite everyone saying, hey, is that the peak?
We've got about 30 seconds. I was speaking to Bob Michael yesterday. Lisa mentioned that earlier on. And he talked about the calm before the storm. Do you get the sense this ends with this cathartic moment of just this massive, massive demand for the US dollar? The kind of breakout we saw in March 2020. Are you anticipating that kind of thing again?
I view it slightly differently. I think we've been on a reasonable dollar trend, so like a boat trundling along the water towards the ferry port. But as you come into the ferry port, the stopping point, all the propellers come on, all the volatility, everything gets churned, and then we kind of settle. And maybe we settle into a port like a trading range for 2023. That's what I think we're heading towards, not necessarily some massive capitulation or final dollar surge. I think it's more about the vol that we'll get as we near the end of these cycles.
The best storyteller in the business, TK. Isn't that great?
By the time we start churning at the ferry port, I'm over the edge seasick.
You haven't made it on the car trip to
Martha's
the ferry
Vineyard
port.
ferry coming out of Hyannis, coming out of Falmouth. I would lay down, I'm not kidding you, I would lay down as they left the harbor.
You dropped the kids off before you got
John,
there.
this is like no waves.
That's a different churn.
Dara Mayer of HSBC. Dara, fantastic to see you, buddy,
Nice to
as
see you.
always. Equity futures down by 8 cents of 1%
trade?
on the S&P.
We didn't get a
He gave us a
$1.
framework. Stick with the dollar. Jeff Yu of BNY Mellon's going to join us
He'll
with
give
a
us a
trade
trade.
next. From New York, this is Bloomberg.
What do you say to the cynics that say, look, it's all nice and fine, but a lot of it is greenwashing, and you're not a good company, you're just a less toxic company than some of the other oil majors?
Well, the first thing to say is that, I'm a big believer in we need to put ourselves in other person's shoes in life in general. And So I understand that point of view, and I get that people have that perspective. I don't agree with that, obviously, but I understand where they're coming from. We have an enormous challenge as society, which is to provide the world with reliable, affordable, and clean energy. That's what society wants. That's what society needs. And I believe in my heart that a company like BP is actually one of the few companies in the world who can actually make that happen. We can talk about the things that we're going to grow and over the coming years, and I find it hugely exciting and energizing for our organization. But that's what the world needs, and you simply can't go against the grain of society. You can't defy gravity, and that's why we're making the change that we're making.
As Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune in to Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
It is very premature to be thinking about pausing.
Until we see progress on inflation, the Fed is really focused on getting inflation down.
I think the Fed is just saying, hey, let's be careful and understand we have to get to the destination.
It's not about the terminal rate. They're still looking at as high a terminal rate as they need to derail inflation.
It does not want to see premature financial condition easing on the signs of any Fed pivot.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. An historic moment after an historic press conference. John, I'm going to go to the jaw-dropping headline. The Bank of England looks for an 8-quarter, 2-year recession starting now.
The central bank goes 75, a 75 basis point interest rate hike from the BOE from 2.25 to 3%, a 75 basis point hike. And in the forecast, Tom, if, and it's an if, we get a 2-year recession if rates follow the market curve. The peak interest rate, though, here's a bit of pushback that we didn't get yesterday from Chairman Powell. Chairman Powell encouraged a higher peak rate. The Bank of England saying this, Bramo, just moments ago, the peak interest rate likely lower than implied by markets. So a pushback against that peak view in this market.
Financial markets pricing in a path that heads to 5.25% in 2023. So they're pushing back against that. Also interesting, saying that the inflation rate will likely peak at 10.9% this year rather than the previous peak expected of 13%. So perhaps seeing some disinflation from some of the recession that they see, the 8-quarter recession that is starting right now.
Sterling weaker, 112.07. We're going to get a 111 handle here on a weaker sterling through the morning as well. John, this seems like it's in a vacuum because they don't have a fiscal policy within the political turmoil of the nation.
That's what will be interesting about the news conference. What kind of assumptions are they making on fiscal policy? Because all reports are suggesting from this government right now, we're going to get a lot of spending cuts, Tom, a lot of spending cuts in the next budget.
I just don't understand it. This isn't in the textbooks. This isn't in Begg is the big British textbook. It's not in there.
It's been a total mess in the United Kingdom. This 75 basis point hike was set to be a whole lot bigger than that at one point 5-6 weeks ago. So that's a big change relative to what we expected only a month or so ago. So you get a 75 basis point interest rate hike from the BOE. Cable's down to about 112. The front end of the gilt curve yields up by 2 or 3 basis points. No drama there at about 294, and a 10-year up 3 basis points to 342. Outside the Bank of England, working through all the details of this decision, one of the best, Lizzie Burden, joins us right now. Lizzie, your takeaway from this decision this morning?
Well, it's exactly what markets and economists had expected, and if they'd gone for 50, as some were saying that they might, like Citi or ING, it would have been bad news for the pound. But thankfully, the comms have worked this time. The groundwork was laid for this. It is, as you say, much smaller than had been expected at times in the period since the last decision. There were times when markets were looking for 200 basis points because of the need to deal with Trussonomics. Interesting, the vote split here. We were expecting 7-2. The dissenters were Swati Dhingra. She voted for a half point. Silvana Tenreiro went for a quarter point. Dhingra, of course, outed herself as a dove at the last meeting, her first meeting. We knew Tenreiro was a dove already, but this is because of their worries about the recession risks. You'd have expected Ramsden and Mann to go for 75. They went for that in September. But really, these forecasts, I don't think you can take too much from them. As you say, the BOE is flying blind here. We don't know what's going to come in the November 17th fiscal statement, particularly on energy. Of course, you've got the impact of the energy bailout, but we don't know what's going to happen after April in terms of the energy support, in terms of what it means for inflation. So I wouldn't read too much into that, but interesting that they're pushing back against the market expectations for rate hikes down the line. That's already what Ben Broadbent, Deputy Governor, had been saying.
Lizzie, what kind of assumptions do you think they have made about the future of fiscal policy?
Well, I have to say, Rishi Sunak, when he was Chancellor, was known for not leaking, shall I say, but preparing the markets and the press about what he was going to do. And Jeremy Hunt and Rishi Sunak have been doing that, managing expectations in recent days. So we can expect there to be tax rises, we can expect there to be spending cuts, and the BOE will know that. But of course, they cannot factor that into this decision too much until it's confirmed on November the 17th.
Lizzie Burden, outside
Stanley says,
the Bank of
more
England.
The Treasury does in terms of the heavy lifting, in terms of tightening, the BOE has to do less.
Lizzie, thank you. Wonderful work, as always. TK, 75 basis points from the BOE.
Very quickly here, let's frame this out. It's on the edge of Draghi. We didn't see this with the Fed at all. They have the presumption to guess out to the fourth quarter of 2025.
You get a multi-year forecast from the Fed.
Is that like a British thing?
No, you get a multi-year forecast from the Fed, don't you? They'll tell you where they think inflation is going to be in 23, 24.
In this environment, I'm stunned that they do that. I agree. They're basically looking towards deflation into 2026.
I can't get past next week.
Yeah, exactly.
Never mind into 24.
Exactly.
It's going to be a great conversation a little bit later. Don't miss it. Francine Lacqua sitting down with the Governor of the Bank of England, Andrew Bailey. We'll bring you some of that interview at 12 p.m. Eastern Time. What a tough time that man has had, and the Chancellor, and the former Chancellor, and the Prime Minister, and the former Prime Minister in the last couple of months.
Does he have to go see the Queen of the King when he's made governor
not in the
of
same
Bank
way.
of England?
Well, you think he hikes 75 and goes to see King Charles?
I don't know.
If only he could script
Gives him a phone call the night before. Let's do this. We had Dominic Constant of Mizuho with us. Thanks for your many comments on what Dr. Constant talked about. Now we talk to Jeffrey Hughes, Senior Market Strategist, BNY Mellon as well. Jeff, I don't even know where to begin other than I think an emotion of our listeners and viewers. Is the system near breaking?
No, it's not in the UK, but dare we use that P word, unpivot. There's a key line here. There are clear signs of the cost of living crisis taking hold on economic activity, suggesting a more gradual approach was warranted. An over-tightening in policy, right? They are worried about over-tightening. They're worried about hitting the afterburners at exactly the wrong point in the household cycle. So some doubts are creeping in, and I think that's where we are. This is really very different from where the Fed is right now. Actually, everyone else is different from the Fed is right now. You look at Norges earlier today, it looks like Europe is starting to pull away, or rather pull back.
Well, that's exactly where I wanted to go, Jeff. How much is this really representing a sea change among central bankers? The fact that one committee member on the Bank of England's committee did vote for a 50 basis point hike, another one 25 basis point. How much is that the dissent that you're going to increasingly see around the world that will eventually filter back to the Fed?
So it is only going to start to increase. Starting in Europe, again, we saw it in Norway today. It didn't seem like 50 basis points was on the table, even though that was where the market was. And now we're going to start to only see increasing dissent of not pursuing things as aggressively. The Fed, however, so I think you mentioned this early in the program, our dollar, your problem is going to take quite a bit for them to start to worry about international conditions, because from the US's point of view, it's about tightening conditions in the US. The US economy is still doing well, so there's no obligation for the Fed to take into account wider conditions.
How long can this last, Jeff? How long can this divergence where the dollar is the preeminent trade and continues to strengthen, is that an entire 2023 kind of trade?
So it will last longer than markets expect, but more crucially, from a positioning point of view, it will last longer than markets hope. Right, so there will still be repeated efforts to price in a Fed pivot trade through equities, through bonds, through FX, through the dollar and the like. But I think there's still a few more rounds of disappointments to come. We look at where Fed terminal pricing is. Right now it's going up, whereas everywhere else now it's probably going to start coming off.
Jeff, we've been discussing whether you should be trading growth expectations or rates when it comes to the euro, when it comes to sterling, and Lisa's been building on that in this conversation too. Based on what the Bank of England's just said, is that positive news for sterling that they're pushing back against a higher terminal rate that would have actually hammered growth over the next couple of years?
I think initially it's not, to be frank, because if the market's still working off rate differentials, between the BOE and the Fed, so that correlation needs to snap back, right, after the mini budget kind of trashed it. So if that correlation does snap back, then on a cable point of view, then sterling's going to struggle. But if you think that not as tight policy, if the household is going to get some relief, then growth is going to be slightly better in the UK compared to the Eurozone, compared to Scandinavia, then relative value trades, that could start to come through. We just look at intra-European divergence, but the dollar is still going to reign supreme at this point.
Getting a bonus round, Tom, with Jeff Yu. How cool is that?
It's good.
Jeff's going to stick with us.
Great.
Jeff Yu of BNY Mellon sticking with us. The Bank of England hiking rates 75 basis points. Sterling against the US dollar 112.30. I should point out, Tom, end of September 103.50 on cable. So we're a mile away from the mess of a month or so ago.
But that was a political hemorrhage, if you will. And I look, it's a third, we talk about, and I have trouble with the phrase Black Wednesday. I think for Americans, they don't know what that means. The answer is 1992, the world of England blew up. It's a 36% devaluation of pound sterling over the last 30 years. This guy has a chronic nature to it around all of this, day to day that we're talking about.
And it's been feeding, Lisa, higher inflation expectations in the United Kingdom.
And this is really the conundrum for the Bank of England. And I'm very curious to see the evolution of some of the dissenters, of how many more of them come to the table and say it is not worth inflicting more pain to try to get inflation under control because we might not have that much control over it anyway. And check it out, the pound is weakening anyway.
Should we call Catherine Mann, see if we can book her tomorrow with 7C block?
That would be
amazing. Mann used to come on all the time.
Oh, yeah.
It's a gig at the Bank of England, never hear from her. Just never hear from her anymore.
No, she didn't send me, I didn't
love
get a
catching up
Halloween
with
card from
Catherine.
her,
OECD, Catherine would come on. City, Catherine would come on. Gets to the Bank of England, no.
Wait,
don't want to talk to you guys anymore.
Where's the violin? I mean, really, people are crying. It's a massive
I think we'd all like to hear from Catherine Mann.
Could you see, we could be in London, in the food court in London with St. Paul's behind us.
Are the drinks there on the
with
table?
the drinks,
Okay. Sure.
Beefeater gin.
Nice.
We would have Blanche Flower and Catherine Mann. That would be like lightning.
Crossfire.
Yeah.
I'm not sure that's a great sell for Catherine Mann.
Oh, I think.
Do you want to come and get berated by Danny Blanchflower for raising a drink?
No, she'll give it right back. She's tough as nails.
I know she is.
She'll throw chalk
but
at
who
him.
wants to face down just Danny shouting at you because you hiked rates?
I don't
just think anyone wants to engage.
Mann Blanchflower would be just a great panel we could do.
I'd like to be a fly on the wall back in the day with Blanchflower and Mervyn King.
Oh, yeah.
Wouldn't that have been fun posing there too?
These are really bright people that agree to disagree collegially.
Equities negative today. Sterling -2. We're down by 1.4% on cable. 112.36. Was that a real invite for Catherine Mann? If she's listening.
Yeah, of course.
Sure.
For Dr. Mann, always.
Gin and Blanchflower. She'll be like, I'll take the gin.
Did you see,
I don't know about Danny.
The word cumulative in here? I don't see it anywhere.
From
Nobody's
New York.
being cumulative in London.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Pakistan, former Prime Minister Imran Khan has been wounded by gunfire. His spokesman says he was shot in his leg but is safe. The attack took place at a rally in the eastern Punjab province. Khan was leading his supporters toward Pakistan's capital, Islamabad, to demand early elections. The U.S. has condemned what it said was the test launch of an intercontinental ballistic missile by North Korea. The launch came a day after Kim Jong-un's regime fired off at least 23 missiles. The State Department urged North Korea to stop the launches and return to talks over its nuclear weapons program. The reopening of China is the dominant theme for traders the last few days. Chinese equities rallied Tuesday and Wednesday following unverified social media posts that signaled Beijing is set to move away from its strict COVID-0 strategy. But stocks slumped again today after China's top health body reiterated its commitment to the policy. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK. The market environment is a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
All eyes are on the October jobs report.
The unemployment rate needs to rise for inflation to come in.
We may be seeing a Fed that doesn't have to do a whole lot more.
Tomorrow, Tom, John, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
To preserve jobs in the long run, we need to kill inflation.
We have a long way to go.
Creating pain in the jobs market is not what we want to do.
Is it worth paying this price to get inflation down?
The October jobs report, tomorrow on Bloomberg Television and Radio.
It's basically made it very clear that they're emphasizing the longer more than the higher. It's not just up and then back down. The Fed's going to keep that peak in interest rates for quite some time until they actually see improvement in the underlying inflation outlook.
That was Bill Dudley, Bloomberg opinion columnist and, of course, former New York Fed president. Equity futures this morning are negative off the back of Chairman Powell yesterday. The follow-through pretty negative from yesterday into this Thursday morning. Tom, futures are down by 0.7%. You seem very excited.
I'm very excited. I've never seen this before. Translate, John. Jeff, you with us, but I got to go to John Farrell here. Can you imagine Secretary of Treasury Yellen coming out with a statement 15 minutes after Jerome Powell releases a cumulative tightening statement? I have the Chancellor of the Exchequer managing the message in real time on the monetary events of his nation. Never seen it.
Chancellor Hunt wants limited interest rate rises. But I think there's some acknowledgement here before we sort of jump too many steps ahead. There's some acknowledgement of their contribution to what is happening with interest rate hikes in the UK. So Chancellor Hunt goes on to say the top priority is to grip inflation. Difficult decisions need to be made on taxes and spending. There is an understanding here in this government of their contribution to the idea that we were expecting higher interest rates and more rate hikes still to come potentially. And what they're going to do is come out with a statement in the next month or so, a budget that's going to involve tax hikes and spending cuts, which will, in theory, stop the Bank of England from hiking more than they otherwise would have done.
We rip up the script off this historic moment with Jeffrey Yu. He's Senior Market Strategist, BNY Mellon. Jeff, thank you so much for continuing with us. Jeff, how do you spell austerity, United Kingdom style? What's it going to look like?
Well, the Tories are going to try to not call it austerity, if anything, you can bet that. But just going to the Chancellor's statement right now, there are political calculations here. The UK government wants limited interest rate rises because that translates into higher debt servicing burdens for homeowners, right? The bulk of which the Conservative Party will consider their natural constituency, for example. But at the same time, the BOE and the governor has mentioned this in the past as well. Inflation that could widen inequality as well, and that's a society-wide issue. So I think these statements are driven by different motivations and targeted at different groups here. But let's see what happens when the new fiscal plan comes out, right? So now the onus is on number 10 and number 11 to work together to make sure that the risk to that 2-year recession view from the BOE, that is a kitchen sink forecast, and things can only be better than that. So we'll see, what the Chancellor comes up with.
So, Jeff, do you think that we're on the cusp of perhaps a buying opportunity in the United Kingdom, or foreign investors starting to see some stability and a sign that they can start to try to find some value?
So let's go by on an individual asset class basis, right? So gilt markets, I think there's not going to be as much volatility as in the past, and I do think that people are going to start to look at the long end of the gilt curve or the belly of the curve and say, right, if this is where the BOE is, then scope for aggressive steepening is going to soften to some extent, so they could revisit that market as well. In terms of equities, again, the FTSE 100, 70% of that is international earnings. We're taking a view on the global cycle, less to do with the UK, but the FTSE 250, that is certainly going to continue to struggle because that is tied to the UK household, and certainly the household is in for a world of pain up ahead. As for sterling, as mentioned earlier, it's probably still relative value because where the Fed is, you can think what you want about the BOE. Where the Fed is right now, the dollar's still going to try to lead.
You said something about the kitchen sink approach, and this is what a lot of people have been looking for. People have been wondering when we're going to start seeing companies really downgrade their earnings per share, when you're going to start seeing central bankers say, we are going to go into recession. In this case, an extremely long one. 8 quarters is quite long to be projecting. At what point can that give people conviction for some sort of capitulation and a beginning of a new bottom?
Well, frankly, I'm eating my own words here because I think, with the last round of forecasts in August, it was 6 quarters of household real income declines. I called that kitchen sinking the forecasts, right? So the risk is you think you've kitchen sink the forecasts, and then you realize, well, okay, there's another sink out there. So that is something in terms of guidance, be it on a corporate level, a central bank, or a nation. They really have to be careful at this point in the cycle. No matter how bad you think things are, there's still the possibility that things could get worse, right? So that's where you need to be really careful.
I really can't emphasize, folks, the movable parts this odd Thursday morning. And with that said, Jeff, for you, my theme has been degrees of freedom. How constrained is Governor Bailey? How constrained is his team, Catherine Mann and others here? Do they lose degrees of freedom because Jerome Powell's saying 5% 2-year yield or bust?
Right. So on the international side, absolutely, it's done. So don't even assume that you're going to get any degrees of freedom, from the Fed side, from the dollar side. So try to manage your currency, make sure you don't import as much inflation, and just hope that energy prices can continue to settle. But on the domestic side of things, I think they'll try to push the chancellor around. Let's say you need 50 billion in savings. Please focus on the revenue side, because the revenue multiplier is close to 0, according to the IMF. But the fiscal spending multiplier, be it spending or cuts, that is non-zero. So the more you can lean on tax rises, on the revenue savings, the better. The more you lean on spending cuts, that is going to be worse for the economy. But then it's going to be a political estimation, and Governor Bailey will have no input into that.
Hey, Jeff, wonderful. Thank you, sir.
Fabulous.
Jeff, Elf BNY Mellon. Jeff, thank you. Ian Shepherdson of Pantheon Macro had this to say just moments ago on Twitter.
Please.
Powell, I'm going to hike and hike until I blow the house down. Bank of England, nah, not doing that. And then he goes on to say, poor sterling, cable 112.23. And that's the difference between the Fed yesterday pushing to price in a higher terminal rate, and the Bank of England this morning
and others
pushing back against the idea of a higher terminal rate.
I believe it was Norway that came in a little bit light today as well. We're starting to see this effect. John, I forget this number. I just didn't have it memorized. The average U.S. recession is about 10 months. How as an institution do you adapt to a 2-year recession call?
If rates are priced where rates are priced right now in the market, that's the if over at the Bank of England right now. Tom, for me, though, it's the reaction function of these central banks through a recession. It's going to be very, very unusual to see the economy enter recession potentially. In the UK, it could be just around the corner, in the United States as well. And central banks not cut rates. Because, Lisa, that's what they're telling us, isn't it? That we could go there, and if it happens, you know what? We might not cut this time around.
Because we're dealing with inflation. And it might not even be healed with respect to the rate hikes that we're expecting, if you believe ECB's Christine Lagarde. Going to Ian Shepherdon's quote, I'm just still thinking about this. We're going to blow the house down versus, nah, no thanks. At the same time, the U.S. economy is much stronger. Is it a relevant comparison to talk about these two economies in the same breath, given their different battles that these central banks are battling?
Do you have that nursery rhyme, that little story, the three little pigs and the wolf and blowing the house down?
Yeah, of course.
Just checking. Tom didn't.
Yes, he did.
No, he didn't. He doesn't remember.
Yeah, of course. You start it with straw, then you do it with wood.
Jack had dinner early. Father played with Kate.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from businesses most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
While Teslas and the like make for good headlines, the reality is that even if every car on the roads today went electric, it wouldn't be enough to curb global emissions to avoid catastrophic climate change. Greenhouse gas emissions from transportation account for about 29% of total U.S. greenhouse gas emissions. So what about the other 71%?
Buildings across America burn fossil fuels to operate. What we want to do is make that all electric. Instead of burning oil and gas to give us the energy and electricity we need, we want to do 100% clean energy, all electric. We want to turn buildings into Teslas. Just like a Tesla or an electric vehicle is all electric with no fossil fuels, we want to do that with our buildings. And if we can do it in one building, we can do it in all buildings. And if we do it in all buildings, we'll reduce 30% of U.S. greenhouse gas emissions.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. No one covers the world like
The
Bloomberg.
writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Bases loaded. Mike McKee around the table with us, Tom, in the studio to break down jobless claims due any second now. Equity futures going into that on the S&P 500, deeply negative through most of this morning. In the bond market, yields much higher, up by 8 basis points on a 10-year to 417.84. Your equity market down 0.75% with the data. Here's Mike McKee.
Interesting, John. No change in jobless claims for last week, 217,000, which is less than the 220,000 that were forecast. So if Jay Powell's looking for some sort of relief from the labor market, he's not getting it yet. A lot of talk from companies about maybe pausing hiring or letting people go, but it is not sending people to the sidelines yet. And we look at the continuing claims numbers, 1,485,000. That is slightly higher than the prior week, but it is still showing that people are getting jobs right away. The revised initial claims number is 218,000. So it was actually a drop, if you want to technically call it that, from the prior week. The number that really may matter here the most, though, for companies going forward, non-farm productivity, it rises just 0.3 after a drop of 4.1% in the second quarter. The forecast was for 0.5%. And the problem there is that it means companies are paying more to get less out of everything because productivity is really slumped. Unit labor costs up by 3.5%. That is an improvement. That's the only good news here. 10.2% in the second quarter, so a bit of a drop in unit labor costs. And then the trade balance comes in down $73.3 billion. This was kind of expected. The J-curve, which is economic nerd talk that will get Tom all excited. The dollar's been very strong, but it takes about a year for all of that to work itself into trade. We were expecting the trade balance to widen. It's narrowed for a couple of months, but now we're seeing it widen again. That subtracts from growth.
Next stop, payrolls. 200K the estimate, Mike. What should we be focusing on tomorrow morning?
Well, I would switch my focus from the number of jobs. I mean, theoretically, we want to see a downshift in the number of jobs created, but the unemployment rate has been holding in at 3.5%, and the Fed is looking for it to go to 4.4%. It was in September. Now, Jay Powell told us to throw those numbers out. So they're thinking that unemployment's going to go higher. When?
Yesterday was, first of all, Mike, you hit the ball out of the park. You paused him twice. Your questions were very sophisticated and brought him to a halt. There was a point where he quoted Okun's law and the beverage curve back to back. This is a guy like me who really is faking it. He can't do it. Who's advising this guy about Phillips, Taylor, Okun, and beverage? Which part of the Fed has really got his ear?
Well, obviously the Monetary Policy Division, but they've got 400 PhDs there, I think, who can explain things to him, and he does seem to be a quick learner. I mean, the one thing you see in all of the analysis is that Powell did a great job yesterday in terms of setting the markets up without causing a market crash.
Or a big market rally. You're killing me this morning. You're so lucky you've got the diplomatic Mike McKee around the table with us. Did you just say the Chairman Powell doesn't understand what he's talking about?
No, he's getting briefed by 400 PhDs. We had cumulative tightening that vaporized into a restatement of the terminal rate and the path to the terminal rate.
You have to knit it together.
The Dow only moved 800 points.
I'm sure your next guest, Dean, will knit it all together very well for you.
Can I just say what I loved about the question yesterday on the yield curve, and Bob Michael was on board with you about asking that question too, and I know you wanted to ask it before he even mentioned it, was that he said that particular part, that yield curve measurement, was still positive. And I was sat there and I was thinking, I mean, come on. By what? A couple of basis points?
Yeah, it was I had it up on my screen when I asked the question. It was 2 basis points positive.
We're going to get to Dean Mackey right now. John, 2's10 spread comes right down 55 basis points. That's a big deal within the micro data of the day. Futures at negative 28. Dean Mackey was a force on Wall Street. He went off to a gentleman named Cohen at 0.72 and is the chief U.S. economist for 0.72, and I dare say the New York Mets as well. Dr. Mackey joins us this morning. Dean Mackey, the governor of the Bank of England, just framed out a 2-year recession. America is different. How different is the United States from the turmoil of double-digit inflation we see worldwide?
The main difference, Tom, is there's just a lot more momentum in the U.S. economy. Europe and the UK are dealing with a much bigger rise in energy prices, and they have a war on their doorstep. The U.S. has a lot of momentum, especially in the service sector, and we think that's why jobless claims are staying low. We don't think the unemployment rate is going to rise soon. The momentum in the service sector is going to continue. The rate hikes are slowing things like housing, but it's not having an impact on services, and we think it'll take a long time to happen.
Dr. Mackey, you were weaned at Stanford off of John Taylor and other elites. Do their rules work now? Does Okun's law, the beverage curve of LSE that Jerome Powell mentioned yesterday, and the Taylor rule of Stanford, are those operative theories now, or are we flying by the seat of our pants?
I think, those rules can give some guidance, but really the Fed's hasn't dealt with the pandemic before in the post-pandemic era. So those rules can give the Fed some idea of where to go, but it's really a different environment right now.
How do you understand, Dean, the productivity levels that are not recovering at any kind of real pace, and this idea that we don't necessarily see any decline in the number of people who are getting jobs? How do you understand this at a time when we're hearing anecdotally so many companies laying people off, reducing some of their workforce through attrition?
I think what has happened is that not long ago, most companies were having trouble finding workers. And especially in that service sector, which is 71% of U.S. employment, there's no reason they're going to start laying people off immediately. They're looking at business. There's still the shift from goods to services spending happening, and that's bolstering service sector employment. The productivity numbers, I think, are also being weighed down by what I do think is an understatement of GDP in the first half of this year. It doesn't make sense that employers were adding 500,000 jobs per month while the economy was contracting. So I think that's eventually going to get revised to something more in line with what growth gross domestic income was telling us. But in any case, productivity is pretty weak right now.
Do you think that the labor market is an accurate reflection of some of the pain that's being felt in the market? In other words, is this really the metric that the Federal Reserve should be targeting right now to understand the progress that they're making in bringing down inflation?
I mean, I think the labor market is an important step in the process of bringing down inflation. Now, one thing I would mention is that much of the inflation we have isn't directly tied to wage inflation. We all know about the supply chain problems, the goods price surge that we saw during the pandemic and afterwards. But I do think wage growth and the labor is high enough and the labor market's tight enough that it is a force on inflation right now. So the Fed ultimately does need to slow it down, but I think it's going to be difficult for them to do that.
Dean Mackey, Dominic Constam, you knew him at Credit Suisse when you were at Barclays and at Deutsche Bank. Dominic Constam says this is a Fed that is super restrictive. Do you agree?
I wouldn't say they're super restrictive right now. They are raising rates quite rapidly, so they are getting into restrictive territory. And you are seeing them having an effect. The housing market's clearly contracting at this point. So their policy is working in that sense. But I do think that they're dealing with a different environment now where you do have still reopening that's happening in the service sector. And that means that you're not going to get the service sector contracting in the way that it often does during a recession.
Dean, we just want to know if 0.72 has done any modelling on what would happen to the Queen's economy if Aaron Judge went to the Mets. Have you modelled that out yet?
I'm working on it, but no, I haven't done it.
He's working on it, TK. That's a scoop, isn't it?
Come on, Dean. We got to,
he's working on it.
You got to have Mr. Cohen. We got to get Steve Cohen and you on the show together, Dean. I think you can provide cover for us to talk to Mr. Cohen about this. I mean, Aaron Judge, Texas Rangers, Aaron Judge, San Francisco Giants, Aaron Judge. Dean, Steve Cohen's going to let Judge go to the LA Dodgers? It's un-American.
You can run.
No comment.
Dean Mackey
Let him go.
of 0.72. Dean's like ready to pull the cable out the back of the laptop
I
or
honestly
something.
don't blame him.
Dean Mackey of 0.72. Thank you, Dean. TK, it's in sterling. You've got Governor Bailey speaking right now, pushing back hard against rate pricing. Cable 111.83 rather. We're negative 1.8% on the session.
And buttressed off of the Chancellor of the Exchequer, folks, the Secretary of Treasury, if you will, for the United Kingdom, out with a statement right following on. And John, as you interpret that, can they pull forward their fiscal plan to help Governor Bailey with the uncertainty?
I think he'd like them to, for sure. I think he'd like them to. What a difference, though. You've got a governor of a Bank of England hiking rates, but very, very worried about rate pricing right now and what it could do to the economy, particularly in the mortgage market, pushing back against mortgage pricing right now and saying rates might not have to go as high as people think they might, Lisa.
But it's a different economy, and I keep going back to this, and especially with mortgage rates that are much more prone to resetting in tandem with rates as they rise, really crimping household balance sheets much more directly. In the U.S., and this is sort of a problem and also a solution. It's both the strength and a weakness for the U.S. economy that we've immunized ourselves so significantly from a lot of these rate hikes. So the transmission mechanism just isn't there as directly as it has been in the past.
I would suggest it's a different transmission mechanism, but what really this is about is scale. The U.S. is just that much bigger. Americans, I've found, Lisa, over the years have no understanding of how compartmentalized and small the United Kingdom economy is. We don't understand. John, is it 1/7 of our size?
That was tiny compared to America. Sure.
I'm guessing off the top of my head. Americans don't understand it. We're blind. It's like London, boom, Heathrow, boom.
76. Are you saying that all
what's going on?
The United Kingdom is London and Heathrow?
Yeah, Bond Street and then New Bond Street, and you go over and there's a little cutesy pie arcade you go through.
Where's my single? London. Can we just bring up my single? This is important. Just bring up my single, just briefly. I'm sorry.
To who?
To the whole of the UK. I'm sorry. I'm trying.
How's that working out?
That's it. I'm going to go now, right? The opening bout's coming up shortly. Christian Romani of Lafayette College. Gagi Chowdhury
Probably Mohammed's on today. Is Mohammed on today?
Of Wells Fargo. He's not. He was on yesterday.
Okay, good. Thank you.
He's a busy man.
I just wish we could once, Mohammed.
He might have something to say about the Mets and Aaron Judge, though.
I think he would.
I'll give him a call. This is Bloomberg.
are the best. Keeping you up to date with news from around the world with the first word. I'm Lisa Mateo. Well, the Bank of England has increased interest rates by the most in 33 years. Policymakers voted to lift rates 75 basis points to 3%, but they strongly pushed back against market expectations for the scale of further rate hikes. A BOE statement said the peak will be lower than what is priced into financial markets. U.S. authorities are investigating whether executives have been gaming prearranged stock sale programs. They're designed to prevent the possibility of insider trading. Bloomberg's learned that the Justice Department and the SEC, they're using computer algorithms to look at pre-planned equity sales by C-suite officials. Peloton has delivered a weaker outlook for the current quarter than Wall Street was predicting. The fitness company revenue was 37% below what it was a year ago. Still, CEO Barry McCarthy said Peloton is beating its own timeline for a turnaround. Shares are down about 90% over the last 12 months. And media entrepreneur Byron Allen is preparing to make a bid for pro football's Washington Commanders. Bloomberg's learned that Allen's working with an investor group. Commanders owner Dan Snyder has hired Bank of America to explore a sale of the team. If Allen succeeds in buying the Commanders, he would be the first black majority owner of an NFL franchise. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists. I'm Lisa Mateo. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
In the past 2 decades, China has built large infrastructure projects in almost every country in Africa.
African governments themselves said, we are tired of aid and charity. We want to do trade. We want to be treated like partners. The Chinese came along and said, great, we don't do aid and charity. We want to do business with you.
Global Gateway will mobilize 300 billion euros till 2027.
Now the US and Europe are answering back with their own infrastructure initiatives to counter China, but African experts are skeptical.
China has been that guy around the corner with, a bouquet of flowers to Africa, of the US, Europe and the UK have time and time again said, be careful of the flowers you see out of the window. They have thorns on them.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
We do not believe that that recession will be sufficient to actually tame inflation, and we can just let things roll out as it will be. We need to continue to deliver on our mandate and to find that interest rate that will help us reach the target that we defined as the 2% symmetric medium term.
You know the voice, Christine Lagarde, ECB president, and I tell you, her degrees of freedom have changed in 24 hours.
Yeah, degrees of
including the guy across the channel.
I mean, but this idea that they have to keep going, even if there is a recession, highlights hiking into pain. This have to be a confirmation of what central banks.
Yeah.
You don't buy it.
I don't know if I buy it or not. What I know, folks, and this is important for those of you that are not sophisticates at this is an original Thursday looking at the Bloomberg terminal. Part of that is a conversation we had earlier with Dean Mackey, formerly with Barclays, now with Steve Cohen over at Point 72, and earlier with Dominic Constant at Credit Suisse. And it speaks to the heritage of Bloomberg's surveillance. To give you an idea, a window into it, and not the Credit Suisse of the news now that you know, but long ago and far away, it was about Neil Sauce, their head of research, into Dominic Constant on a credit desk that was read worldwide, and he had a young whippersnapper working with him, and he would turn to Ira Jersey and say, Ira, explain LIBOR. Joining us now after Dominic Constant, Ira Jersey. Ira, what was it like working daily with Dominic Constant?
So he's such a smart guy, and at the end of the day, he's a macro economist in a big way. And what I brought was a lot of the micro bottom up kind of work from my time working in on the credit desk. So that kind of mixture of macro and micro, I think, made for that particular group to be very special.
What is a micro analysis of a 5% 2-year yield due to Jerome Powell?
Yeah. So it basically is telling the market, or the market is starting to come around to the idea finally that the Federal Reserve may hike to 5% and keep that interest rate there for a long time. And it's kind of taken 3 months of Jay Powell kind of hounding the market and saying, hey, once we reach the terminal rate, we're staying there forever. And the market had not been pricing for that. And now it's starting to. Not only a higher terminal rate than the dot plot had been implying, which just the market, in fairness, has been pricing for a little while, but more importantly, that that we're starting to price out cuts. And I think that that's the important information that the market kind of took on board yesterday.
Right now, I'm looking at Fed funds futures, about 5% plus or minus a couple of basis points here and there throughout the whole of 2023. Is that fully priced into credit, given your credit expertise, given that we really haven't seen the pain that a lot of people have expected?
Well, spreads, I think, have the risk of going a little bit wider, particularly if you wind up with revenue growth, with top line growth of a lot of companies start to come down, because we are going to see a significant slower economy. But keep in mind that balance sheets are much stronger today than they were even 3-4 years ago, because when interest rates were very low, a lot of companies took that as an opportunity to refinance some of their upcoming maturities. So cash is still very high on some corporate balance sheets, and we don't expect a massive increase necessarily in defaults. You will have some, right? There's always going to be some defaults in the high yield space, and certainly weaker credits will be at risk. And you want to look at BI Intelligence's work in distress credit to find out exactly how bad that's going to be. Shameless plug, of course. I'm on with Tom, so I have to give a shameless plug. But ultimately, I think we are going to have a recession. I think this question in the jury is still going to be out because of how long it's probably going to take us to dip into that recession, how deep and how long it's going to be. And obviously, the deeper and longer it is, the more likely you wind up seeing credit spreads blow out even more than they already have, and you wind up seeing more defaults.
Are we there yet with respect to the market? Have we fully priced and even overpriced, in your estimation, the average benchmark rate over the next 2 years based on where the 2-year is trading?
Yeah, I think maybe a little bit. I think we're getting there where we're just about cheap to a little bit cheap to where we think ultimately will go. But there is the risk here, and I think this is what the market's pricing right now. There is the risk that not that the Fed goes to 5%, but maybe they go to 5.25% and 5.5%. And I think that's one of the important aspects that the market's finally gotten after a couple of months of Jay Powell hounding the market and saying, "Hey, we're going to slow down interest rate hikes." And when they slow down and they get back to that 25 basis point and meeting hike range, they can calibrate where exactly they want the Fed funds rate to go. Is that 4 3/4? Is it 5? Is it 5 1/4? Is it 5.5? Like that allows them to the slower pace allows them to kind of tweak exactly where that terminal rate's going to be.
Ira, Neil Sauce, I think he signed your paycheck long ago and far away. Neil Sauce was heated about asymmetric realities in monetary theory. We heard that twice yesterday from Chairman Powell. And the way I subscribe it is he believes he can overshoot, become, as Constam says, super restrictive, and then turn around and manage a more accommodative path. Is there any evidence a central bank can do that?
Well, they can, but I think one of the things that I think Jay Powell smartly said yesterday was that the window of having that soft landing is closing. And the issue is if they do exactly what you said, Tom, then we're going to have a recession, and it might be a little bit worse than people had ultimately thought. So the way that I see this playing out is the Federal Reserve's on hold until inflation's dead, 5, 5 1/4, 4 3/4, somewhere around there. And then ultimately, once we get inflation back down, say under 3% on the headline PCE number for a couple of months, then they have to cut and cut hard, right? And I think that the market is pricing for some of that, but not enough. My surprise this morning coming in was not that the bond market was selling off, but that the curve hadn't flattened a lot more. And I think that that's what we're ultimately going to see, negative 65, negative 75 basis points on the 2-10s curve, and we haven't seen that yet. And I think that that's the next move and the next shoe to drop.
It's exactly where I wanted to go. I'm going to do it with Lisa. Ira Jersey, thank you so much. Looking forward to the publishing of your colleagues, and you'll help out as well at Bloomberg Intelligence today. Lisa, I was going to go 2s10s, which is a negative 55 basis points earlier, and Ira looks for further steepening, inversion, I should say there. But I got to go to the real yield, and to be the heart of the matter for the rest of the week, even in the jobs day, is the real yield 160. Now 170. It's nonlinear. Its effect on America. Whatever the real yield you want to measure, yours is different than mine. It's nonlinear, and we're there where it's really going to have an impact.
Another way to put this is that if you have a relative return on the benchmark full faith and credit of the U.S. Treasury, how much does that take away from the rest of the economy? How much does that take away from the rest of the financial markets that otherwise would go into...
What's corporates doing? What are spreads doing?
Well, spreads have actually come in, particularly on the high yield side.
They're constructive in distress.
And that was something that people are wondering about. At what point will we see this really bleed into margins in a way that really is reflected? And that's what Ira was talking about. He does expect it to happen, but they have enough cash, and they've really locked in certain rates for a long time.
I don't know where to begin other than to say to our booking team, are we up to 20 people helping us now piece this together?
They're doing a fabulous job. We are incredibly grateful.
The guest quality today was off the chart. We hope you enjoy this conversation on economics, finance, investment. Lisa, sterling, 111.81.
And,
stunning.
Honestly, Ira was saying, kind of surprising it's not even weaker considering some of the projections there.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
The equity market pain continues. Live from New York City this morning. Good morning, good morning. Your equity market negative 1% on the S&P. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
Live from New York, we begin with the big issue. Slower, but higher.
Don't focus on the pace anymore.
There's a shift in narrative.
Yes, it's about the destination, not the journey.
There were two bombshells, really.
The beginning of the Fed meeting and the statement itself was misleading.
The first one is we're not pausing.
We have ways to go before we actually can pause.
The second bombshell is
suddenly more hawkish tone.
Chair Powell is more concerned about under-tightening than over-tightening.
This was a big disappointment for the market.
The Fed does not want to see a replay of what we saw in July.
The main thing for me is a new narrative.
We're past the catch-up phase. Now it's about the ultimate destination.
You're expected to see a step up in that SEP statement for the terminal rate.
The market is left guessing what this terminal rate is.
Let's get that conversation started. Joining us now is BlackRock's Gargi Chowdhury, Krishna Mamani of Lafayette College. Gargi, first to you. Okay, slower but higher. How much higher?
Good morning, John. Great to be here. So they made it very clear yesterday, or at least at the press conference, they made it very clear yesterday that we haven't seen the peak in Fed funds rate based on their SEP forecast in September. It's still going to move higher. I would imagine that when we get the dots the next time in December, that points to perhaps 4.8 or 5%. And I think the market will and already has started beginning to price in something even higher than that. And I think it's fair to say that we'll probably see perhaps even a 5.2 getting priced into the peak Fed funds rate.
In September, the 23 dot went from 380 to 460. Krishna, when they meet again in December and come out with new projections, where's that dot going to be?
Well, so they have been somewhat incremental in that approach, and the fact that they're slowing the pace down probably indicates that they want to be incremental. So I think 5% is a good number to work with. Having said that, I think to his credit, Jay Powell was very clear. He has no clue what the terminal rate is going to be. So for this meeting, for this SAP, we can get to 5%, but if the data continues to be as strong, it's probably higher. We are not pricing it at that level just yet, but that cannot be ruled out at the moment based on what we are seeing in the real data.
Yields are up right now by 11 basis points on a 2-year to 473. Citi and Vasilios Giannakis came out during the news conference just after it and said this: I can't see how US yields can stop increasing. He went on to say Powell's message to the market effectively was reprice the terminal rate higher and price out any rate cuts for next year. Their view on a 2-year, Gargi, is that the 2-year can hit 5% before year end. They say it's unequivocally dollar bullish. You've seen that play out in the FX market today. If you just compare what you heard from Chairman Powell yesterday to Governor Bailey this morning, one wants the terminal rate higher, the other one is pushing back against rate pricing. Cable right now is down 2% to 111.64. I'll get to the dollar piece in just a moment. Let's start with the front end. Gargi, a 2-year at 5%, not a long way away from where we are right now. Do you think we can get there pretty quickly?
You're right, not a long runway away at all, especially given what we heard from the Fed yesterday. Can we get there? Yes, I believe that now. I didn't even about a month and a half ago. Can we get there? Yes, but is that what is actually going to realize? Are we actually going to be happy that we bought that 2-year yield at 5%? I think the answer to that is also yes, because at the end of the day, even if the markets start pricing in this terminal at 5.25, I don't actually think they'll deliver all of that, because they've already opened the window, like slightly, ever so slightly, to this concept of needing to slow the pace. We're nowhere near a pause. We're nowhere near a pivot. All of that is far, far away, but they will slow the pace. And ultimately, this idea that the economy is going to slow down as a reaction to this very high terminal rate will have to be something that the Fed contends with. And we're seeing that, as you said, from the Bank of England already. So yes, to your answer, it could maybe go there, but I think that continues to be a really good buying opportunity for those looking for coupon.
I want to pick up on something you implied, which is there is a difference between what they signal and what they'll ultimately do. Now, Krishna, when it comes to the equity market, I just wonder how tradable that is. Let's say we're sitting here now, and you've got a chairman trying to guide you towards maybe pricing in 5% as a terminal rate, yet you don't believe they're going to get there because the data is going to do something that basically leads them to back away from that call. Krishna, is that something that you can use to get long equities right now when this chairman is really not interested in seeing equities go higher?
Well, I think getting long equities at these levels perhaps doesn't make any sense, at least not today, until we see some more data where there is some evidence of some slowdown. Having said that, I think the thesis has to be probably puts a floor as to how low equities can go, and that kind of gives you an opportunity to leg into the market. So I think if the current situation persists, the likelihood that we go through the 3,500, 3,600 floor remains somewhat spotty for the sort of reasons that Gargi just articulated. Having said that, I think I want to believe what Gargi says. I truly do. I want to be the optimist. But so far, I see nothing, absolutely nothing. And I am a perennial optimist. That gives me any level of confidence that 5% is it. That's it. That's, you know, kind of hanging on DOE to conclude sort of things for the U.S. market, I don't think is at all appropriate, because they are dealing with all sorts of other stuff. And 5% is just a number at the moment. You know, at the pace we are going, it takes a couple more meetings, and we may be north of that pretty quickly.
Hold up, Krishna. You think the scope for the terminal rate to be priced higher? How much higher?
Well, so that's a very good question. I think the trade-off, and Jay Powell kind of alluded to it, the trade-off that he's saying is basically, you know, get it higher, much higher, and then and not hold it at that level, versus get it to a modestly higher level and then hold it at that level. And I think that's the conflict that they're dealing with. And that conflict will be resolved not by what Jay Powell thinks. That conflict will only be resolved what the data does. And the data that he's focusing on is really the savings and the labor side of the equation. And neither of them are showing signs of any significant weakening. As a punting man, you know, you have to go with the data a little bit more than you would like to, but that's a reality today.
Gargi, your reaction?
Sure. So, you know, I'd say that you're right, 5% is just a number. And I think the market is actually going to price in higher than 5%. But we'll also have to see the other side, the trade-off that Krishna was talking about, playing through in the market. And look, that hasn't happened yet. They themselves talked about the lag in the FOMC statement. Of course, we forgot all about that 30 minutes later, but they did talk about the lag of policies, the lag that is going to eventually show up in the housing market. It already has. If you look at the housing starts data, which has been at the worst declining rate ever, given the pace of mortgage rate rising, it's going to follow through to other parts of the economy. So far, the Fed has been singularly focused on inflation at some point, and that point could come in 1 quarter, it could come in a little bit longer than that, but at some point they have to think about the impact that's going to have on the housing market and broadly on the labor market. Again, to Krishna's point earlier, we haven't seen that in the labor market. Thankfully, the labor market is still very strong. But do we really want to have a Fed that is creating job losses of 2, 3, 5 million? I don't think the Fed wants that, and that's why I think eventually, even though the market will and probably can price in a lot higher than 5%, they already are, or perhaps even 5.25%, I don't think they'll deliver that.
It might not be the Fed we want, but maybe it's the Fed we've got. Right now, futures on the S&P down by about 1% on the S&P 500. Yields higher, much, much higher. Some big moves in this market in the last 24 hours. On top of them, Katie Lyons. Hey, Kaylee.
Yeah, John, you can thank the chairman for that. His message yesterday was it's not about the journey and a slower pace of hikes. It's about the ultimate destination, and it's a lot higher than you guys thought back in September. So you better reprice your terminal rate expectations. And that is exactly what we have seen the markets do. Yes, we think we'll reach 5% by March, but by May and later on, we think we're going to be north of 5.10 and stay north of 5 throughout 2023. So no longer is this just a conversation about potentially cuts next year. It's higher for longer and a higher peak than previously thought. So the short end of the curve does have to re-rate because of that. We are seeing the 2-year yield climb again today, up 11 basis points intraday. We're now north of 472. This is the highest we have seen on the 2-year going back to July of 2007. And of course, really no part of the curve is immune to this force today. You are seeing yields higher across maturities. And with higher rates and higher rate expectations, equities taking a pretty hard hit. It was so interesting yesterday to see after the statement released, equity markets really trying to cling to anything dovish and then just getting smacked down by Chairman Powell, who rattled off a list of half a dozen hawkish talking points when he thought the market was still rallying. So as a result, worst Fed day for the S&P since January of 2021 yesterday. Obviously, those losses continuing this morning, and we just see that benchmark trying and failing again to break out of its technical downtrend, John.
Katie Lyons, thank you. I think we were all struck by a moment in the news conference yesterday, and I've talked about this a few times, so forgive me if you've already heard this, but I think it's worth revisiting. Right at the very end, Chairman Powell was wrongly misled into believing that the equity market was rallying in response to the Fed decision. And in response to that, he went through point by point all the hawkish talking points from the news conference. And someone messaged me, it was like a hawkish greatest hits from Chairman Powell in response to an equity market that he thought was rallying. And Krishna, it made me think, in the last 10 years, don't fight the Fed meant don't short this market. And it just feels like, looking at how that news conference played out, and I thought it was incredibly revealing. In fact, one of the most revealing moments I've seen in a news conference, perhaps ever, that he pushed back that hard against it. Isn't that basically the chairman telling you the rules of the game? That if you think you can be long in this market bullish, I don't want it that way.
Well, so I think, as somebody said, he Jackson Holed us in 2 minutes. Effectively, as you said, he went point by point, making sure that the market got the message really clearly, and the market certainly did get the message really clearly. So I think in this environment, it's very hard to be long any risk assets, and perhaps other than 1-year or 2-year notes. Those are not really risk assets, but something that can generate positive returns. Having said that, I think the point is worth remembering. He's on a mission at the moment based on the data that he's seeing today. And I think it is also fair to say that he does not, and the committee itself perhaps does not have a good handle on what the data is going to look like middle of next year. Equity investors, on the other hand, will have to contemplate some of that. So that, to me, indicates that given what is going on in other parts of the economy other than the labor market, things are softening. So expecting softening down the road is possibly something that can happen, probably will happen, but kind of taking extended exposure, expecting that today, given what we have to go through over the next few quarters, is somewhat tough.
Gargi, if you're long this equity market, are you fighting this Fed?
So as you know, John, we have actually been talking about being defensive in this equity market. We don't think you're supposed to be overweight this equity market at all. What we're seeing in the earnings season so far, we're seeing that companies have already been revising their earnings guidance all through from the summer all the way now. And when earnings estimates are so low, it is easier to beat. But at the same time, as we look forward to Q4, again, earnings estimates are going to come lower. And there's also, again, a lagged effect of the macro headwinds that we're facing with higher rates. There's a macro effect of the higher dollar that we talked about just a second ago, and how that feeds into the company bottom lines. We're already seeing that in earnings season this year. So you're supposed to remain defensive on equities. I don't think this is the moment to be buying the dip. But I will say where we do see opportunities is certain sectors within the equity markets. I would say energy has been something that we've been talking about. And again, the earnings season shows us that that continues to be a bright spot in the market. Healthcare is another one, a good place to earn some quality in your portfolio. And, remaining invested in min-vol names is something that we like. But certainly not the moment to buy the dip in equity market yet.
Gargi Chaudhry, Krishna Mamani, sticking with us. What a news conference that was yesterday. The job of the chairman in a news conference is to reflect the consensus of the committee. I just wonder how together that committee is right now, and whether the Fed speaker the next few weeks maybe highlights some cracks in the unity of the Federal Reserve. Futures right now down 0.9% on the S&P. Yields absolutely flying at the front end, up 12 basis points, 4.74 on a 2-year. Coming up, corporate America's hiring slowdown, gaining momentum.
Companies actually have been hiring, making plans, and frankly, the turnover is starting to change, and maybe they hired a little too many people too early.
That conversation up next.
On the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
The U.S. has a lot of momentum, especially in the service sector. And we think that's why jobless claims are staying low. We don't think the unemployment rate is going to rise soon. The momentum in the service sector is going to continue. The rate hikes are slowing things like housing, but it's not having an impact on services, and we think it'll take a long time to happen.
A growing list of companies announcing job cuts or hiring freezes this year. C-suites bracing for an economic slowdown. Morgan Stanley, the latest among them, according to Reuters. The latest round of data painting a different picture, with no real change in jobless claims in America. Team coverage starts right now with Kelly Lyons and Mike McKee. Mike McKee, first to you. I don't see what I'm hearing from companies in the data.
A lot of companies on that board, but not a lot of people filing for unemployment yet, at least. 217,000 the past week. That's the same as, pretty much the same as it was the week before that. And what's even more interesting is that the continuing claims numbers don't rise significantly. We are not seeing people spend a lot of time on unemployment. Those who do file are finding new jobs reasonably quickly, and that is good news for the economy. Of course, we'll be looking tomorrow to see what's happening with jobs. Do we see a slowdown? The forecast is for 200,000, and unemployment forecast to rise just a little bit. That's going to be interesting to watch. Average hourly earnings maybe step down some. And the interesting news today, productivity is falling still, down 1.4% on an annual basis, but unit labor costs dropped a little bit. So put it all together, and maybe Jay Powell's going to get what he wants.
Maybe. Just maybe.
Big maybe.
Kelly Lyons, this Fed emboldened by the labour market data Mike's been covering. At the same time, you can just look across the C-suite in corporate America right now. It's crack after crack after crack.
Yeah, and maybe the latest is Morgan Stanley, that Reuters report saying in the coming weeks they could cut perhaps a small single-digit percentage of their global workforce. We haven't gotten confirmation from the bank on that, but that would kind of jive with what James Gorman hinted on the earnings call last week. And of course, Morgan Stanley not alone. Let's talk about Twitter and Elon Musk as well. Could cut half of Twitter's workforce, about 3,700 jobs, as he tries to cut costs after overpaying $44 billion for the company. And there's more. I literally typed the word layoffs into the headline bar on my Bloomberg terminal, and there was a laundry list just in the last week. Opendoor laying off 18% of workers. Galaxy Digital may cut 20%. Qualcomm has frozen hiring. Seagate could cut 3,000 jobs. I could go on, but the point, John, is this is a wave. And PwC released a survey yesterday saying 8 out of 10 human resource officers say they're cutting jobs, freezing hiring, or employing other tactics to reduce staff. So something is going on in corporate America. Maybe the data just doesn't reflect it yet.
Kelly Lyons, Mike McKee, thank you. And as Katie's speaking, this headline, Stripe cutting staff by 14% as it readies for what they call leaner times. Bob Michael of JP Morgan Asset Management said this yesterday. The markets are priced for a soft landing. They're not priced for a recession. And it's the latter he's expecting, not the former. Krishna Mamani, do you agree?
Well, yeah, I think the market, if you look at credit spreads, and I look at credit spreads as the ultimate benchmark of recession pricing, they are certainly not pricing a recession, and that's a problem. I think if you look at the retrenchments that we are talking about, it's coming from sectors like financial services and tech primarily. It's not coming from hotels. It's not coming from restaurants. It's not coming from airlines, and that's where the labor pressures are really coming from. So yes, there is some softening in the labor market, but it isn't in the sectors that the Fed is really worried about at the moment. So and the real test of all of that is really not going to come in the next quarter, or probably not till the end of the year. It's really going to come in early part of next year. If there is any softening, that's when we are going to, we are going to see it. And so for now, we are basically stuck with the water torture from now till probably late first quarter.
It is water torture for most people, particularly if they've been long through most of this year. The co-founder of Stripe said the following just moments ago. We were much too optimistic about the internet economy's near-term growth in 22 and 23, and underestimated both the likelihood and impact of a broader slowdown. Gargi, we're not seeing this in the aggregate data just yet, the jobs market data. Maybe we see it tomorrow, I don't know. We are seeing the underperformance, though, in places like tech, and the outperformance in places like energy. Are there pockets of the market, Gargi, right now, you talked about defensive, but are there pockets of the market that you want to stay in and pockets you want to totally avoid?
Sure, John, absolutely. So there are. And I think that we have to first come to terms with the fact that We are now at a close to 2% real rate regime, and we're likely to stay there for some time. And that's a big departure from the -2 or -1% real rate regime that we were at for a long time. And this means something for different parts of the capital stack. And I think investing accordingly, to your point around what just came out from Stripe and looking at some of the earnings that came out from the mega cap tech, I think there is a recognition that's happening that discounting rate at 2% is very different than the -1.5%. So what does that mean for you as an investor? I would say look for those pockets of cash flow generation. Look for companies, sectors, and industries that have that. Energy happens to be one. Healthcare providers happen to be another one. And then I would say look for a coupon. Fixed income is giving you high-quality fixed income, such as IGSB, which is front-end investment-grade credit, is earning you 6%. Clip that coupon.
Gaki Chowdhury, that's the message from you, alongside Krishna Mamani. To the both of you, thank you. What a moment for this economy, for central banks and for markets too. Governor Bailey in the Bank of England speaking just moments ago at a news conference, saying that the UK is suffering a bigger income shock than in the 1970s. If you're following cable right now, 111.67. Nothing like the 103.50s we saw back at the end of September, but still it's a 2% move negative on the day against sterling in the favor of a stronger US dollar off the back of much higher bond yields, up 11 basis points on a 2-year, 4.73. Equity futures lower now on the S&P by 1 full percentage point. Up next, the morning calls, and later, Chris Harvey of Wells Fargo anticipating 3Q earnings to see the worst penalties on record.
Expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question.
That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Minutes away from the opening bell, equity futures down 9/10 on the S&P. On the Nasdaq, we're down by about 1 full percentage point. That's the price action. Here's the morning calls. First up, JP Morgan downgrading Corvo to underweight from overweight, highlighting global macro headwinds and bloated inventories. Next up, Rosenblatt downgrading Roku to neutral, expressing concerns about the company's outlook. And finally, KeyBank cutting its Qualcomm price target down to 150, expecting demand and supply challenges to continue after earnings. Coming up on this program, betting on momentum and earnings volatility. That's the call from Chris Harvey of Wells Fargo. He joins us at the opening bell. The opening bell just around the corner with futures down 0.9%. The cash open up next.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
As Americans decide the future of Congress and state legislatures, Bloomberg will be live in Washington, D.C. to cover the results as they break and provide insight about what it means for the country.
We're in a divided country, and these are really close elections. We take a look at what the races could mean for Wall Street.
Special election night coverage starts at 8 p.m. on Bloomberg Television and Radio. And tune into Surveillance live from D.C. at 6 a.m. on Wednesday for the latest overnight. This is Bloomberg. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
25 seconds away from the opening bell this morning, the worst Fed day price action on the S&P since January 2021. That stat for you from Rita Nazareth here at Bloomberg. Futures right now down 1% on S&P 500 futures. On the NASDAQ, we are down by more than 1% again. Negative follow-through here on the equity market. There's the opening bell this Thursday morning. Switch on the board and get to the bond market. Pain, the epicenter of it, yields up 9 basis points on a 10-year, just south of 420, 419.31. Check out the front end. Ugly, up 10 basis points, 472 on a 2-year. The highs of the year, the highest since 2007. If you get yields this high, you get some dollar strength. It's biting into the euro, 97.54 on euro dollar, down by 0.6%. It's taken a chunk out of sterling. Cable, 111.75, negative 1.9%. Chairman Powell pushed in one way. Governor Bailey trying to lean in the other direction. In crude, 87.98, we're down by more than 2%. That's the cross-asset price action. Here's the open for you. About 35 seconds in, we're down by more than 1% on the S&P. On the NASDAQ, we're down by 1.2. More warnings from corporate America. Here's another one from Qualcomm telling investors the following. The softening macroeconomic environment and sustained COVID restrictions in China have led to broad-based demand weakening on the West Coast. Let's get to Ed Ludlow. Morning, Ed.
Yeah, good morning, Jonathan. We're down more than 7.5% on Qualcomm. Biggest drop since June. Biggest drag, of course, on the Philadelphia Semiconductor Index, which is down 1.7% itself. There's two things happening here with Qualcomm. First, as you said, demand for handsets, and Qualcomm is the biggest maker of smartphone processors and modems for the iPhone, is dropping off a cliff, right? Previously, Qualcomm had guided that handset shipments would drop by single digits in full year calendar 22. They've changed that guidance to say it will be low double digits in terms of the drop in handset shipments. The other thing is that inventories are now an issue. We've changed the story in the semiconductor space completely. COVID restrictions in China and that weakening macroeconomic condition globally means that you have increasing supply and lower demand, which means that there's 8 to 10 weeks of inventory for Qualcomm's customers. Instead of ordering more chips, they're waiting to whittle down those inventories. Qualcomm emphasizing this is short term. They expect it to take a couple of quarters to work that out. But how quickly has that story changed, John, from the beginning of this year, where we were supply constrained and demand was intense? There was a shortage of specific chips. This was a record quarter in terms of revenue just gone for Qualcomm. That's worth pointing out. And there was another win. Previously, they expected to build around 20% of the modems for the 2023 iPhone handset. They're now expecting to build the majority of those modems. Why is that important? It's an interesting point that Apple seems to be struggling to do this part of their business in-house. A win for Qualcomm. It's not helping the shares, but really the macroeconomic readout is what's important here.
The stock down by more than 7%. I talked about the bond market taking a chunk out of the FX market, out of the euro, out of sterling, and it's taken a chunk out of the labour force on the West Coast. Stripe, here's the headline from them moments ago. Cutting staff by 14%. It's readying for what they call leaner times. The co-founder said this: "We were much too optimistic about the internet company's near-term growth in 22, 23, and underestimated both the likelihood and impact of a broader slowdown." Ed, they are not alone, are they?
They're not alone. You look especially across some of the larger growth names in the private company space, Instacart including in that, they are battening down the hatches for what is a changing market. Stripe was pretty bloated, right? I think we started the year at 8,000 employees. We're now going back to 7,000, a cut of 1,000. But what I'm hearing from venture capitalists on all levels of the curve, from seed through to growth equity stage, is now is a time to be disciplined. Preserve cash. Do not invest with risk, and be conservative with hiring. And that is exactly what this Stripe story represents that's crossed the Bloomberg.
Hey Ed, thank you, buddy. Great coverage as always. About 3 or 4 minutes into this, the equity market's down by a little more than 1%. You break down the industry grouping on the Bloomberg, every single group right now on my screen is in the red and negative. Consumer discretionary with some relative outperformance, believe it or not, down just 1/3 of 1%. Energy down by about 0.6 of 1%. Financials, bottom of the pile. Off the back of the bond market move, curious. Financials down by 1.35%. Information technology down by 1.25%. Real estate down by 1%. Utilities off by 0.9. Industrials down by 0.8. Take your pick. It's down on the session. More punishment for earnings misses seems to be the theme so far in earnings season. Chris Harvey of Wells Fargo said this: "The third quarter is on track for a new record for harshest EPS miss penalties. While this is a risk, there have also been opportunities for larger rewards." Chris, I'm pleased to say, joins us right now. Chris, lovely to catch up with you, mate, as always. Let's start with the corporate numbers. What are you learning so far from this earnings season, Chris?
What we're learning so far from this earnings season is what you would expect. It's becoming more and more difficult to beat. If you are beating, the market is rewarding you. But if you're missing, the market's really penalizing. You're not going to get saved out by the economy. You're not going to get saved out by the Fed. And if you can't turn things around, things are just going to get worse and worse and worse, which leads us to why we've been pushing momentum strategies for so long, right? The things that are not working will continue not to work, and the things that are working will do better, right? And that's not a very exciting or sexy comment, but that's where we are. It's a very robust comment, and it's what we're seeing in the marketplace.
Chris, how much has this assessment been skewed by big tech and single names, the likes of Meta, Amazon, Microsoft, Alphabet?
Right. So obviously those names, they make the headlines, and we see that. But we're seeing this across the board. The only place where we're really seeing a different kind of reaction is across momentum stocks. And when we look at momentum stocks, you get a much better reaction from your higher momentum stocks, and you get a much worse reaction from your low momentum stocks. But to answer the original question, you're getting those big headline stocks really miss and come down, but you're seeing this across the board. This is not something that's just specific to larger cap. It's just highlighted a lot more than it is for the mid and smaller cap stocks.
And Chris, we've all had trouble trying to work out when the real weakness from this turn down in the global economy is going to come about. You and I have had that conversation. Would it be Q1 of 2023? Would it be the back end of 2022? Chris, just on the pace of the downturn in corporate earnings, the weakness you're expecting to see, is it coming in quicker than expected or slower than expected?
I think it's really coming in line with our expectations. So we didn't expect numbers to come down dramatically this quarter. We think numbers will come down dramatically next year because the underlying fundamentals are still okay. You're seeing the cracks. You're seeing certain companies do better, certain companies do worse, but it's not a terrible environment, right? You know, let's take a step back. What's happening in the broader market? The broader market's down 20%. Why is the broader market down 20%? Is because the cost of capital is more than doubled. It's not because the fundamentals elicit a 20% down. If you go back to 08, we had Bear Stearns, we had Freddie, we had Fannie, we had Lehman go belly up. That's not what you're seeing on the fundamental side. What you're seeing is a cost of capital issue. But at the end of the day, What we worry about is those fundamentals will roll over next year. Numbers do have to come down, and that's when things get even sloppier.
This is what Bob Michael at JP Morgan said 24 hours ago on this program. Literally 24 hours ago to the second. He said this might be, Chris, the calm before the storm. Do you agree?
I do think things are going to get worse. As you point out, the front end of the curve, rates are going higher. The Fed is telling you that rates are going to go higher. The big comment for us yesterday was, hey, it's going to, the penalty for over-tightening is much less than the penalty for going too slow. Now, they didn't say that specifically, but that's the message we took away. And that's what the market really didn't like. And so is it the calm in front of the storm? Let's just say things are going to get tougher in the first half of next year on a fundamental basis. And the Fed, what is the Fed doing? What is the Fed saying? Hey, we can't crack the job market. We have a inflation problem. So we're still going to raise rates until either the job market cracks or inflation comes down. And again, that's not great for risk product.
They couldn't have been clearer. Chairman Powell said the path to a soft landing has got narrower. He said that since the last meeting, the terminal rate probably has to shift higher. He built on that. I'm going to build on the words you just said, Chris. Your takeaway, not off the mark. He doubled down on it more than once. I think he went about 5 times on it. Talked about the risk of doing too little outweighing the risk of doing too more. The risk was asymmetric. Chris, with all of that in mind, I've asked this question a few times this morning. I want to ask the same question of you. If you're long this equity market right now, are you fighting this Fed?
Oh, yeah, you're definitely fighting the Fed. So what happened last year and what's been happening over the last couple of years? The cost of capital, the Fed brought down the cost of capital to a level that it never should have been at, right? Real rates were negative 100 basis points not that long ago. So they subsidized the cost of capital. What would you expect to see? You would expect financial prices, real prices, tangible prices to go higher. You bring the cost of capital back up, well, you need to adjust price, right? So prices need to come down, and that's what we're seeing. Now, what's also going to occur is you're going to slow down the economy. So now it's not just a cost of capital adjustment, it's a cost of capital and a fundamental adjustment, which is coming up. And that's just a tough environment to invest in. So yeah, you're absolutely positively fighting the Fed if you're long the market.
Chris, so just a final question from me. I want to gauge from you and your team and the conversations you're having with clients right now as to whether you truly believe the reaction function of this Federal Reserve. I've heard some people call this guy at the Federal Reserve, this chairman, a dove in hawk's clothing, that ultimately, when times get tough, he'll back away. Do you believe that we could get a recession next year in the United States and this Fed would not cut interest rates?
John, that's a really good question. And what I would say is this is a Fed that's really difficult for us to handicap. The Yellen Fed, the Bernanke Fed, the Greenspan Fed was a lot easier to understand and handicap. This one's a lot more difficult. And so I don't know the answer to that. And the other question that we're talking about is, hey, what's driving inflation and what's interest rate sensitive and what's not? Okay, are we fighting owner equivalent rent? Are we fighting commodity prices? Are we fighting wages? Because each one has a different interest rate sensitivity, and raising rates may not be the best solution for these things. And so they probably do have to go too far. But to answer your original question, it's really tough to handicap them because I'm not sure exactly what drives them and what makes them tick.
It's tremendously difficult. Chris, wonderful to catch up, buddy. We'll catch up soon before year end, I'm sure. Chris Harvey of Wells Fargo. Equities down 9/10 on the S&P. On the Nasdaq, we're down about 1 full percentage point off the back of the moves in the bond market, up 10 basis points to the front end. That move fades just a little bit, but still up 9 or 10 basis points. Quite a move and building on the gains of yesterday. 472 on 2s, on 10s, 418-ish. Up 7 or 8 basis points off the back of that. Guess what? Dollar stronger against pretty much every single currency in G10 right now. Coming up, it's the home stretch ahead of the midterms.
There are candidates running for every level of office in America. This is a path to chaos in America.
That conversation still ahead.
knows the world like Bloomberg.
The writing's on the wall for the Bank of England. Just Stop Oil has spray painted the front door.
Recession in Europe, UK, and possibly the US.
Brazilians are out in full force celebrating the election victory of former President Lula da Silva.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Should we anticipate that you will have regulations clarifying what the SEC is going to do on cryptocurrencies and related kinds of things in the near future?
It's pretty clear that many of these tokens may be securities. What we've asked the trading platforms, the lending platforms, the other various venues to come in, to work with us, to get registered under the securities laws, because if a platform has 50 or some of them 500 tokens on their platform, probabilities are they're not all non-securities.
Now, there's another issue that has arisen, which is called gamification, which is to say people are making a game out of trying to buy stocks. Are you worried about this phenomenon?
We live in the 2020s in a new digital age where applications on our phones can use massive amount of data and then predict our behavior. What do we do when the digital algorithms are maximizing for the company's revenues rather than our returns? And so we're trying to think that through. It's not just gamification, it's a little bit more than that. It's whether there's a conflict between the app and our investment returns.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
As I stand here today, there are candidates running for every level of office in America, for governor, Congress, Attorney General, Secretary of State, who won't commit. They will not commit to accepting the results of elections that they're running in. This is a path to chaos in America. It's unprecedented. It's unlawful. And it's un-American.
President Biden ramping up the rhetoric ahead of midterms, the GOP pushing back. Leader McCarthy tweeting, President Biden is trying to divide and deflect because he can't talk about his policies that have driven up the cost of living. All of this as Fed Chair Jay Powell raising rates yet again, despite Democratic pushback. The White House still taking the Fed's side.
The Fed is an independent agency, and we respect their independence. The Fed actions help bring inflation down, stable and steady growth with lower inflation. This is the kind of economy that delivers for working families, and that's how we see the work of the Fed.
The team coverage starts right now with AMH down in D.C. Mike McKee with us here in New York. Morning, Anne-Marie.
Good morning, John. What you just heard there from the president's press secretary, we just heard as well from his chief of staff, Ron Klain, saying here at the White House, he was asked directly about the Fed from MSNBC, and he said here at the White House, we don't comment on monetary policy. The issue this White House is facing, of course, Jonathan, is really twofold. One is the midterm elections, where the economy is front and center. You see that with this latest Wall Street Journal poll today. The numbers are getting worse, especially for a robust voting group like suburban white women. They are now leaning towards Republicans just because it costs more to live every day. And the second is the fact that this White House doesn't want to comment about the Fed, but members of their own party do. And we see a growing chorus of Democrats really taking aim at Fed Chair Jay Powell about this aggressive hiking and what that could potentially mean for the future of the economy.
Mike McKee, in that news conference yesterday, after all these questions being asked by Democratic senators, do you think the chairman answered those questions or fueled the fire?
probably fueled the fire a little bit because he said we're going to continue raising interest rates, and the politicians don't like that, especially when it's a week before the election. It's interesting, under the Trump administration, the idea that the administration did not talk about the Fed went out the window. What will happen if Republicans take one of those houses back? Well, they're going to complain about what the Fed's done for recession and inflation, because that's what politicians do. But there are some questions about the Fed's dual mandate. Should they focus on price stability only? They may look into bank capital requirements. Some members of the Republican Party don't like the idea that the Fed's raised capital requirements. There is a possible Fed ethics probe. The chairman was asked about that yesterday. And then rules around central bank digital currency are probably going to be coming up in the next few years, and they will want input into that. Biggest thing, of course, that's going to be coming up soon, the debt limit. The speaker-to-be, perhaps, does not wants to hold the economy hostage to get spending cuts out of President Biden, but the incoming head of the Banking and Finance Committee, Patrick McHenry, does not. So it'll be interesting to see how that dynamic plays out. Fed is going to kind of ignore it all unless perhaps we do violate the debt limit.
Anne-Marie, we all know the probabilities, but we've only really discussed one outcome, and that's a red wave or maybe a divided Congress. MH, what happens if we get a blue wave? What's on the table next for this administration if they get what they'd love to see, which many people doubt they'll get to see?
Well, it's interesting because their major big-ticket landmark items they wanted to get done, they have. They had the Inflation Reduction Act, which is a very little version of Build Back Better. This was a huge effort from the administration in the first year. They were able to get hard infrastructure done alongside Republicans 2 summers ago. So they were able to get a number of things, as well as the Semiconductor Chips Act. So they were able to get all this done, also likely with an expectation that history does say that in most midterm elections, it's a referendum on those in charge, and usually the president's party doesn't fare well. What I would have focused on for next year, Jonathan, and this is off of another Wall Street Journal poll this morning, is what about the foreign policy and the international money, right? Because that is something that this administration continues to tell its friends and partners, the Ukrainians, that will continue to flow. We've already heard, from some Republicans saying there's not going to be a, quote, blank check. And in this poll, it does seem to reflect that.
It's slowly becoming a partisan issue. You mentioned the White House Chief of Staff, Ron Klain, speaking on MSNBC a little bit earlier this morning. He said the United States is not in recession. Mike McKee, a lot of economists will agree with that assessment because the labor market hasn't broken down. And the Federal Reserve has the support of this White House for now. And I say for now, Mike, because it hasn't been tested yet. If we see this labor market break down, do we have a different approach?
I don't think so. I think the Democrats have internalized the idea of you don't criticize the Fed, you let the Fed do its job, and that's why it was set up as an independent agency. Republicans, obviously, in the last administration went a different way. So we've got 2 more years at least of Joe Biden, and I don't think you'll see a lot of pressure out of the White House. There may be some behind the scenes. Joe Biden may have Jay Powell over to lunch, but Powell is now in his second term, and so he's not going anywhere. And I think the White House knows it can't do much about changing the Fed's mind.
Mike, let's talk about the data briefly. The S&P down by 1.26%. On the NASDAQ, we're down by 1.4%. We had the PMIs out moments ago. I believe we get the ISM Services Index at the top of the hour.
Yeah, the PMIs come in a little bit stronger for services and for composite, but they're still under 50. The services number at 47.8 and the composite number at 48.2. So we do see some signs of contraction in those S&P PMIs. The services PMI from ISM is going to be really interesting because that's been the strongest part of the economy. We did see a big drop in prices paid in the ISM manufacturing index. So let's see if on the services side, inflation is still holding up. That's what Powell was talking about yesterday.
What a negative 24 hours. Mike McKee, great work at a press conference. Had a ton of messages about that. Just wonderful as always. AMH down in DC, Anne-Marie, thank you as always. The run into the midterms within a week. A week from today, we get CPI in America. Don't lose sight of that. November 10th. And then the next print is December 13th. And that's about a day away from the next Fed decision. So I think we're at the mercy of that. Until then, it's an equity market that trades lower, softer, negative. We're down by 1.4% on the S&P. On the NASDAQ, we're down by about 1.5% plus. Let's get you some sector price action. Here's Abby.
Well, John, with that bearish action, with the S&P 500, the other indexes down 4 days in a row, and at this point, we're looking at a down week, the worst week since June. Not surprisingly, most sectors are lower. There's only one that's higher. That's energy, which is kind of curious, only because we do have oil down. But that, of course, has been the safe haven, quote-unquote, safe haven sector all year long last year, where there's nowhere else to hide, investors going there. But to your point on the bearishness for technology, tech down 2.5%, communication services, some of those other mega cap techs down 1.6%, financials, even with yields down 1.5%. Many of these sectors down 1%. What I really want to highlight, though, is we do, of course, have this other pocket of weakness. That is China tech. Now, on a relative basis today, it's not down so much. It's down about 1%. But over the last 2 months, that NASDAQ Golden Dragon Index down 33% in just 2 months. That's not even the peak to trough decline. That's closer to 35%. But take a look at the NYSE FANG Index, which has some of those China tech ADRs down 20%. And then the NASDAQ over this time period down 11%. So it's felt like we've been in this rebound rally. But when we break it down this way, John, I don't know. This year's bear market still seems to be in play.
Brutal, I think, is the word I've maybe overused this year, but brutal. Abby, thank you. Yields up, stocks down. I've said that how many times through 2022? I'm going to say it again. Yields up, stocks down. On the S&P by 1.4%. On a 2-year, up 10 basis points to 472. Coming up.
Nutrigenomics and precision nutrition is one of those rare scientific fields that overlaps with the Instagram-friendly wellness industry.
There is a lot of interest in this idea of personalized nutrition, and especially how accessible it is to the public. You can go on Google and type personalized nutrition or diet and genes, and you will find dozens of different companies that offer this nutrition precision tests.
One of those companies is Routine. Routine claims that their personalized tests stemming from sciences like nutrigenomics make their supplements different. But even with the claims from Routine, as well as dozens of other personalized nutrition companies, the science still has a long way to go.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. Negative follow-through post-Fed and into Thursday. Equities down by 1.4%, down by 1.8% on the NASDAQ. Yields higher, treasuries lower. Look at the moves at the front end of the yield curve on a 2-year right now, up about 10 basis points or so, 472 on 2s. That's the price action. Here's the trading diary. ISM services data at the top of the hour. President Biden discussing student debt relief at 3:45 Eastern time. Fed speak returns on Friday. Boston Fed President Susan Collins scheduled to speak. And finally, we close out the week with the payrolls report. Right now, the estimate in our survey is at about 200K. Fantastic lineup for you tomorrow. As always on this program, looking forward to catching up with Rick Reeder, with Anastasia Amoroso, with Mike Collins, and we should hear from the White House first on this program. We'll catch up with the Labour Secretary. Looking forward to that too. From New York, good luck for the rest of the trading day. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
USA, but the sign on the CEO's door often says, Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
The top names in business are on Bloomberg.
The financial services industry, which is a large part of the UK, is very competitive. But it's not the only one. Health sciences, even technology and fintech are very, very bright stars in the UK.
The market environment isn't a very challenging one. It's not about blaming the markets. The markets is the same for everyone. And that's exactly how we deal with it.
90% of our clients are indicating we need more guidance. And if they want more guidance, that's why they bring their money to us.
Nobody covers business like Bloomberg, your global business authority.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands. And it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi-Cola, Coca-Cola. In the 1990s, it was everywhere. Pepsi and Coca-Cola were embroiled in what is now known as the Cola Wars. It was a fierce battle for market dominance. Number Fever was already a really popular promotion. It had been rolled out in America to great success. And so Pepsi decided to roll it out internationally, particularly in Asia. They thought it was the answer to their problems. They thought it could finally help them beat their biggest competitor.
Look for the winning number in Sari stores every day, also on TV, radio, and newspapers. You could be a millionaire.
$1 million pesos, or $68,000, doesn't sound like a lot now, but in 1992, that was a phenomenal amount of money. You've got to remember that in the Philippines at the time, the average monthly income was about $100, so $1 million pesos was wealth beyond anyone's wildest imaginations. Number Fever caught fire in the Philippines. Kids were saving up their pocket money to buy a bottle of Pepsi. Parents were squirreling away all of the bottle caps in bags. You would walk down the street and people were going through trash trying to find discarded bottle caps. It was a national phenomenon. Pepsi boasted that half the population of the Philippines was playing it. Number fever boosted Pepsi's sales every month from $10 million to $14 million. It had a huge impact on Pepsi's bottom line. Number fever quickly became number hysteria. Maids were being jailed for stealing their employers' winning bottle caps. There was even some murders over winning bottle caps. People were fighting in the streets over these caps. There were signs that there were going to be problems with number fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the streets, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for number fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines. because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the number fever campaign. Del Fierro thought Pepsi's number fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance, per se, is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired two consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue a warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as a coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war, so the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to actually go public. Salaries for soccer players in the Bundesliga have gone up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Bayern Munich.
Unfortunately, that didn't go too well. Dortmund bought too many expensive players, high wages, and the club almost went bust in 2005.
The price of their shares, it has sometimes gone up, but mostly gone down since they made that decision. So on April 11th, 2017, the team was staying in a hotel on the outskirts of Dortmund.
Match days are always special in Dortmund. Everyone is looking forward to it. The team always meets in the same hotel ahead of matches.
They stayed in this hotel in order to have a kind of neutral space before games so that they could concentrate, be sort of isolated from distractions, things like that.
Everyone was pretty optimistic they had a chance to go really far, maybe into the finals. I was in the office and getting ready for match day. I was going to meet with a friend, a fellow Dortmund supporter, in a pub. As always, the fans are very excited about matches.
On that day, they were heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus. And I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venegold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venegold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venegold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venegold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do.